Welcome back. We are back for day 2 of our inaugural Benzinga Global Small Cap Conference. We had a full day of content yesterday, tons of investor presentations, several amazing industry-focused panels, great market education from the Lizard King, awesome name. But I'm back with a very special guest, everybody's favorite, Hot Stocks Luke. Luke, are you there, my friend?
I'm here. What's up, everybody? As Elliot mentioned, we have a jam-packed day. We're not only going to hear from some of these small cap companies, which is your chance to get ahead of up-and-coming technologies and really build alpha in the markets, but we are going to have some of the best educators around as well.
Oh, I'm excited. You know what? We had a lot of cool content yesterday. If you missed it, highly recommend going back and watching all day yesterday, because Luke and several of our amazing guests gave some awesome stock picks and backed them up. We got some incredible stories, and we dove into, obviously, the small cap companies that were presenting. I mean, the amount of information we got about, who to put on your watch list at least was pretty incredible. I do want to do one small shout out to Markham. As you can see right behind me, they are our title sponsor. They have been a huge assistance to us. If you are a company looking for services, IPO, if you're public, please reach out to them. They're incredible. Luke, how are you today, man? What you looking forward to?
Elliot. Well, you know what I'm looking forward to? Boom! Another full day of notes.
Taking more notes.
I can't do a Benzinga event without saying this. Today has so much content, and we got bombarded with emails after the event yesterday of people asking for replays. Guys, make sure that you have your notepads out. You are not going to want to miss any of these stocks. I mean, we've got a total of 60 stocks between the 2 days, and you're not going to want to miss any of the presenters. We're going to talk about charting.
We have more than that. I think we have like 70, 75, or maybe around 70.
Almost 80 companies.
Yeah, I mean,
regardless, you need the freaking notes.
Touche. Now, Luke, yesterday we had some pretty fun giveaways. To my knowledge, we may or may not be doing that again today.
So we're doing the giveaways again. If 80 company presentations again, you're learning about these companies before Wall Street knows about them, before hedge funds can invest in them. If 80 of those presentations, if about 10 of the best educators, if that's not enough for you, we're also doing giveaways. We like to make it fun. We like to have some suspense built in, so you must be present to win. You should be sitting at the edge of your seat waiting to get these prizes. We're going to have a lifetime subscription to Benzinga Pro. That's something that we sell for almost $6,000. We're going to have giveaways for Benzinga options, giveaways for the Benzinga merch store. And all that you have to do is fill out this link that I'm going to drop in the chat. You've got to give your email address and your favorite stock. That's it. And you're automatically in. We're going to be calling them every 2 hours.
Y'all, and give some cool stocks, because Luke will call you out if you don't give a cool stock.
Yes, our first winner yesterday picked Microsoft as his favorite stock. Lame choice, especially at a small cap conference. Pick something small or at least interesting.
I will say, you told us Ford is going to make a nice impact next year, so you got some proving to do as well. I'm just saying. That's to the person that picked Microsoft. Awesome. So super excited about today. I do want to call attention to our other shows that we have. We obviously have a whole other track happening today, so make sure you check that out. Obviously, when we're not going, check it out later. We're cooler. What was that?
Yeah,
first is the worst.
First is the worst. Second is the best. Thank you.
And here we are.
I recommend you just hang out on track 2 all day. We're a lot more fun.
I'm down for it. We're happy to have you. We have an awesome company. Let's actually go ahead and get started. I want to jump right in. We're starting with Yatra. That is NASDAQ listed, YTRA, presented by the CEO and co-founder, Dhruv Shringi. Dhruv, are you with us? And did I at all pronounce your name right? It looks like you might need to turn your video and camera on.
And while he's doing that, I'll say in the daily show that I host a daily stock show on the Benzinga YouTube channel. We get asked about the stock almost every single day. I mean, this is definitely a popular name, so I'm excited for this presentation.
Fantastic. Dhruv, how are you, sir?
Good. How are you guys doing?
We're very well. Did I say your name right, Dhruv Shringi?
That's pretty good. Yeah.
Okay, pretty good. I'll take it. I'll take it.
That's great. Yeah.
Well, we're going to let you dive right in. We want to go ahead and get started, and we're obviously starting off with a power presentation. So tell us all about Yatra. You're welcome to share your screen and go ahead and get started.
Sure. I'll just do that. If I can just request the host to enable screen sharing, please.
All right, we'll do that right now. Good to go.
Yeah, morning, everyone. My name is Dhruv Shringi. I'm the co-founder and CEO of Yatra Online Inc. Yatra is one of the leading online travel companies in India. We were set up back in 2006 by me and a colleague of mine. We both used to work in the online travel space in Europe, and we moved back to India in early 2006 to set it up. So from there, Yatra has grown from a 2-member team to almost a 1,200 people organization today. In 2019, we did $1.5 billion of GMV. So we are well established in the Indian travel ecosystem, and I'll walk you through that today. Just the usual safe harbor. So some key highlights about Yatra. As I mentioned, we are one of the most well-recognized homegrown Indian internet brands. We are the largest corporate travel service provider in India and the second largest consumer OTA in the country. We are well positioned to benefit from India's growing travel market. And as you can imagine, during this pandemic era, digitization has really gained a lot of traction. So our business is expected to accelerate strongly on the back of this growth of digital penetration in India for both consumers and business. We're very bottom line focused, and over the last 9 months have taken stringent steps to optimize our cost, very disciplined on our marketing and focused on execution. Pre-COVID, our annual adjusted revenue run rate was about $89 million, and we had an EBITDA margin of about 13%. Our adjusted revenue in Q2 of fiscal 21, so we follow the Indian fiscal year, which runs from April to March. So for the quarter ended September 2020, we did about $5.1 million in revenue, and our adjusted EBITDA loss improved from 4.1 million in the first quarter, which is the June quarter, to about 1.7 million in Q2. So post the impact of COVID, the market gradually seems to be coming back, and we've started definitely seeing green shoots of recovery in the Indian OTA segment. So in terms of Yatra, we're a comprehensive travel solution provider. We are the second largest consumer direct OTA and the largest corporate travel platform in the country. In fiscal year 2019, we did about 111 billion rupees in gross bookings and about 8.9 billion rupees in terms of revenue. Our revenue declined in fiscal year 2020, partly on account of COVID, which impacted us towards the end of the fiscal year. And also, more importantly, we were in the process of going through a merger with Ebix, which is another NASDAQ listed company. And as part of some constraints under the merger agreement, we had scaled back our growth. However, that merger did not happen, and we are now back to being an independent company. Some other key highlights of Yatra. So we have 11.1 million cumulative customers, get about 212 million visits a year, have the largest inventory of domestic hotels in India with over 100,000 hotels, a very strong and loyal customer base. 88% of our transactions come from repeat customers, high degree of mobile penetration with 83% of traffic coming on mobile devices, and the largest corporate travel platform in India with over 700 large corporate customers. Our go-to-market strategy is a bit differentiated from what you would typically look at. So we are maybe, a bit different from the traditional OTAs who are only consumer focused. And the reason behind that is that in an emerging market like India, business travel still is the larger part of the overall travel ecosystem. So as you can see out here, business travel is about a $32 billion market opportunity, whereas consumer travel is about 19 billion. The online penetration that we've seen on consumer travel also is higher. at about 38%, whereas on the business travel side, it's still low single digits. So we think from an upside and growth opportunity perspective, business travel also offers a great growth opportunity going forward. In addition to the 700 large corporate customers, we have about 35,000 odd small and medium scale enterprises as well that use us. The Indian aviation market, at least pre-COVID, was growing very rapidly. From an air traffic point of view, India is ranked the 5th in the globe in terms of number of passengers. We are at about 140 million passengers pre-COVID in terms of annual passenger movement. On the back of the growth, and this passenger movement actually was growing in the early teens. So on the back of the growth of this passenger movement, the airlines were also expanding capacity strongly. So as you see on the chart below that, while there are currently about 600 aircrafts operating in India, there's a near similar number on order as well. The chart on the right, top right, shows you the growth which is expected in traffic. So it's expected to cross 1.1 billion people traveling per year by 2040 from the about 140 million which traveled in 2019. On the back of this growth, the airport infrastructure also is expected to double between now and 2040. The consumer market is shifting online, and this is growing at a fairly brisk pace. So in 2017, about 39% of the market was online. By 2021, approximately 45% of the market is expected to be online. And the OTAs in India continue to be the dominant form of online transaction. The share of OTAs continues to be larger than the airline and the supplier direct websites. And the reason behind this is that in India, given a high proportion of the traffic is coming on mobile devices, the mobile traffic inherently favors an aggregator. People are not very comfortable opening multiple screens on small 4.5-inch devices. So they prefer an aggregator app where they can go search and book across multiple suppliers. The corporate travel market in India was growing at a CAGR of 12% pre-COVID. It was the fastest growing large corporate travel market in the world, and it's about a $32 billion opportunity. About half to about 2/3 of the market for corporate travel is air, about 25% is hotels, and 15% are other services. Business travel is quite closely linked to the growth of GDP in India. And given that India is expected to recover strongly in 2021 and 2022, we expect business travel to also come back on the back of this growth of the underlying economy. The business travel market, just digging a bit deeper into this, it's 13,000 companies that make up about 28% of the volume. And then the rest of it is spread over 100,000 plus SMEs. In this 13,000 segment, we are the market leaders. We've got about 700 out of these 13,000 large corporate customers. And obviously, our focus on this side is towards the very large corporate customers. So we would have some of the largest software development companies in India as our customers. We would have the big accounting firms, so an EY, PwC, a KPMG, a BCG, all of these guys would be our customers. Some of the biggest banks in India would be our customers, etc. On COVID, India seems to be doing reasonably well under the given circumstances. The number of new cases continue to decline. And as you can see out here, from a peak which was almost nearing 100,000, somewhere around mid-September, we are at about 35 to 36,000 cases a day. And the recoveries seem to be higher than the new cases coming through. So we think India, should be able to get this under control relatively quickly. And if you look at this on a, per capita kind of number, on a cases per thousand, India would rank somewhere, around the 90s, whereas the US, by contrast, would rank 12th. So India, I think, is doing reasonably well given the size and scale of the population. Obviously, the absolute numbers are high, but it has to be looked at in the context of the 1.4 billion population in the country. The other interesting thing to note out here, and this is another reason why domestic travel is picking up strongly in India, is that a vast majority of India's population, almost 60%, is under the age of 30. And on account of that, the mortality rates in India are on the lower side with just about 1.4%. So if you look at the growth in terms of domestic travel market, so while early part of this year, pre-COVID, we were doing about 12 million passengers a month, and this came to a standstill in the month of April and May. From there, there's been a fairly brisk recovery that's happening, and November was almost 50% of pre-COVID. Going forward, the aviation ministry has now allowed airlines to operate between 70 to 80% of their pre-COVID capacity. So we expect that, maybe by the early part of 2021, we should be looking at closer to about 80% of pre-COVID, and by the middle of next year, getting back to pre-COVID levels. On the international front, international travel to a great extent is still governed by the bubble agreements that exist. These are the bilateral travel agreements between countries. Here, the capacity is back to about 10% of pre-COVID, but as the vaccine gets propagated, we expect this number to begin to recover as well. We expect to get to about 50% of pre-COVID levels by the middle of 2021, and then by the end of 2021, get to pre-COVID levels. The approach that we've taken to India in terms of building out an online travel platform is unique, but we think is best suited for the realities of the Indian market. Our platform allows us to be able to address not just direct B2C consumers, but also be able to service corporate travelers. And we think this unique proposition allows us to solve for a challenge that most companies face in emerging markets, which is the one of high customer acquisition cost. Ultimately, the corporate travel employees that we are servicing form the bulk of the consuming middle class of India. These are the guys who are highly educated. These are the guys with access to the internet, access to mobile devices, well-traveled. So by getting them onto our platform using business travel as the hook, we are then converting them also into leisure travelers and thereby acquiring customers at a much better cost of acquisition than any of our peers. As a consumer brand, we are very well recognized in the country. We won the National Tourism Award 4 times. This is given by the President of India. We won the Most Trusted Travel Brand a couple of times by the equivalent of the Wall Street Journal. We've got very high degree of direct traffic. 92 to 96% of our traffic is coming direct and organic. This is on account of the interplay between corporate and consumer that we've built. So this allows us to keep our customer acquisition cost low. High amount of traffic, 200 plus million people come to us every year, and our customer base is growing in the mid-teens. On the Yatra for Business side, Yatra for Business is the largest business travel management platform. We've got over 700 large corporate customers and about 35,000 SMEs. It's a comprehensive self-book platform which integrates deeply and seamlessly into organizations. And this creates a highly sticky proposition for us with our corporate customers. I'm just going to move a couple of slides just to give you a sense of the P&L. In terms of our own adjusted revenue in fiscal 19, while we were moving towards profitability, by March 2020, we had expected to be profitable, and in December 2019 we were actually profitable. COVID has impacted us negatively, but we think in the relatively near term we should be able to get back to profitability.
Awesome, Drew. Thank you so much for joining us. Again, we host a daily show here at Benzinga, and we get asked about your stock all the time. I mean, almost daily. So I know it's a popular one out there.
I'm glad to hear that. And
Awesome.
Thank you for having us.
Absolutely. All right, guys. So we're hopping from one hot market to another one. So we just did travel in India. Now we're going to esports. I mean, this is I think that the next up and coming sector. I personally am invested in the space, just like I was in cannabis several years ago. But let me stop blabbering on and cutting into their time. I wanted to introduce Michael Aiello. He is a managing partner at Century Business Consulting. Michael, I know I butchered your name. Could you, when you hop on the stream, could you clarify how to pronounce that for us?
Yeah, absolutely. Thanks, Luke. So it's Mike Aiello. And yeah, hi, everyone. My name is Mike Aiello, as I just mentioned. I'm the CEO and managing partner of Century, where we focus on accounting and advisory services for emerging growth companies and related industries. I would like to welcome you to our panel here today on esports and the changing game in 2020. 2020 has certainly been all about change, and we're going to cover how the esports industry has evolved in 2020. It is my pleasure to introduce you to the panelists here today, and I'll go around the room now. First, we have John Fazio, who is the CEO of Nerd Street Gamers. We have Jeff Cohen, who is the VP of Strategic Planning and Investor Relations at Esports Entertainment Group. And we have Conrad Wasalia, who is the CEO of ESE Entertainment. Guys, we have limited time here today, but I would ask for you guys to each please give a brief introduction on yourself and your company. And let's start with John first.
Hey, how's it going? John Fazio, CEO of Nerd Street Gamers. Nerd Street's an esports infrastructure company dedicated to replicating the same types of opportunities that traditional sports provide for hundreds of millions of people around the world for gamers. We do that by building a network of physical infrastructure, meaning training facilities and physical venues, and connecting that to the events and programming that allow to gamers to showcase their talent.
Great. And Jeff, how about you?
Thanks, Michael. Thanks for having me. I'm Jeff Cohen. I'm the VP of Strategy here at Esports Entertainment Group. We're a publicly listed esports entertainment gambling company, ticker is GMBL. We operate across a number of different areas in the esports ecosystem, but we're primarily involved in tournaments, venues, and all things gambling. Prior to joining EEG back in July, I was an analyst on the sell side at Stephens, where I covered the gaming and esports sectors.
Great. And Conrad, over to you.
Good morning, everyone. My name is Conrad Wasila. We recently listed on the TSX Venture Exchange in Toronto in August. ESE Entertainment is a diversified esports company specializing in esports infrastructure, specifically in technology and our gaming franchise. As it pertains to technology, we have our own proprietary online gaming platform to host tournaments. As it pertains to the gaming franchise, we have our own professional team. We host events and we have exclusive digital media rights as well for our gaming franchise.
Great, thanks guys. All right, so let's jump into it. You know, when I think about the esports industry in 2020, the first thing that comes to mind for me is the significant increase in awareness of the industry itself, followed by the rapid growth of its viewership and just the overall coverage as a whole. And in my opinion, that is what has led to the continued emergence of esports industry in 2020. Let's jump into it. Jeff, I'm going to go with you first here. What do you believe has led to the increased awareness, viewership, and just coverage as a whole in 2020?
Yeah, I mean, if we're talking about esports specifically, I think obviously sports being canceled, kind of led to esports being the only game in town for a certain period of time. That kind of led to an explosion of, I'll call it mainstreamization. Not sure if that's a word, but we saw esports being played on linear TV. You had the NBA get canceled. Some NBA superstars were streaming. Some do anyway, but you kind of had more kind of join the party. I think the esports leagues also did a really good job transitioning very quickly from physical into digital, which is obviously one of the beautiful things about esports is that it is a digital medium. So it was a fairly seamless transition. And then another important trend that I would just mention, more about gaming rather than esports, but something that's been happening for some time, but really got exacerbated during the pandemic was games becoming more like social platforms, places for people to hang out, connect with friends and family when we had to be social, or we still have to be socially distant. that obviously led to an explosion of engagement with gaming, which led to more monetization and then increased coverage by the media.
Great insights. And John, what are your thoughts on the increased awareness, viewership, coverage?
I think there's a lot of trends coming together here. Esports, as a word is less than a decade old, but competitive video gaming or the idea of playing video games competitively is something that's been around for 40 years now, maybe more than that. Really started in the arcades and developed through PC gaming in the 90s. And now we have this kind of confluence of various technologies like Twitch, the live streaming platform, which has really connected a whole ecosystem of people who are trying to create content with the people who are really interested in consuming it as natural gamers here, as well as a combination of things that are happening in the high school and college environments as well as at the professional level. So right around the same time in the past 10 years, really in the accelerated in the past 5 or 6, we saw game publishers invest heavily in their professional leagues with an idea of franchising and creating these massive media properties that they distribute similar to traditional sports. At the same time, you've had, I think it's something like almost 200 universities now pushing some form of varsity or club or scholarship esports program. You've got over 5,000 high schools looking to do the same. As those things are all starting to turn on, we're just now getting through our first cycles of students who grew up playing esports in middle school and high school, and collegiate athletes who competed for their college and esports, and kids and young adults who grew up watching professional esports on TV. It's all kind of came together at the same time right now. And then, as Jeff said, COVID hits, traditional sports turns off. What else is there? It was, the perfect storm for putting attention towards this, really exciting industry. But the thing, kind of the hidden story that's really important to make sure isn't lost here is the access issue that was really exacerbated in COVID. And we talk about an exciting industry. We talk about these really cool opportunities, but what we're really talking about is only available for this really kind of middle class or affluent buyer who can afford thousands of dollars worth of equipment and games and things like this. And there's a real need to connect to the consumer who doesn't have this access point, and that's what really will scale this industry. We saw in COVID upwards of 50% of various school districts in major cities across the country didn't have home internet, to participate in remote learning. So how are they going to think about participating in esports? If we want this to look like traditional sports, that part has to be solved.
Got it. Conrad, what are your thoughts on that? Again, the awareness, viewership, coverage, and the increase in 2020?
I think both gentlemen had some fantastic points, but I wanted to highlight, the crossover into other industries as well, specifically music. We did some activations during COVID with Columbia Records and Sony Music. You saw Travis Scott have live tournaments. This just really highlights the scale and the scope. It's not just pro athletes, it's musicians, music events, integrating that into the games, interaction with people globally for music, and just entertainment in general. I think esports has kind of taken a life of its own, and COVID just accelerated that. And now it's pro athletes, it's music. We've done events with FC Barcelona in Europe. I mean, it's just a massive, massive industry, and it's going to slowly cross over into every aspect of entertainment.
That's great. Absolutely. I'm going to shift it up a little bit, but John, I'm going to go back to you. You mentioned streaming a couple of times there. What are your thoughts on the future of streaming? How is that going to impact hardware usage and just the overall industry itself?
Yeah, I think it's a really interesting dynamic right now where, what was a monopoly for 10 years or so in Justin TV and now Twitch, which is, owned by Amazon, has been, I don't want to say disrupted, but at least met with, finally a competitive force from YouTube gaming. And we're finally starting to see some really interesting growth there. And, I think it'll be a future that's determined in a lot of ways by the distribution systems of the publishers and the event experiences more more so than the medium itself. And so, a publisher like Activision or Riot or Electronic Arts has really, immense power in the value of streaming platforms, because they can ultimately decide whether intellectual property is allowed to be distributed. And so, when you think about it in that way, in terms of, this kind of conference in Benzinga and thinking about, public markets and stock opportunities here, I think, looking at what the publishers themselves are saying about where they want to be streaming and where they're going to make their investments is really where you're going to see the future of this. Right now, Twitch is the dominant player and YouTube gaming's, on its heels. But the reality is that can move really, really fast in this current, climate if one of the publishers decides to make a new decision there. So, I think they hold most of the cards, and that's where you want to kind of keep your eyes. The platforms like Twitch and YouTube are likely to always be there as the content creation for that kind of, mass user group. However, the real numbers come from a top tier of professionally created content by the publishers. So, watching where they move will tell you where the dollars move.
Conrad, what are your thoughts on streaming in the future?
Yeah, I think that's very interesting. However, linear TV is still alive, and it's still very active in esports. I mean, you mentioned some of the gaming publishers. That's a very good point, but they've also shown significant trust in regions like Poland, for example, or Central Eastern Europe, where they've given exclusive licenses to companies like myself to be on national TV on some of the biggest media channels in all of Central Eastern Europe and Europe, with 20+ million views a year. This shows a lot of trust and definitely the need to enter in those markets. And there's platforms in those markets to distribute content and to really grow the industry, not just via Twitch or YouTube, but even with linear TV, and then even the US market globally. We also work with ESTV, where Amazon Fire, Samsung TV, Roku, and some of the bigger channels are also picking up esports. So it's really nice to see, and it's a really evenly spread push amongst the linear TV. So it's exciting.
Yeah, I think that's a great point. It's definitely kind of really evenly spread out, and certainly an exciting time. Jeff, what are your thoughts on this topic?
Yeah, I think John and Conrad did a good job. I don't have too much more to add. I think the streaming companies have done a really good job capturing the dedicated esports viewer. But to bring in new viewers, you do need more mainstream channels like linear TV to pick up these things as well. I always think about like my father. He's a sports fan, but he's not an esports fan. But if he was flipping around ESPN and he there was a FIFA game on there, he might get engaged. So I always think about that. Sometimes when esports are on linear TV, you go on Twitter and everyone's freaking out, like what is, why are video games on ESPN? We kind of have to break through that barrier in order to get this to really be in the mainstream. Like we talked about before, that did start happening a lot more during COVID. So hopefully that's a good, good first step.
Yeah, I totally agree there. And Conrad, I think you're absolutely right. Linear is like, a huge hidden value proposition right now. We even talk about, young kids, and we make this assumption that they're all on Twitch. But, I go over to my uncle's house and see my nephew sitting in front of a TV watching a cable top box still. So, there's still a mass amount of, this linear consumption. Our company, for one, creates a TV show called For the Win Philly, which is produced through NBC Sports Philly. It's a Nerd Street created TV show with the idea of it educating parents and young kids on the opportunities of esports that exist both inside the actual competitive frameworks and outside, career opportunities, educational opportunities, and things like that. Our first season actually ended up winning an Emmy. It was nominated for 2 and won an Emmy, and now has been picked up for its second and third season here.
That's awesome. That's great. Okay, guys, I'm going to switch it up here again on us. So, Conrad, I'm going to start with you this time. In 2020, with the pandemic, the world has certainly experienced a transition from in-person activity to the virtual environment. How, I know we touched on this a little bit already, but how has that impacted the esports industry? And also, secondarily, when do you think live events are coming back?
I mean, I think it obviously caught everybody by surprise. And to be quite frank, I think it made our company stronger. We became more nimble, and we started exploring more online-based activities, and really ramped up our technology aspect of our company, started hosting a lot of tournaments, and really started engaging more with the streaming, and continued to press with the linear TV side as well. But as it pertains to things coming back to normal, I mean, nobody has a crystal ball, but some exciting things have happened as of late. You know, there's smaller group gatherings, so there's boot camps or training sessions with esports teams and players. But realistically, I think live events would be late 2021, more realistically 2022, from what I see.
Yeah, I think there's been like as Conrad said, there's a little bit of a shift towards what we can do now, as opposed to the full-on live event experience. And we've already started to see a lot of that turn on, as we've gotten clarifications around what is and isn't safe. And, we know that, there are options for bubble environments that aren't the full NBA bubble experience. There's a way to do that scale back. For instance, as much as we want everybody playing on the same internet, same equipment in the same building, it's still better to say have all the teams together themselves, but maybe separate than everybody playing at home. And so, creating environments where teams can come in and never be with more than the 5 people they're with and can have their own kind of, quarantine status for that as a team, and play in the same building or on the same equipment, but never actually see the rest of the teams or come within, or stay socially distanced there. Those are options now that we're seeing to turn on. So I think over the next few months, we're going to start to see teams come in for, we've already seen studios start to come back. The next step will be the teams start to come back. And I think we're a ways off from the spectators actually coming in and competing here. There's 2 types of live experiences. There's the spectator-driven live experience, and then there's the competitor-driven live experience. The competitor-driven live experience, like a lot of the tournaments we run, we might have 3,000 people come and 80% are competing and only 20% are there to spectate because it's more of an amateur-driven, tournament series. With those, those are kind of stuck in the spectator bucket because of the size of them. And so we've had to really evolve and come up with ways to do smaller events and do them periodically and have qualifiers. And, these are things that all of the TOs are now going to have to figure out. But, in terms of live events in a medium scale turning back on, we're just now starting to see bookings for Q3 and Q4 now that the vaccine news was, announced. And so, I do expect to see live events really start to come back online in that Q3 here in America. It looks like America and EU are very much tied together and kind of making decisions they're same, whereas Asia's turning back on way sooner. So, that's kind of our prediction as far as the large stadium events. Who knows? It could be 2022 before we see them again. I'm not really sure.
Got it. And I guess what I'm hearing here from you guys is really looking towards a hybrid environment where you maybe can get the teams together, and that bubble type environment where you have the NBA. So at least that's positive. We're silver lining here and looking towards getting back together for some fun soon. Jeff, what are your thoughts on this topic?
Yeah, I agree with the guys. Again, I definitely don't want to be the one to try to predict the reopening. It does seem like vaccines are on the way, which is great. I will predict that, regardless of when things reopen, the industry will come back stronger. The pandemic has caused some companies with bad business models to kind of get weeded out. I think the ones that remain will be the stronger ones. And, importantly, all of what we've talked about so far, the pandemic has really brought new eyeballs to gaming and esports. Fans of traditional sports who never considered themselves to be gamers, now participating in gaming, participating in esports, seeing it on mainstream TV. The question now is, can we keep those players, and can we figure out a way to monetize them? And, I'm really bullish on the industry being able to figure that out.
Great. Okay, guys. So we're actually getting close on time here. So I want to give us all time for closing remarks. So let's go around the room and like each of you to give any closing remarks, and also make sure you provide where people can find more information about you and your company. Let's start with Jeff. Where do you want to start?
Sorry, where people can find me or the company?
Yes.
Best place to find me is just LinkedIn, Jeff Cohen. I pretty much respond to all messages. Happy to talk to anyone who's interested in the space. And best way to find our company is esportsentertainmentgroup.com. Like I mentioned, we're publicly listed on the NASDAQ, ticker GMBL. Go buy some stock. I run investor relations. Email me, jeff@esportsentertainmentgroup.com. Happy to answer any questions about either esports in general or our company, obviously.
Great. And John, over to you. Any closing remarks? And also, where can people find more about you and your company?
Sure. You can find me on Twitter at JFaz, JFAZ. You can find our company, nerdstreetgamers.com. We are a company that's venture backed. Comcast and Five Below public companies back us. Us and Five Below have a really interesting partnership that allows us to scale our esports training facilities across the country rapidly. Five Below is a really interesting and innovative retailer that has excess space that we're able to take advantage of, building these 2,000 to 3,000 square foot esports training facilities within. When we build those facilities, they're their own standalone facilities. They have their own entrance, and they have kind of what we call the portal into Five Below, where you can share in that Five Below retail experience while still being, in a Nerd Street experienced, esports training facility, and not breaking that environment. And so when we open those, we're able to connect with local high schools, local community centers, and Parks and Rec, and Boys and Girls Clubs, and those types of activations. We're really excited about continuing that expansion here. I think that what the industry needs now is the backfill of, the infrastructure. We talk a lot about the excitement. We talk a lot about professional leagues. We talk a lot about, the 6 or 7 massive, Goliath publicly traded, technology and publisher companies that have so far controlled this ecosystem. Now we've got a rush of, 99,000 or 100,000 high schools in America that are all going to want to turn on some form of esports program. We have thousands of universities here and thousands across the world that are going to want to turn this on. As that starts building out, as we start going through that cycle of students who've, take it for granted that they've competed for their school for esports, that next generation of consumer here is really going to create an exponential growth in this market, and it'll be really exciting. The sleepers, as far as picking and being a stock picker or an investor here, looking at the infrastructures where the story comes. It's great to own publishers and game companies, especially now, and if you've done very well for yourself. But if you're looking for that real cutting edge alpha, it's going to come from finding the infrastructure companies that really lay the railroad tracks for the next generation.
Thanks, John. And Conrad, over to you. Closing remarks, thoughts, and where can we find more about you and your company?
Yeah, the best way to find me, guys, is jump on LinkedIn, Conrad Wasela. As it pertains to the company, you could find us on the Toronto Stock Exchange, TSXV, symbol ESE, and on the OTC, ENTEF. And as Jeff mentioned, feel free to go buy some stocks. As it pertains to our website, it's ese.gg. More information on there as well. And I would like to highlight kind of what John mentioned. We're hyper focused on esports infrastructure. We have a significant competitive advantage. We operate out of Central Eastern Europe. We have a big team, low cost basis, and we're expanding fast. The infrastructure and digital media rights working directly with the gaming publishers, and we have the capability to scale fast. And we're really excited and believe that infrastructure is really the play here as it pertains to esports. And I think we're right in the thick of things in Europe and in Asia, and coming into North America fast. So just really fired up. Make sure you follow the story. Please follow our press releases, news releases. We always have exciting stuff coming down the pipeline.
Great. Thanks, guys. And thanks, everybody. Once again, my name is Mike Aiello, and you can find more information about Sentry at sentryconsulting.com. You can, of course, look me up at Michael Aiello on LinkedIn as well. And again, thank you to everyone at Benzinga and everyone tuning in here today. And I guess seeing the notes here, turning it back over here to Elliot.
Hey, everybody. Awesome job. Incredible panel. Super excited to be involved in the esports industry moving forward. But Mike, Conrad, Jeff, John, I think we'll see all of you at separate times. If not, thanks again for being here, and be well. And we'll talk to you all soon.
Thank you.
Great.
Thanks
for having us.
Good luck with everything, guys.
Thanks so much. Appreciate y'all. All right, everybody. The YouTube chat is going absolutely crazy for our next company. It will be a couple minutes before they hop on. We will have Alf Poor from Ideonomics to present. We will get him on shortly. I do want to mention that there will be giveaways from Luke. He will be giving away a lifetime subscription to Benzinga Pro, which for me as a new investor, I would keel over for. I'm a big fan in our news. I get a lot of my confident investing news from Benzinga, and very, very hopeful that whoever gets that definitely takes advantage of it. All right, I think we're going to be moving him over shortly. Another thing I do want to mention, we will have an electric vehicle panel later today at 2:35. Alfpour will also be on that. He will be alongside Arcmoto, Aero, I believe Electric Mechanica. They will be there. Again, this is NASDAQ listed IDEX. Fantastic. Do we have Alf yet, Shelby, or are we waiting just a hair? It looks like we'll be getting him back shortly. All right. Again, looking at some of the stocks. Oh, we are moving him over. But again, just to point out, NASDAQ listed IDEX. Definitely check out the esports presenters that were just passed. They are some of the leaders in the space. Alf, I see ya. If you want to turn your video and camera on for us there. Can you hear me, sir?
Yes, I hear you. Got a little bit. Yeah, I hear you. Got a little bit of lag. Just give me a second or two.
Oh, no worries. No worries. Take your time. All right, fantastic. So we are going to get him up and running here shortly. I know the YouTubers, retail investors, the institutional investors are all really excited to hear this presentation. We'll definitely get that to you shortly. I will say, definitely check out some of our other content. Obviously, a whole other track today. Watch it later. We're cooler. But we also have a daily show. Hot Stocks Luke and Jason Raznick every midday, I think at noon, go live on LinkedIn to pick some awesome stocks. We talk about cannabis every Thursday from 4 to 5. Alf, we hear you, sir, or we did.
Nope, you hear me, Elliot, I think.
Oh, there you are.
Yes.
What's going on, Homer?
Thanks. What I'll say is from our daily show and from this chat right now that I'm watching on YouTube, I mean, I've never seen so much excitement for a stock. I mean, people are fired up for this thing. I mean, this is going to be an awesome presentation. Twitter's going crazy. It's amazing.
Yeah, I'm very excited. I would ask you why, but we're actually about to hear it from Alf, so I'm very excited about that. But can you give us a little more insight into the other content that's available while we're getting Alf situated here?
Yeah. So if you guys like some of the programming that we do today, I'll give you what our regular show schedule is. From 8 to 9 a.m., we're covering pre-market trading. We've got 3 veteran traders on a stream at once. They're trading. They're talking about what they're trading. And I see Alf popping on. So maybe that's my cue to go.
Hey, Alf, just got to turn your mic on there. Nice background. That's nice. It makes me want to be there. We got to get your mic turned on there, sir.
Yep, I think you're on mute, Alf.
Yeah, guys, no, I'm here. Just shutting down a few applications because the computer was running a bit slow. So
You're preaching to the choir, man. It's all about shutting down tabs. I got like 500 tabs open normally. But if you want to share your screen, if you're looking to do that, feel free. You should have access to it. But we're going to let you dive right in because our investors are clamoring.
Yeah, so let me just share my screen with you quickly, guys. So let me jump in. Get this thing in presentation mode. Let's get this show on the road. Okay, good morning to everyone joining today. We appreciate you spending the time. As our host Elliot is saying, there's a lot of activity on Twitter, a lot of people tuning in. For those of you that tuning in to hear about the company for the first time, we are Ideonomics. We're listed on the NASDAQ under the ticker symbol IDEX. And I'm going to take you through a brief overview of the company and some of our current activities. Ideonomics is a US company. We're headquartered in New York, but we have a global footprint. We have 2 primary divisions within the company. First one is our flagship, which is our mobile energy group, and that does all of our things EV. Okay, I'm going to be talking much more about that today. This is an EV-focused panel. I'm on this afternoon as well. In addition, our second division is called Ideonomics Capital. again, we're looking at disruptive technologies, whether it's electric vehicles, or what else it may be. And there's a significant convergence between Ideanomics Capital and MEG coming up in the future. And the reason for that is the automotive industry relies heavily on financing, whether it's passenger cars where you go out and you get a lease or you get a low rate loan, or it's fleet commercial operators where we're primarily interested. Somebody needs to finance these. These are big ticket items. So it'll start to be more obvious to you some of the asset investments we have. And in 2021, you'll be hearing a lot more from us on the finance and leasing side here in North America. Talk to you a little bit about our subsidiaries. The two primary ones, obviously, our Mobile Energy Group. Mobile Energy Group is a service provider. We have what we've developed, which is called our S2F2C business model, which is sales to financing to charging. Really what we're doing here is we're providing all the tools that a commercial fleet operator needs to get into a vehicle. MEG will sell anybody's vehicles to fulfill the needs of the commercial fleet operator. Then we have our two brand products. Okay, the first is Medici Motorworks, which is coming to the US shores very soon. Okay, that's going to be our brand for our European and our North American, starting in North America, activities. I'll talk more about Medici in a moment, but there's basically going to be a range of vehicles from heavy trucks and buses through to pickups and specialty vehicles. Tree Electric is our brand in South Asia. That's a Malaysia-based EV company that we own 51% of. Okay, this is a national brand that we're hoping to build. We have the King of Malaysia as one of the investors, and they're primarily in the two-wheeled space, so mopeds and motorbikes. That's the mainstay of transportation in that part of the world. Countries like Indonesia, which is close to Malaysia, have more than 150 million motorbikes on the road. So two wheels primarily from Tree Electric. We will be selling under the Tree Electric brand through Mega Medici in the US as well. So you can expect to see Tree Electric motorbikes and mopeds on our shores fairly soon. Moving over into our fintech side, really got three core businesses there. We've got Timios, which is a large title and real estate closing firm that we're recently going through the acquisition for. Acquisition's almost done. We're just waiting for the regulatory approvals from several states' departments of insurance. We own Dbot. Dbot is an ATS. There's some very interesting moves being made in the financial markets. We're starting to look at blockchain as the technology matures. We'll have more updates on that for you very shortly. There's some exciting conversations there. And Intelligenta is our AI engine. That gives us a lot of underpinnings, whether we're working through the EV group or the fintech group. AI and data are obviously a good thing to help drive businesses. As you can see, we've got some old media assets. The company was a media company prior to 2018 that we're looking to divest. And we've also got some very interesting investments, including the recent one into the EV tractor company based in Northern California called Solectrac. As I mentioned at the top of this presentation, we are an American company with a global footprint. We do have a large presence in China, but we're very much based in New York, and the majority of the C-suite of the company reside in New York, where the corporate headquarters are. In the US, we have primarily two brands, Medici Motorworks and Solectrac that I've just mentioned. Medici, as I said, it's going to be bringing an initial 6 or 7 different types of vehicles. We say 7 because there's some additional order interest we have for a particular type of a specialty vehicle. But everything from delivery vehicles, like you see the likes of Amazon, UPS, FedEx, UPS, others, US Postal Service using, through to heavy trucks. Solectrac is in the tractor space. They're doing primarily the smaller HP tractors at this point, but we'll be looking to help them develop that business as we move forward. Our Mobile Energy Global Group, we will bring the service side of MEG to the US. As you know, in China, we've been setting up the framework so that we can finally get big ticket purchases finalized and financed for these commercial fleet operators. And obviously in ASEAN, as we mentioned, we've got the Tree Electric acquisition as well. We do have a group in Europe. We will be expanding into Europe next year with the establishment of a sales team that will be helping us sell our Medici, Solectrac, and Tree Electric brands, and also using our MEG for the services side of it. But we do also have a software development group. Just so you understand, software development group currently helping us with a lot of internal tools. There's a lot of back office goes into connecting the orders that are placed for Medici, Solectrac, Tree Electric, and other manufacturers, and getting them through the rebate, the contracting, the financing process. We've built a back-end system to help support our sales teams to do that, and we'll be rolling that out globally. Currently, it's just live in China. Okay, so let's talk to you a little bit more about the types of vehicles that we're in. We are not in the passenger car space. We are not a Tesla. We are not a NIO. We are in the commercial fleet operator space. We are in that space because we believe the most interesting opportunity in EV is not the vehicles. The vehicles are sexy. They look modern. They look great. You know, they come with autonomous driving, a lot of them. But really, the most interesting part of the EV industry for Ideanomics is the transition in energy demand. Okay, there is going to be a significant transformation from gasoline and diesel over to electrical consumption. We would like to play an important role in the charging, battery management space, because we believe that's where the largest long-term recurring revenues will come from. And we're focusing on 4 key segments. Okay, trucks and specialty vehicles. At the moment, battery EV suits everything in a shorter mileage use scenario. So we're talking about construction, ports, mining, steel mills, airports. Those types of areas operate heavy machine vehicles in closed circuit environments or short trip environments. We believe battery EV is perfect for those. We've developed a very robust pipeline in that area, as many of you who follow the company know. Next one for us is the city bus and the tour bus sector. This is a very important sector to us. We'll be looking to get into the school bus sector in Europe and in North America as well. Delivery vehicles, obviously that one's got a huge market. You're seeing the growth, particularly with COVID, experienced by FedEx, by UPS, by Amazon, by all the guys who work in the local distance. And that's a perfect sweet spot for battery EV. Most of those vehicles only do 30 to 40 miles a day. So that's a much simpler proposition for many of the commercial fleet operators to switch immediately to BEV. And the last part, which is really the use of kind of passenger cars, and we have some really important news coming up in this segment shortly, is in the taxi and ride sharing space. These are primarily adaptive passenger cars, or in the ride sharing space, they are just passenger cars. And we'll be working, as we have done in China, with taxi fleet operators, local taxi commissions here in the US, 2021 and going forward, on getting their, the likes of Uber drivers, everybody else into EV vehicles, which we think are more economical, obviously better for the environment, and hopefully more profitable in the taxi and ride sharing space. Talk to you a little bit about the S to F to C model. There's 2 ways that we make our money when we sell and finance vehicles. The first one is we work as a point of procurement for the commercial fleet operators. So we help them buy their trucks, their buses, their taxis, etc. And we earn what we call a spread, which is basically we buy the vehicles for X, we sell them for Y, the difference is our profit. You can see on the right-hand side, for the lower ticket size taxis, we can earn something between 2 to 4% per vehicle, and then going up through into logistical vans and buses and the trucks, obviously we start to get in much higher numbers. Similarly with the financing, we get something what some people will call a placement fee or a finder's fee or a commission, again somewhere in the 0.5% to 1% region. These are large ticket orders that we do, and the lease financing companies want to win our business, so they typically pay a commission when the deals are closed. That leads us on to what I believe is the most important medium to long-term part of this, which is the energy sales. Selling everything from battery charging systems to charging piles, as they're called, which is the charging apparatus, through to selling people wholesale electricity. We think that this is the biggest segment of the market. Folks like Tesla understand this. That's why he has a closed circuit network. That's why Tesla have been buying things like electricity sales and metering licenses in places like Germany and Australia. We think this is one of the most significant areas. So we're going to be selling to everybody involved in the connected vehicle space, as well as the EV charging. Some of you have heard in China, we're beginning programs with some of the 5G tower operators. May be confusing to some to understand what the connection there is. Well, EVs come fully loaded with internet connectivity. So there's a natural extension there when city bus operators, fleet operators, taxi operators, they want to get real-time data where their vehicles are, route optimization, traffic management, maintenance and vehicle alerts, all those types of things can be fed back in. And 4G and 5G is the only way really you can transmit that data in real time. So interesting segment for us that's beginning to open up as well. Let's talk about something that all of you want to know a lot about. We are in process to bring to our shores the first 6 types of the vehicles. They'll come in stages. Different vehicles get different classifications. When you're bringing in EV, there are waivers and other things you need to get from the EPA because these are zero emission vehicles. Some vehicle segments move faster than others, but regardless to say, we're going to be able to sell these vehicles in 2021 in the US and Canada. We're going to be bringing our battery EV truck, 2 types of buses, a logistical delivery van, an SUV pickup, and a couple of different types of specialty vehicles. And as I mentioned earlier, we'll also be selling through Medici, the Treelectric branded mopeds and motorbikes as well. A lot of activity taking place there. A lot of new staff have recently come on board, helping us with everything from marketing through the supply chain, through the logistics. So obviously a major operation to set that up, but we're very proud of what we're doing in the Medici segment, and we're expecting big things from that group in 2021. Talk a little bit about Tree. As I mentioned, they're going to be coming over to us. Tree's been heavily impacted by COVID-19. We call Treelectric Tree because basically the borders have been shut down in Malaysia. It's been very difficult to import and export, get vehicle parts in for assembly. Those are starting to open up now. We've just had some interesting discussions with the customs and excise folks around exemption for moving the vehicles in and out of Malaysia. And they're beginning to deliver now. We just placed a major order for more than 1,000 units that will be put into the Thailand and Indonesia markets starting in Q1 of next year. As you know, to help us with the growth there, we're beginning to hire people with backgrounds from the automotive industry. We were lucky enough to get the attention of some significant talent in the region, which is our new CFO, Richard Teo. He comes from leading the Volkswagen Group from a financial side of things based out of Malaysia for that part of the world. So we've got somebody with very rich experience. He's experienced in supply chain. He's experienced in construction of assembly plants, and he's experienced obviously in all aspects of automotive. So to bring someone with Richard's experience in just at the right time, you can expect to see more hires of those caliber across the group. Those resources are scarce, but as we have these conversations with these individuals, they're very excited by the messaging that Ideanomics has, that Medici has, that Treelectric has, that Meg has, as a rounded kind of solution that helps commercial fleet operators from A to Z. And that's why we're able to attract the talent we do. As you know, we acquired some land earlier in the year, and we're going to be building on that, our assembly plants to help them with their export operations throughout the region. Brings us over to Solectrac. We made an investment. We own around 24% right now of this company. This is a really interesting company with a very dynamic leader. He lives, breathes, eats zero emissions and clean tech. He's been in the space since the late 70s. And he's come up with a range of tractors that are really interesting at an affordable price point that are good for the smaller markets. And we're working with supply chain OEM partners in India and China to bring the larger HP tractors to market, both here and in Europe. Talk a little bit about our Q4 activities. We're very pleased with the sales development that's happening at our offices in Qingdao and Hangzhou. Zhujian has built us an amazing team over there, and the pipeline is growing quickly. And I'm pleased to say most of the new hires that we make hit the ground running and immediately bring leads to the table. So very pleased with the growth in the sales pipeline there. As I mentioned, Treelectric, just placed its order for more than 1,000 units that'll be going into Indonesia and Thailand markets. Also working with a lot of folks in terms of getting charging networks and other things in place in Malaysia and that part of the world. And as I mentioned in quite a lot of detail here, obviously Medici Motorworks, getting the vehicles in under marketing exemption is the short-term goal. So we can begin to show the types of vehicles that we're going to be working with. In the meantime, the homologation process, difficult word to say, that means the certification for road use in the US and Canada. So that's taking place. That'll take a few months to get fully in place, but we can begin showing these demonstration vehicles to our partners in an off-road environment while we wait for that homologation process to complete. Take you a little bit through, can't talk about Q4 yet, haven't finished the year. But basically what you're seeing from us at this point is the company's growing, quarter over quarter growth for the recent sequential quarters. We expect that to continue. We've started putting out monthly unit delivery updates to the market. This gives you an idea of the activity that's going on within the group. We put those out around the middle of each month. Revenues are obviously going up compared to quarter over quarter as well as previous quarter of last year. We're keeping an eye on our costs. We want to grow profitably as we start to mature the business. We've reduced about $1.6 million in annual operating costs so far this year. We have an active M&A and investment pipeline. A lot of players in the space are out there talking to people. That spurs us to talk to people as well. We don't want to get caught sitting on our hands and find some of the best and brightest technology and personnel have been snapped up while we were sleeping. So, you'll see a lot of activity from us on an ongoing basis. And obviously, as you know, we've raised money recently from the summer through to more recently out of the market. So we have a very strong cash position with more than 150 million on the balance sheet at this time. Talk a little bit about where we are, where we're going. We're seeing continued growth. As I said previously, very, very pleased with the development of the pipeline. We're beginning to garner interest out of Europe as well. Our pipeline's beginning to build in the US and obviously in China and Malaysia and the ASEAN region, it's developing quite quickly. We closed the Timios acquisition. That brings us in strong revenue growth in the US while we wait for the other activities to ramp up on the Medici side in 2021. But we're seeing some very favorable macroeconomic conditions which give us confidence moving forward.
Hey, Alf, I think we're going to have to call it there, my friend.
Okay, so I'm about wrapped up. I'll just show you guys that obviously you can see the growth we're seeing in the unit deliveries. We're expecting that to continue. There's a nice view of all the people running the business at this time. These are the guys making the decisions. And that's the thank you very much page.
Oh, man, I cut you off 2 slides too soon. I'm sorry.
No problem at all.
But, yeah, we're thrilled to have you. I mean, you have some raving fans. I just, pointing that out. Obviously, you all are doing something right. So we're very happy to have you. We look forward to seeing you back in 4.5 hours for the panel. So looking forward to it, sir.
Great stuff. There's some great questions coming out of the moderator. Be some really interesting learnings for the audience. So I look forward to it.
Perfect. Thanks again, Alf.
Thanks, Elliot.
Right.
Thank you very much.
Be well. All right, y'all. We're going to keep it moving. We are moving right along to a wonderful Chinese data play out of China, DataC. Henry Sun, the director of capital. They are listed on NASDAQ at DTSS. Please like and subscribe the channel. Incredible lineup for you today. You're going to see Alf later, so you might as well stick around and watch some of these awesome presentations. And I think some of these companies are going to surprise you at how very cool they are. Henry, can you hear me, sir?
Yes, very clearly.
Perfect, Henry. Glad to have you. If you want to get your video on for me there so we can see you.
I'm afraid there's a camera. Yeah, camera doesn't work properly.
All right, no worries, no worries.
My screen. Yeah, my screen.
All right, you're welcome to share your screen there. All right, Henry, perfect. We see your screen. We're going to let you hop right in.
Okay, thank you. Thank you, sir. All right. Good evening from Beijing and good morning to everyone there in US. This is Henry Sun from This Inc. Thank you all. I would like to spend about 20 minutes providing an overview on what DataC does, explain the market opportunities with our industry, discuss our diversified business modules. Slide 2 is a safe harbor statement. Please read at your leisure. DeadSea is an emerging technology company based in China, engaged in providing smart security solutions and developing education-related technologies. We specialize in using our proprietary technologies and intellectual property to help make China a safe place. As you can see, the multitude of patents and copyrights we own, in addition to several certifications and qualifications we have received, all speak for themselves. Here are some key equity status with our figures in US dollars. You can see DeadSea has been trading on the Nasdaq Capital Market and the symbol of DTSS since December 2018. And we currently have around 21 million shares outstanding with a market cap approximately 51 million US dollars and average 30-day trading volume approximately 120,000 shares. Well, the smart security industry has witnessed significant tailwinds in the past few years, both domestically here in China and globally. More specifically, as our industry gathers more attention, the demand within certain segments such as schools, sensitive areas, and public communities continues to grow. I'd like to point out that the estimated potential demand for domestic security projects from 7 billion to 72.5 billion US dollars worth of products, while in 2019, China's smart city related investment was approximately 22.8 billion domestically and 1.1 trillion globally. As I mentioned in the previous slide, our industry has been propelled by several tailwinds, which has provided a significant number of market opportunities. A key market we are currently focusing on is in smart cities. This particular segment reached about 1.1 trillion US dollar globally last year. We are making sure that our R&D team are constantly innovated and developing the necessary products to meet consumer demand. In conjunction with the growing public security concerns, we have noticed tremendous increased opportunities within the intellectual security space. And additionally, we continue to see the increased commitment from the Chinese government as safety become more of a priority concern with the country. We emphasize adaptability here at DeadSea. As you can see, the demand and the market opportunity for security solutions has been on the rise, and we intend to capitalize on the opportunity. As you can see, the numbers speak for themselves. The market size of China's security industry has increased by 104% from 45.8 billion in 2012 to 94.5 billion in 2018, and is estimated to reach 116.1 billion this year. Additionally, the market size of China intelligent security solutions is forecasted to reach 14 billion this year and then more than 42 billion next year. Let's move on to our next area of interest. I would like to discuss our core technologies, which are divided into visual and non-visual perception algorithms. To begin, our visual perception algorithm features the use of thermal posture, visible light, and infrared night vision images, aiming to improve recognition accuracy and danger predictions. And secondly, our non-visual perception algorithm utilizes the algorithm to process sounds for behavioral predictions and decision-making, which includes audio message-based predictive perception algorithm, ambient sound-based incident detecting method, system perception algorithm, and multi-channel database intelligent security monitoring algorithm, something like that. And finally, our visual and non-visual perception and linkage technology combines both algorithms and optimizes both visual and non-visual data. These technology features are a big reason for the success we have received thus far. I will take about one of the two major platforms, of our core intellectual property, which we produce and implement ourselves. I'll start with a big data security platform. This platform analyzes the videos and the images that aggregate through the use of our proprietary technology. And next, I'd like to share our second major platform is our smart 3D, three-dimension security platform, which is capable of building a security system through the use of visual and non-visual algorithms, which I had mentioned before. And this platform, coupled with our hardware products such as face recognition cameras, infrared emissions, and smoke detectors, gives the users the ability to build an intelligent 3D security system. As a result, we have developed 3 different security systems as our major products to meet the rising demand of the clients. You can see for the public community, safe campus, and sensitive areas. So the first core products offering I would like to talk about is the safe campus security system, which offers the targeted campus security solutions for kindergartens, private schools, middle schools, high schools, and colleges. Our system enhances safety measures and monitors the security throughout the ground of the campus. Based on visual and non-visual algorithms and data perception, this system leverages our big data security platform and smart 3D security platform, and had been used for personal identifications, alarm received, and response management, something like that to keep the campus safety. More specifically, the safe campus security system effectively identifies people passing through the campus and prevents blacklisted individuals and strangers from infiltrating the premise of a school campus within 1 second. Second, the next product offering I'd like to talk about is the public community securities, which similar to the safe campus security system, leverage our big data security platform and smart 3D security platform to improve public security. More specifically, these products offer functions such as video surveillance, property management, community management, and vehicle analysis, which comprehensively increase safety and minimize the risk of crime. Additionally, by being able to monitor the foot traffic of individuals coming in and out of a designated area, we are able to even mitigate hazardous risk. Finally, our last product offering that is still being beta tested and will be in the market available in 2021 is the sensitive area security system. This system is currently being developed for the purpose of ensuring the personal safety of tourists, strengthening the management process of sensitive areas, and to help to reduce the labor cost. This is all featured through the key features such as electronic inspection, passenger flow analysis, and to collect, visualize the information through integration with the geographic information system. Okay, let's move on to our next area of interest. Another first to our products list I would like to share is our image technology. As you can see, there are numerous high-tech functions and applications that benefit the users. As I mentioned before, in light of a global pandemic, we have leveraged our 2 platforms and have developed an additional system called Epidemic Prevention and Control System. The sole purpose of this system is to monitor public healthcare threats and pandemics for our users, which include but are not limited to the K-12 schools and the public securities. The system includes a database management platform system and front-end equipment, which include features such as 7-inch feature recognition, temperature management terminals, and security turnstiles. Furthermore, the system has 3 core basic functions: non-contact and accurate temperature measurement, mask recognition, and face comparison. The epidemic prevention control system is truly the testament to our R&D team's ability to adopt and innovate our technology into a robust and pertinent solution. Our epidemic system integrates hardware devices and enhances those hardware devices to more efficiently and accurately acquiring the data. From there, our platform will consolidate the data and then analyze the data to show the health conditions of target individuals and areas. And I have to mention, the temperature measurement is based on the thermal imaging technology and feature higher accuracy, which is positive and negative 0.10 degree I'm talking about. And now I'd like to share a bit about a significant piece of technology our team has developed is the smart thermometer. Our surveillance systems, thermal cameras, and the smart thermometers are able to measure the temperature of 16 objects within 0.03 seconds. That is 500 times more efficient than the traditional and the measurement manual temperature measurements method, and can be done with absolutely no contact. Our epidemic system can target a variety of application scenarios, which include multiple areas throughout a school campus, such as entrances, libraries, cafeterias, and dormitory entrances, and throughout high-field traffic areas in the public community. I'd like to share an example of one of our projects at the city of Handan, Hebei province, where we provide our products and services to 2 middle schools, approximately 3,000 students and teachers. Our system was able to efficiently record class attendances, measure the body temperature of each teachers and students, and provide the parents with the information such as general school announcements, notification of upcoming tests or homework assignments, something like that, by mobile phones. Let's moving on. I'm proud to share that recent, from August to November, DataC was able to sign agreements with 11 institutions, including 4 gas stations in Guangdong and the Fujian province here in China, to provide big data value-added services, such as big data smart information software system and hardware utilizations, payments, and interface maintenance. Again, with this new normal and domestic landscape that we are living in, our smart system helps retailers utilize big data and analytical and facial recognition technology to leverage physical recognition technology to charge the customer at the point of sale. As a result, the company estimated its earning potential to be approximately $148,000 on an annual basis, and the term of some of the service agreements is 5 years long.
Hey, Henry, we need to wrap up here. Do you want to leave us with one final thought?
Okay, let's jump to the final. All right, there's the 4 key pilots that we are looking forward to tracking against. Never mind. To recap, here are some of the key points I would like to for you to take away from presentation. DataC is a leading smart security provider in China, and that benefits from a massive total addressable market and some significant tailwinds. As I mentioned, we have diversified customer base leading proprietary technology, one of the most comprehensive product suites in the industry. and innovative R&D team with the experienced management team at the helm. So yeah, that concludes the formal presentation. Thank you. Thank you.
Very cool, Henry. Smart thermometer is really cool. Very impressed with that. Yeah, very much looking forward to seeing more of Day to See. Henry, thanks again. Be well, stay healthy, and hopefully Beijing is nice and sunny tomorrow.
Yeah,
I guess tomorrow because it's nice.
Thank you. Thank you.
Thanks again, my friend. All right, we're gonna move right along. Thanks again to Henry. That's NASDAQ DTSS. We're heading up to the co-founder, CEO, and chairman of Tonix Pharmaceuticals, Seth Lederman. All right, Seth. There he is. He popped right in. How are you, sir?
Great. Thank you for having me.
Absolutely. We're going to let you go right to it, sir.
Thanks. Is it projecting okay, Elliot?
Perfect.
Okay, fantastic. Well, thank you all for coming to watch this presentation on Tonix. Tonix is a public company, so here's our standard safe harbor statement. I'll be making forward-looking statements. And I'm Seth Lederman, CEO of Tonix. We're a clinical stage biopharmaceutical company, and we have two main areas we work on, central nervous system and immunology. And I'm going to be taking you through the lead programs in our CNS portfolio and our immunology portfolio today. I don't have time to tell you more about the pipeline, but we've had very exciting recent news in both these programs. The first is TNX-102SL for fibromyalgia, that's shown in yellow here. And we are now mid-phase 3. We just announced on Monday that we had positive results in a pivotal phase 3 study for fibromyalgia. So we are halfway home and expect to be able to submit a NDA in 2022. Then in our immunology pipeline, the lead program is our COVID-19 vaccine, TNX-1800, and I'll tell you more about that as we go along. So 102SL is a reformulation of cyclobenzaprine. It's a sublingual tablet, goes into the tongue, is rapidly absorbed, and delivers cyclobenzaprine across the mucosal surface directly into the bloodstream. It bypasses the hepatic metabolism, and basically it was designed to increase the amount of cyclobenzaprine in the brain during sleep, because the proposed mechanism of action of our drug is to improve sleep quality. Fibromyalgia is a chronic pain condition. It affects mostly women. There are about 7 million Americans affected by this. And we believe that improved sleep quality can improve fibromyalgia symptoms. Basically, people feel pain all over their bodies. And we think of pain as the body's check engine light. So the metaphor on the left about a check engine light is that if you see the check engine light go on in your car, it either means that there's something wrong with the engine or there's something wrong with the check engine light. So in fibromyalgia, when people experience pain, there's something wrong in the sensor in their brain that signals pain. So here's a schematic of the RELIEF study. This is the study we just reported top line from on Monday. It was about 500 people, double-blind, randomized, placebo-controlled study over 14 weeks. And here are the top line results. As you can see on the primary endpoint, we had P equals 0.01. So a statistically significant hit or win on our primary endpoint. Another way to analyze the pain data is the 30% responder analysis, and we were also statistically significant on that at P.006. Now, we had a number of key secondary efficacy endpoints that are fibromyalgia syndrome related. FIQR, that means Fibromyalgia Impact Questionnaire symptom domain, FIQR function domain, PROMIS fatigue, daily sleep diary, and PROMIS sleep disturbance. And as you can see, all of these were P less than 0.05. So we're very encouraged by these results. It was well tolerated. As expected, the most common side effect was some tongue numbness or transient taste experiences in the mouth. And it's related to the fact that this is a sublingual medicine, but they're transient, episodic, and short-lived. In terms of the overall safety profile, again, we've done a number of studies in this drug, and it was very well tolerated, and we think presents a favorable risk reward for people with fibromyalgia. So this is our second phase 3 study called the Rally study, and we've been enrolling this in September. So this is pretty much the same design as the Relief study that was just statistically significant. So we have a good amount of optimism about the Rally study. Fibromyalgia is a very active area. There are two drugs that were blockbusters in their day, Lyrica and Cymbalta. They're now generic. And Savella is still being marketed, but hasn't been promoted for some time. We have strong intellectual property protection on 102SL. Shown here are two families of patents. But you can see these are composition of matter patents, which is interesting because this is a reformulated version of cyclobenzaprine. But the way that the formulation is done is designed to optimize transmucosal absorption, so covered by a number of US patents. So next steps, we expect the results from the currently enrolling phase 3 study to be available in the second half of 2021. And following the results of that, assuming they're positive, we expect to be able to submit an NDA in 2022. We already have completed the long-term safety and have a robust and stable GMP manufacturing process. Now I'm going to switch to, well, there are many other indications for 102SL. We have active INDs in PTSD, agitation and Alzheimer's, and also alcoholism. Now I'm turning to the COVID-19 vaccine. This utilizes Tonix's unique proprietary horsepox virus vector. We're doing the animal testing with Southern Research Institute, and we're manufacturing it in collaboration with Fujifilm Diosynth. So the COVID vaccine story is very hot. I'm sure everyone is watching it carefully. There are over 150 vaccines in development, but we think that, first of all, more than one will be approved. The other thing is that we think that different vaccines will have different attributes over time. And ours is in a very small group. Only a few companies and only a few programs are working on live attenuated viruses. We have two. I'm just going to talk about horsepox today. But for example, Merck has two live attenuated viruses. Merck has been the leader in vaccine development for many years. So we feel we're in good company focusing on live attenuated vaccines. So what are the benefits of live attenuated vaccines? Well, long-term durable immunity, single dose administration and scalable manufacturing, and also the prospect of blocking forward transmission. That means limiting the ability of people to be contagious. We recently announced very compelling news about our vaccination of non-human primates. And we got good reactions in 8 of 8 animals, including neutralizing anti-CoV-2 antibodies. We had good tolerability in the non-human primates, and the dose that was required to induce the immunity is low. And that's promising because it means that we believe we'll be able to present this as a product with 100 doses in each glass vial. So that glass sparing property is very important in dealing with the pandemic. So 1800 is engineered for long-term immunity. It's based on a vaccine that Edward Jenner developed over 200 years ago. He called that Vaccinia. It's the most successful vaccine ever. It led to the eradication of smallpox. Smallpox is the only disease ever to have been eradicated. And since a lot of the work with smallpox was done before the molecular era, you can see that it's manufacturable at scale, there's minimal cold chain issues, and many doses can be put in one vial. Now, we just had an announcement less than a week ago that our vaccine is very similar to an 1860 United States smallpox vaccine, which tells a very compelling story about the evolution of smallpox vaccines. Now, why are we excited about horsepox? Well, it can be engineered to express a number of different antigens. It does not integrate into the host genome. It elicits very strong immune responses. It's manufacturable at scale. And because it's an attenuated live vaccine, it stimulates the immune system in a pretty unique way. Now, here's a slide contrasting CoV-2, the cause of COVID-19 on the right, and SARS, the disease that affected people in Asia in 2003 on the left. And you can see there's a paradox. SARS was more deadly on a per patient basis. So about 10% of people that were infected with SARS died. Whereas CoV-2 is less deadly on a per patient basis, 100 times less effective at least. But the big difference is that CoV-2 is much more contagious. Only 744 people died of SARS. That seemed like a huge amount of people at the time. But as you can see on the right, you probably know over 1.3 million people have already died of CoV-2. So a key point of this slide is that CoV-2 is more contagious than SARS, and that's why it's so deadly. So it's less deadly on a per person basis, but it's more deadly because it basically makes it up on volume. So that's another reason why we're very excited about inducing strong T-cell immunity. T-cell immunity is durable, it's long-lived, it has the potential to clear viral infections, but also more than any other viral platform, it has the potential to block forward transmission. And that means to tame the incredible infectivity of CoV-2. Now, antibody immunity is much shorter lived, and we believe that the effects that are coming out of the studies that you've read about in the press, Pfizer, Moderna, AstraZeneca, these data are so close after vaccination that they're probably dominated by antibody-dependent immunity. But you really can't count on antibody-dependent immunity. It's short-lived, and there's not much evidence for being able to block infectivity. So here are the upcoming milestones. Number one, we've already completed. We recently announced the results of the non-human primate studies. And number two, will vaccination protect these non-human primates against CoV-2 challenge? And we will have data from that early in 2021. Here's the management team. We've been together for a number of years. I'm Seth Letterman. I've been in biotech for about 20 years, co-founder, CEO of this. Greg Sullivan, our chief medical officer, and we've been public since 2011. And here are the milestones. As you can see, we've had a very active Q3 and Q4, and I'll just call out the milestones related to the programs I've discussed, and that is in the CoV-2 program, we expect to have animal data on the challenge early in 2021, very early in Q1, and we expect to have GMP material manufactured so we can do phase 1 trials. In the 102SL program for fibromyalgia, we just announced positive phase 3 study. We're mid phase 3, and we're already enrolling a second phase 3 trial, and we expect to report data on that in second half of 2021. So with that, I thank you all very much for your attention, and visit our website, tonixpharma.com, and I'll be taking part in a fireside chat this afternoon at about 3 o'clock. So I encourage you to tune in for that. Thank you, Seth Letterman, CEO of Tonix Pharmaceuticals.
Seth, thank you so much for joining us again at ticker TNXP. And all right, guys, I was told by producer Shelby that we have to go quickly, but you guys know that I'm a sucker for giveaways. I love the giveaways. Again, we're going to drop the link into the chat again for you to be able to participate. So if you haven't signed up for the giveaway yet, it's not too late. The first thing that we're going to give away, a lifetime subscription to Benzinga Pro. This is something that we sell for $5,000 here. This is the news and resource terminal, benzingapro.com. And the winner is Roger2K6. Roger, if that sounds like your email, you have 10 minutes. You are on the clock now. 10 minutes to email events@benzinga.com. Again, that's events@benzinga.com. And Roger's stock pick was GNUS. That's Genius Brands. That's been a hot one. But all right, guys, let's hop straight into this next panel. We're going to be talking about REITs. I think this is a super interesting space, especially with the developments that we've had this year. I can't wait to hear about how these companies are thinking about 2020 and then going on into 2021. So I want to go ahead and introduce David Averbach, who is going to be the moderator for this panel. He's from World Equity Group and IR Related. David, I will let you go ahead and take it away.
Good morning, everybody. Thanks for having us. I'm honored to be joined by several colleagues in the industry. My name is David Auerbach. I'm an institutional trader with World Equity Group out of Chicago. I'm also a consultant with IR Realized and also the publisher and contributor of the Daily REIT newsletter. With me joining today, I'm honored to be joined by Richard Stockton, the CEO of Braemar Hotels and Resorts. Richard's been CEO since November 2016 and served as the president since April of 2017. Braemar is a real estate investment trust that focuses on investing in full service luxury hotels and resorts, which are anticipated to generate RevPAR of at least twice the US average RevPAR for all hotels as determined by Smith Travel Research and is externally advised by Ashford, ticker AINC. Braemar's 13 hotels total almost 3,500 owned rooms and are located in DC, California, Washington, Pennsylvania, Florida, Illinois, Colorado, Florida, and St. Thomas in the USVI that range from premium branded independent hotel companies like Hilton, Marriott, Ritz-Carlton, Sofitel, Park Hyatt, among others. I'd also like to introduce Matthew Partridge. He's the dual CFO, treasurer, and senior vice president of Alpine Income Property Trust, ticker PINE, as well as CTO Realty Growth, ticker CTO. Matt joined in October of 2020. He's been in the C-suite as CFO of VP of Finance at Agree Realty, ticker ADC, as well as Pebblebrook Hotel Trust, PEB. Alpine owns and operates a portfolio of high-quality, single-tenant net lease commercial income properties. A portfolio consists of 46 properties in 33 markets in 17 states, and focusing on 18 industries. Average lease term is about 8.5 years. They have acquired about $101 million of single tenant net lease properties year to date, with an average going in cap rate of 6.9%. CTO Realty Growth, on the other hand, owns income properties that comprise 2.4 million square feet in markets, diversified markets in the United States. And they do own an approximate 23.5% interest in Alpine Realty Income Property Trust. And CTO is currently in the process of converting to a REIT. I'd also like to introduce David Lesser. David's the chairman and CEO of Power REIT, ticker PW, which focuses on acquiring and owning controlled environment agricultural facilities, also known as greenhouses, which are used for the cultivation of cannabis. And Power REIT leases these facilities to growers through long-term triple net leases, meaning their tenants are responsible for all operating and capital expenses. Since July of 2019, Power REIT's been expanding their greenhouse footprint through accretive acquisitions, which have bolstered their core FFO, funds from operations, trajectory. They currently own over 38 acres of land with approximately 193,000 square feet of greenhouse processing space. In addition, they have 600 acres of land leased to over 107 megawatts of utility scale solar farms, along with 112 miles of railroad located in the Marcellus Shale territory of Pennsylvania, West Virginia, and Ohio. They currently have a market cap around $52 million, trading around $27 a share, with a forward FFO multiple of approximately 12.5 times. Finally, I'd like to introduce Ian Selig. Ian is the manager of investor relations at Safehold, ticker SAFE, since October of 2017. Ian's a 13-year Wall Street veteran, a heck of a musician, and he's got a proven track record for effectively planning and executing and communicating broad strategic direction. He's got extensive managerial and executive experience in both financial and global consumer products organizations, with expertise integrating finance, communication, marketing, securities, law, and compliance. Safehold is currently the only publicly traded REIT that focuses on ground leases and offers investors a way to own the land beneath buildings while delivering safe, growing income and long-term capital appreciation to its shareholders. Safe was the top performing REIT in 2019, up 118%, while Green Street notes that, quote, the security of a ground lease position is incredibly safe when compared to other equity investments in the commercial real estate industry. Before we get going, real quick, for those that don't know, let's talk about a REIT real quick. A REIT, according to REIT.com, a real estate investment trust, in order to qualify, the REIT must invest at least 75% of their total assets in real estate, derive at least 75% of their gross income from the rents from real property, interest on mortgages, financing real property, or from the sales of real estate. The kicker here, they pay at least 90% of their taxable income in the form of shareholder dividends each year. It's an entity that's taxable as a corporation, managed by a board of directors or trustees. They have a minimum of 100 shareholders and have no more than 50% of its shares held by 5 or fewer individuals. And in our case here, that really doesn't apply because we're focusing on publicly traded REITs. So with that, gentlemen, good morning. Thank you for joining me. It's great to see all you guys.
Morning.
Morning, David.
Hey, David.
So let's kick it off. As we focus on the first important topic, obviously, is leases. Everybody has leases here, whether you're Richard and your tenant spends one night at your property, you have partners like Marriott and Hilton, or you're Matt and you have relationships with gas stations and convenience stores and all sorts of stuff. Talk about how the importance of leasing works in your REIT with your partners, and then we'll go from there. David, why don't you kick us off?
Sure. So in our portfolio, we mostly have what would be referred to in the industry, the real estate industry, as triple net leases. So it really keeps sort of management and operations and frankly, G&A down because really our tenant is responsible completely for that property. And we have very clear visibility in terms of the cash flow and earnings that we're going to get from those properties. So it's a good structure for what we do because we're really owning purpose-built or specialty types of assets. And really, we are a financial partner, if you will, owning that asset.
Richard, why don't you go?
Yeah, you know, in the hotel business, we're on the opposite end of the spectrum. We have one-night leases, as you say, generally, right? We have guests that stay with us for one night, and that creates an interesting dynamic because we can therefore react and adapt our business model to improvements in the economy on a nightly basis, right? So we can react to demand. So whereas some other REITs will have, you know, up to 10-year-long leases, and in some cases they'll have escalation provisions, we can actually move up our lease rates each day and take advantage of that demand. It works on the downside too, right? So you know, we'll have days and we'll have episodes like we've had over the last few months where there's slackening demand, and as a result, our lease rates are lower. So I think when you think about lodging REITs versus other types, you're thinking really about how do I play the closest correlation with the overall economy that I can. And if you're very bullish on the economy and very bullish on the recovery of the economy right now, lodging REITs will tend to track that very closely.
Matt?
Yeah, I think at Alpine, we're very similar to David. We're focused on triple net leases, which minimizes the G&A spend and the operational activity associated with those assets. And we're at the opposite end of the spectrum of Richard. At CTO, with a focus on retail shopping centers and office assets, we're kind of in between where Alpine and Power REITs sit and where Richard and the nightly leases sit. Our leases tend to be 5 to 10 years in length at CTO, and we can position ourselves to take advantage of rental increases in the market as the leases roll over, whereas we have less of an opportunity to do that at Alpine, just given the long-term nature of the leases. So at Alpine, we focus more on rental increases within those leases and within the options where the tenants tend to be a little bit more stable in terms of occupying the assets.
And Ian.
Sure. So as you mentioned, David, we are the first and only publicly traded REIT that is focused on ground leases. Many of you may be familiar with ground leases, but for those of you who are not, it's pretty easy to understand. Any piece of commercial real estate is literally just two components. It's the land and the building that sits on top of that land, and in a ground lease structure, we separate those two things. And one party owns the land, and that would be us at SAFE. And another party leases that land for a long duration, typically 99 years. And not unlike David and Matt, those tenants are under a triple net lease, and they are responsible for all expenses and CapEx. And they're the de facto owners of that building, and any net operating income or profits that building produces is theirs to keep. However, not unlike some other lease structures, at the termination of the lease, not only does SAFE get its land back, but it gets the building and all the improvements back as well. So I think everyone has to have a little bit of an idea of how that works. So it's an interesting way to look at investing in land, which is not unlike a fixed income instrument. It's a high grade bond. That's how we kind of look at it.
Well, that's a good transition to the next topic, which I want to focus on, and that's the importance of leverage. Looking at your various companies, we're looking at growth, income. No two REITs are alike. No two companies are alike. Everybody has a different leverage and risk profile. So can you guys explain to us, because I'm a little biased growing up at Green Street, who was always emphasizing the importance of low leverage. Can you guys talk to us about how leverage has helped shape what you guys are trying to do? And then we'll use that as the next step to the next topic. Richard, why don't you kick off this round?
Yeah, no, that'd be great. And you're right, not all leverage is created equal. And you can design a leverage policy that coincides with your business model. And that's what we've done at Braemar. So more specifically, we have our debt 100% non-recourse, mortgaged at the asset level. That's generally been our policy. Now, we've drawn down a little bit of a corporate facility to cope with the pandemic liquidity needs, but generally all non-recourse at the asset level. And what that allows us to do is defend assets as necessary, depending on circumstances. But one of the other important things we've done is we've drawn all of our debt down as 100% floating rate. And that's against conventional wisdom, I think, particularly among long lease REITs, where they're tending to match that income stream with a fixed cost interest expense. But for us, as I said, we have nightly leases. And so by having 100% floating rate, what happens in a downturn is interest rates get cut. And when interest rates get cut, our interest expense goes down. So if our income is going down, our interest expense is also going down. So that's a nice hedge. Alternatively, if it's a upswing in the economy, generally interest rates will go up a little bit, but then you'll see a top line outperformance. And so we benefit that way. And that strategy has really served us well in this crisis, where we've been able to reduce our interest expense by over 30% as interest rates have been cut and base rates have been cut. And then the other thing that we do that enables us to have a little bit higher leverage, I think, than some of our peers is hold a war chest of cash on hand. And we have a policy of holding 10% of our gross debt balance as cash on hand. And that cash is there to plug any gaps in refinancing if there's a hiccup in the debt capital markets, or to provide a cushion for any liquidity that's needed during a downturn, which is what we're experiencing right now. So we had 45% net debt to gross assets coming into the pandemic. It's ticked up a little bit now because we've used cash and drawn down a little extra debt, so we're about 55%. But suffice to say that we have ample liquidity to last us through the full recovery of this phase of the economy, and believe that our leverage strategy was exactly the right one to be able to cope with this.
Thank you for that. Ian, how about you go next?
Sure, absolutely. So at SAFE, we presently have about $1.7 billion worth of debt, but it's 35 years out maturity. So we're fairly well immunized against any interest rate fluctuations, unless anyone thinks anything's going to happen in the super long term. We have our portfolio is used as collateral against that debt. And if you think about it, like, who are the folks who would give you 35 years worth of maturity and their life companies? And they understand that these are 99-year investments. And our leverage policy, to use Richard's words, is really 2 to 1. So if we're going to do a $90 million ground lease and buy a piece of dirt for $90 million, we will spend $30 million in cash, and we'll lever the other 60. But that being said, we have done 2 raises, I believe, since the pandemic began, and we have roughly $1 billion in dry powder, for the reason that we're in business and we are doing deals, and we are ready to go at a moment's notice. Last year, we did a deal in New York for it was $600 million just for the dirt. So, if any of those whales ever come in, we never want to say no to a customer.
David?
Sure. So, look, interest rates are at historic lows, and with triple net long-term leases like we have in our portfolio, I think adding debt on a long-term basis makes a lot of sense. One of the other things, and similar. Similarly, we have some long-term ground leases, 99-year type ground leases, and late last year we were able to lock in, 4.6%, 35-year money. So that's very, very accretive to what we're doing.
Right.
We have a portfolio now. Our new focus on controlled environment agriculture is completely unleveraged because that portfolio has exposure to cannabis, and as such is not really able to borrow against that portfolio. Having said that, I would view a company like ours could sort of tick up relative to traditional REIT thought process in terms of leverage levels, because we are investing at such extremely high yields. So in my mind, it gives us a tremendous amount of coverage on debt and debt service, and really is massively accretive. So we're certainly interested in increasing our leverage as possible. But as I mentioned, there is a challenge associated with our cannabis exposure.
And Matt, you're up.
Yep. So with long-term leases, similar to David, and similar to the point that Richard made, we focus on locking in our cost of capital to match the income stream associated with it. Unlike Richard, whose all of his debt is primarily associated with the asset, 100% of our debt is corporate guaranteed and not affiliated with any one particular asset, because most of our assets are, $2 to $3 million in acquisition value, and so the efficiency of doing corporate level debt it makes sense for the types of assets that we're buying. The other point I would make about our debt policy is that we are focused on the sustainability of our dividend and the cash flow associated with it. So we're generally trying to lock in interest rates to preserve that spread that then will flow to the investors through our dividend, which is a little bit different than some of the other asset types on the panelists here.
Well, that was going to lead to my next topic. And so one reason why retail investors gravitate towards REITs is because of the dividend structure. Again, noting that 90% of the net income is paid out to shareholders in the form of dividends. According to NAREIT, current dividend yield on average right now is about 4%. The benchmark that we use is around the 10-year note, which is trading, call it 95 basis points. So there's an inherent, call it 300 basis points in your pocket, according to NAREIT, as to why REITs are a more beneficial investment, and why advisors recommend 5 to 15% of your portfolio in REITs. So with that, I know dividends are obviously a very touchy subject. It's an interesting topic, but let's focus on that because we're looking out towards 21, which we will transition to talk about briefly here. But Matt, expand a little bit more about the dividend policy with Alpine and CTO, and we'll go from there.
Yeah, Alpine's been around for a little over a year, and so we're growing into our dividend as we continue to place the capital that we have available for investment. Right now, we're yielding around a 5.75% yield, and we expect that dividend to grow as we continue to invest in assets and drive cash flow and taxable income. Conversely, at CTO, it's a little bit more of a stabilized company. We're in the process, as you mentioned, of going through the REIT conversion, which will be effective for 2020 and is almost complete. Over there, we're yielding north of 9%, in part because of the conversion and the misunderstanding, I think, by the investment community of what the company will look like post REIT conversion. And we expect the stock to respond to the dividend as we head into 2021. But for us, we're focused on driving cash flow that then will make its way into our shareholders' total return through dividend policy.
Ian, you want to touch on Safehold's situation? I know it's not a dividend play, but it's an interesting story. You want to talk about that?
I thought you would save me for last, seeing that we have probably the lowest dividend on the panel. But yes, you are correct, David. our dividend, I think, is under 1% right now. We have raised our dividend every year that we have been in business since our IPO. There's two things going on there. Number one, since our stock has accelerated so quickly, it's pretty much just math. As your share price goes up, your dividend goes down. That being said, this SAFE is not a dividend play. We're a growth and we're a value play. As I mentioned earlier, it's our point of view that the land underneath building is something akin to a AAA bond. So if you take any AAA bond with similar maturity and risk profiles, for example, MIT has a 100-year AAA bond. Their yield to maturity is 3.2%. Well, in our ground leases, they're very straightforward. We have 2% annual bump structures that compound every year. And if you overlay the returns from those two very similar bonds, for example, we have literally 150 to 200 basis points wide of any other existing AAA bond out there. So that is the returns that we are giving to our investors. Discount the fact that we returned 118% total return. Last year, we were over 70%. This year, that's all fantastic. But I think the real crux of the story is the fact that we have these excess returns, and there's probably no other compounding, escalating bump structure in existence today that give you that much of a spread. Look, in the AAA CMBS world, if you can generate, and I think Matt knows this for sure, probably better than anybody, if you can generate 5, 10, 15, 20 basis points wider than your peers, you would be one of the best performing managers on Wall Street. We are literally providing 150 to 200 basis points wide of similar like bonds.
David?
Yeah, so we're also sort of uniquely situated. We actually don't currently pay a dividend on our common shares. We are able to qualify as a REIT, nevertheless, because we have a significant net operating loss. And because we're in a growth mode and deploying capital, again, at very, very high yields. I mean, basically, our most recent acquisition was at a 19% unleveraged yield. We've chosen for now to retain capital because we can create, in our opinion, more shareholder value by deploying that capital within the company rather than making a distribution to our shareholders. And frankly, I've had conversations with many shareholders who say, hey, keep doing what you're doing. Don't reinstate a dividend. Having said that, at some point in the, I would say, not too distant future, we probably will put a dividend back in place on our common shares as we continue to grow and it becomes less and less of an issue. But right now, we do not have a dividend because, again, we feel we can create more shareholder value by retaining all capital and deploying it. We do actually have a second class of shares, which is preferred class. And that class does currently pay a dividend. Its coupon is a 7 3/4 rate.
Thank you. Richard?
Yeah, likewise, we're currently not paying a dividend. And I'd say that, investing in hotels and lodging REITs, you're investing in, assets that are, again, geared to the economy. And so we're much more of a growth story. Historically, we've paid a dividend of about 5%. We suspended that earlier this year in order to cope with the pandemic. We'll reinstate it at some point in the future once we're out of the woods and I'd say profitability returns to probably 2019 levels. But investors that we have really don't focus on a dividend because they want to own, in our case, the highest quality assets in the lodging industry, and so they want to own a piece of the Ritz-Carlton Lake Tahoe, the Ritz-Carlton Sarasota, the Ritz-Carlton St. Thomas. And we've done analysis to suggest that luxury hotels are able to grow their values greater than any other type of hotels over the long period of time. And so it's that kind of growth story, and it's that defensive asset underpinning is what brings investors to our stock.
And then the last question for you guys, looking at 21, what's the value proposition? Why should we be buying your stocks? Let's start with Ian. Ian, why should we be buying Safehold into 2021?
Well, we have a very strong pipeline. Last year, we did $1.8 billion worth of deals. Our portfolio has grown pretty much, I think, 9 times since our IPO. The stock's up over 250% since we IPO'd in 2017. Again, we were number one last year. I think we're number two this year behind IPR. But it is just a continued growth story. More customers are understanding that when you can offer them higher returns with less risk, then you have some secret sauce going on. So again, we're the only players in the game, so we're running the field alone presently. And we've, we're just continuing to grow, at a fairly dramatic pace.
Thank you, David.
Sure. So we currently trade at a lower multiple than the broader REIT market. As a small company, it's a lot easier to grow and grow rapidly. But the small size of our company combined with the extraordinary yields that we've been investing at really supercharges the potential for growth that we see. So we think the combination of our current valuation with the projected growth is really misunderstood by the market. And we have a massive pipeline of additional deals. There's a huge need for capital in the cannabis greenhouse cultivation facility market. So we think we can deploy tremendous capital going forward and create a lot of shareholder value in the process.
Richard?
Yeah, I think for us it's very simple. Due to the COVID-19 pandemic, our shares have been severely depressed. We're down 50% year to date. And we're in one of those industries that's very positively geared toward a recovery. And we see it coming, right? We're getting positive medical news on the vaccine for the past 4 weeks straight. It's just now a matter of time before that gets reinstated. People get back on planes, they start traveling, we start meetings, conferences, et cetera. And our stock will react accordingly. And so for us, it's do you want to invest in the recovery that we all know is coming? And that's the play for us.
Your last, Matt.
Yep. Yeah. For us, similar to David, we're growing off a relatively small investment base. So we've got a tremendous amount of growth ahead of us in 2021. We're trading at a discounted valuation relative to our peers, somewhere between 2 to 3 turns on an FFO basis. And we're paying a higher relative yield than almost anybody else in the single tenant net lease space. So from a cash flow standpoint, combined with growth, I think we can provide outsized shareholder returns relative to the single tenant net lease peer group.
Well, I really appreciate you guys spending 30 minutes talking with me here today. I hope we can do this again in person. And I wish guys, obviously, please be safe, and we'll see you in 2021. Thank you again.
Thanks, everybody. Obviously,
Thanks.
we definitely wish we could do this in person, but soon, definitely soon. Guys, we'll see you all shortly. Unless you've already done your presentation, in that case, be healthy and be safe.
Thank you.
Appreciate it, guys.
Thanks, Elliot.
All right, y'all, we are going to keep moving right along. We are actually welcoming back, if I'm not mistaken, Jeff Cohen, the Vice President of Strategic Planning and IR for Esports Entertainment Group. Actually, Jeff, were you on before? Actually, I see you if you want to get your video and mic on, brother.
I'm gonna leave my video off for this one if you don't mind. Can you see my?
Yes, sir. We do see your screen.
Awesome, perfect. And yeah, perfect. I was on that panel before, so that was a good time.
Perfect. All right, I'm gonna let you take it away, Jeff.
Good to get going. All right. Yeah, so I'm Jeff Cohen. I run strategy and investor relations here at Esports Entertainment Group. We're NASDAQ listed under the ticker GMBL. What we do is esports and online gambling. Here, we've got some safe harbor language and disclosures. I won't go through all that. At EEG, our mission statement is to build the future esports betting and entertainment. Before I get further into how we're doing that and the businesses we operate, I'd like to take a step back and give some background on esports for those in the audience that may be unfamiliar. So what is esports? We define esports as competitive video gaming that's watched as a spectator event. For those in the audience that are over the age of 25, you're probably sitting there rolling your eyes right now. But this is a massive secular trend that's actually only accelerated during the COVID pandemic. We've seen esports break into the mainstream with events broadcast to national TV audiences on ESPN and Fox Sports. Those of us that have followed the sector for some time had always expected these things to happen at some point, but the pandemic has really accelerated that timeline. There's a number of impressive stats out there that highlight the increasing popularity of gaming. but I think the 4 here on this slide are amongst the most impressive. There are 2.5 billion gamers globally, with 2 out of 3 Americans identifying themselves as gamers. The gaming industry is now bigger from a revenue perspective than the movie and music industry combined. And probably most impressively, millennials are now spending more time engaging with gaming than they are with social media. This growth and popularity of gaming has led directly to increased awareness and interest in esports. Esports tournaments are now exceeding the prize pools of big traditional sports tournaments. For example, Booga, the 16-year-old who won the Fortnite World Cup in 2019, took home a larger purse than Tiger Woods did for winning the Masters that year. In terms of audience size, esports championships have begun to eclipse those of traditional sports as well. To highlight that, in 2019, the League of Legends Championship drew a larger crowd than the Super Bowl. One of the things that draws many investors to esports are the demographics of the fan base. Esports fans are young, digital native, and affluent. Of the 500 million esports viewers worldwide, 75% are younger than 35, and 43% have an annual household income of over $75,000 per year. Importantly for advertisers, third-party research has also found that esports fans are more likely to be influenced by their favorite team being sponsored by a brand than traditional sports fans are. This is why in recent years, we've seen an influx of both endemic and non-endemic sponsors entering the esports ecosystem. Despite these impressive demographics and abundance of eyeballs, esports still lag significantly behind traditional sports in terms of monetization per viewer. We think this presents a massive opportunity for companies like us in the space as the ecosystem matures over the next several years. As a former analyst covering the esports sector, one of the things I would hear a lot from public investors is that there are very few pure play esports investment opportunities in the public markets. At Esports Entertainment Group, we structure our business across 3 pillars that we believe can provide investors with a broad exposure to the large and rapidly growing esports market. Those 3 pillars are 1, esports entertainment and infrastructure, 2, esports wagering, and 3, iGaming and traditional sports betting. Across these 3 pillars, we operate 6 different entities that I'll walk through in detail over the rest of the presentation. But the important thing to note here is really the synergies between the pillars and the diversification of revenue streams. We think that diversification really differentiates us from our competition in the space. On this slide here, you can see all the logos of the brands that we operate and which pillar they bucket into. Since our uplisting to the NASDAQ back in April, we've been very acquisitive, with everything on this page here having been acquired since then, with the exception of the VIGG brand. I'll walk through a bit on each of these businesses now and how they fit together within this 3-pillar framework, starting with esports entertainment and infrastructure. So our first esports entertainment asset is Esports Gaming League, our skill-based tournament platform. In their 10-year history, EGL has primarily been focused in Europe, partnering to host tournaments with brands such as Microsoft, Red Bull, Arsenal, Activision, and more. Subsequent to our acquisition of EGL in August, we've begun to bring the brand here to the US. In September, we announced first of their kind deals with the LA Kings, LA Galaxy, and Philadelphia Union to be their official esports tournament provider. What we found is that during the pandemic, traditional sports teams are struggling to engage with their fans without being able to have them in the stands. And because of the online nature of esports, as well as the crossover between traditional sports fans and gamers, we believe we have a solution for them with our tournament platform. Since our announcement with AEG Group, we've had over 10 additional sporting organizations reach out to explore similar partnerships. As we host tournaments for these organizations, we're also building up a really valuable database of gamers that we can cross-sell our esports wagering products into. Turning now to our second important esports entertainment asset, which is Helix Esports. Helix operates 5 LAN centers, including 2 of the biggest in the United States. You could think of these as social and community hubs for gamers to come, congregate, and participate in tournaments. While COVID has, of course, been a temporary headwind for these centers, Helix has been able to sign deals during the pandemic with prime real estate locations at very favorable terms that really would not have been attainable prior to the pandemic. The store-level unit economics of these centers make them a very attractive use of capital. It costs about $500,000 to build out a large Helix center, and the payback period on that investment is typically less than a year. At scale, we believe these centers can generate 20% plus EBITDA margins. Importantly, the centers will also allow us to deepen our relationships with the traditional sports teams that we're working with on the EGL side. Since announcing our acquisition of Helix back in late October, we've had conversations with numerous sporting organizations that want to build Helix centers at their stadiums. Turning now to the infrastructure side of our first pillar, here we have GG Circuit and Genji Analytics. GG Circuit is a cloud-based operating system that is sold to LAN centers like Helix on a per computer subscription basis. Currently, GG Circuit serves over 1,000 connected locations globally with 1.9 million unique users and 60 million hours of total usage. This is a classic example of a picks and shovels type investment that will generate strong returns as thousands of new LAN centers are built across the US in the next several years. GG Circuit works with some of the biggest names in esports, including Allied Esports, Super League, Simplicity, GameWorks, as well as 50 plus universities and colleges. We expect GG Circuit to generate nearly 10 million in revenue next year, growing 100% year over year, and to do that profitably. We also see strong synergies with our LanDuel product, which is something I'm going to talk about in further detail on the next slide. Looking now at Genji. Genji is an esports analytics solution that has both B2B and B2C applications. On the B2B side, Genji works with entities like EA's FIFA and Take-Two's NBA 2K League to power activities like combines, drafts, and other data-driven business decisions. On the B2C side, we believe Genji's analytics can be used to create scouting reports for players that they can then use to get recruited to either colleges or picked up by professional sports esports teams. We envision offering this product as an add-on in centers across the entire GG Circuit network. Finally, as a synergy with our wagering products, we anticipate that Genji's analytics will enable our VIGG platform to offer tighter lines on more esports events than any other wagering platform, which actually transitions us nicely to our second pillar, which is the esports wagering pillar. Here we have our VIGG platform and LanDuel. VIGG is an esports vertical focused wagering platform. We're currently the only esports focused wagering platform with a NASDAQ listing, as well as tier 1 gambling licenses. Currently have licenses in the UK, Ireland, and Malta, which allows us to market into 150 additional jurisdictions around the globe. Over the summer, this past summer, we announced that we've secured US market access in New Jersey through a partnership with Twin Rivers Casino. We're currently awaiting approval from the New Jersey Department of Gaming Enforcement and anticipate we will launch there in Q1 of 2021. One of the important things we're doing as a platform is trying to be an authentic brand that esports fans can trust. In order to do that, we've partnered with hundreds of teams and streamers who really serve as affiliates, sending players to our sportsbook. We've also acquired the naming rights and jersey logo placement for the famous Dignitas Counter-Strike Go team. Dignitas is owned by Harris Blitzer Sports and Entertainment, who's also a shareholder of ours, and also owns other sports teams such as the New Jersey Devils and Philadelphia 76ers. We actually just moved our US headquarters into their offices in Newark, New Jersey as well, so we've definitely got a really strong strategic relationship there. While the esports wagering market remains very nascent currently, we see a $3.5 billion addressable market as the industry matures and legalizes here in the US. One of the things that's really important is creating a brand that esports fans trust and educating these fans around gambling. Esports has a very passionate community, but it's one that's still learning the ins and outs of online gambling. On the other side of the slide here, we have LanDuel, which has the chance to potentially actually be even bigger. LanDuel is a proprietary platform that allows for player versus player skill-based wagering on third-party video games. What that means is that two players can play one another in a game of FIFA or a game of Fortnite and bet money on the outcome of their match. In our vision, this market will start first in the Helix LAN centers, then expanding to all centers in GG Circuit's network, and then finally into players' homes using the GG Circuit at-home product. The reason we feel we'll have to begin in the centers is really for compliance and regulatory reasons. One of the struggles that other platforms who have attempted to enter this market have faced is that cheating is rampant, and there's really no way to know that the person playing on the other side of the console is who they say they are. With the physical locations and LANDOR's 4-factor authentication process, we believe we've solved this challenge. Although this is considered to be a game of skill and thus technically not regulated, we are currently working alongside the New Jersey Department of Gaming Enforcement on a pilot program that we expect to launch in early 2021. Because of our focus on compliance and working within the regulatory framework, publishers have been much more open to working with us than some of the more gray market platforms out there. This, alongside what we have with Helix and GG Circuit, opens up a really exciting new vertical for us as well, as a one-stop shop for casinos that are looking to solve their demographic challenges by engaging a new customer through esports. To our knowledge, we're the only organization out there currently that can offer this type of turnkey solution for casinos. And since announcing these acquisitions of Helix and GG Circuit, like I said, in late October, we've had several casinos approach us about building Helix centers and utilizing the LANDOR product within their locations. Finally, now we'll turn to our final pillar, which is iGaming and traditional sports betting. Here we have our Argyle Entertainment asset, which operates a sportsbook in the UK under the Sport Nation brand. One thing that COVID has shown to us is that there is considerable demand for traditional sports bettors to bet on esports. Argyle also brought over with it a team of very talented gambling professionals with expertise on both the regulatory front as well as the operations and product design side. We think this deep bench of online gambling talent helps differentiate us versus some of the other esports vertical-focused wagering operators. To that end, we've engaged Accur Capital to help us with our M&A strategy of acquiring additional mature iGaming operators, primarily overseas in Europe. What these acquisitions do for us is, one, provide us access to gaming licenses in strategic jurisdictions. Two, provide us with a pool of players that we can then cross-sell our esports offerings into. We believe these acquisitions will be significantly accretive to shareholder value and create operational synergies with both our VIGG and Argyle assets. I know I've kind of thrown a lot of information at you here today, but turn now to the last slide and we'll walk through some of the financials. These numbers are a bit dated here on the left. Our market cap sits around 62 million now. We have 9 million in cash as of our last balance sheet date with no debt. We're on a June 30th fiscal year end. So we've given guidance for revenue for both fiscal 21, 13 million, and fiscal 22, 25 million. Pro forma for our GG Circuit Helix acquisition, which we expect to close sometime early in the new year. We've said our fiscal 22 guidance will be increased to 42 million. We'll plan to update on the fiscal 21 guide when we get closer to closing the transaction. And also note,
hey, Jeff, do you want to leave us with one final thought here, my friend?
Yeah. I think happy to talk to anyone. Please reach out, Jeff at esportsentertainmentgroup.com to learn more. Esports is a really exciting sector. I think we're well positioned. And thank you for having us, Elliot.
Yeah, thank you so much, Jeff. Really great presentation. Very interesting. A lot of people tuned in for that, and we'll definitely keep an eye and hopefully talk to you again soon. Awesome. Jeff, thanks again and stay healthy. All right, we're going to keep it moving. Next up, we have Promodex. Also, Esports Entertainment Group is GMBL on the NASDAQ. Promodex is on the NASDAQ as well, listed CDXC. All right, Rob, the CEO, and Kevin, the CFO, are here to talk. Let's make sure we get your microphones and cameras on, gentlemen. All right, I see you, Kevin. If you want to get your microphone on there for us.
Good morning, everybody.
Good morning. All right, I'll let you gentlemen take it away. All right, it doesn't look like we have Rob, but Kevin, would you like to go ahead and get started?
Well, I'm going to wait for Rob. Rob's doing the presentation. He should be on shortly. He's on the phone.
It looks like he hopped off the Zoom. back on.
Yeah. Okay.
All right. So again, this is Chromadex, listed on the NASDAQ for CDXC. This is Kevin Farr that is on with us right now. He's the CFO. Robert Freed is the CEO. Did I say that right, Kevin, or is it Fried?
That is correct. Yes.
Freed. Okay.
Yeah.
Fantastic. All right. So hopefully we can get him back on
Yeah, he says
shortly.
He's on. He's on now. Robert, ready to go.
Oh, there you are.
Okay. I was asked to tell you guys that we will be giving forward-looking statements. If we were in person, I'd be asking anybody in the room if they had heard of NAD by a show of hands. But since we're not in the room and I can't see your hands, I'm just going to assume that about a third of you have heard of NAD at this point. When Kevin and I started a few years ago, we couldn't find anyone that had heard of NAD, nicotinamide adenine dinucleotide, but that is quickly changing. Chromadex controls a patent portfolio around a very important molecule called nicotinamide riboside. Nicotinamide riboside very safely and very efficiently elevates NAD, nicotinamide adenine dinucleotide, which is the most important metabolite found in the body and is found in not just all human cells, all living cells. Could you go to the next slide and the slide after that? There you go, thanks. Our business plan is to create a global brand around what we call Niagen, or what we sell as a consumer brand, True Niagen. Niagen is our name for nicotinamide riboside. Why is that our focus of our company? I wonder if you could go to the next slide, please. Because over the last few years, there has been more independent research from the biochemistry community on nicotinamide riboside and on NAD than any other molecule. It is perhaps the most important molecule to have entered the ingredient or dietary supplement business in a couple of generations. Because NAD decline is associated with virtually every disease that we can identify, to which we associate with growing old. NAD levels decline with age, and NAD levels decline under physiological stress. These are some of the companies with whom we've made deals. These companies are doing research on various indications at their own expense on nicotinamide riboside, again, what we call Niagen. If we are unable to persuade you to invest in Chromadex today, or to further research Chromadex as a company today, I at least hope that everybody listening to us right now today goes out and, if not purchase, research Niagen, nicotinamide riboside, for yourself and for the people that you care about. When you elevate NAD levels, you improve health. Could you go to the next slide, please? These are the areas that are being studied. We've had dozens of published peer-reviewed preclinical and clinical studies over the last few years. We've had 11 published clinical studies and over 100 preclinical studies. What happens with NAD, what happens as we grow old, is that these NAD levels decline. But what is it exactly that NAD does? When you were in biology in 9th grade or 10th grade, you learned about something called mitochondria. Mitochondria, these are organelles inside the cell that are responsible for taking nutrients from food and oxygen from air and creating energy as we know it. It then transfers that energy to molecules called ATP molecules, who then transports the energy to various functions within the cell. That process that I just described is called the Krebs cycle. It's basic biology. In order for mitochondria to do that work, it requires NAD. When there's a decline in NAD, you not only have less efficient mitochondria, but you have fewer mitochondria. And what we have take Niagen orally, nicotinamide riboside, you increase the function of mitochondria, you increase the number of mitochondria, and you increase the amount of ATP, molecules carrying the energy. You have more actual energy when you take True Niagen. But NAD is much more important than just energy, if you could believe that. There are also enzymes inside the cell called PARP, P-A-R-P enzymes. PARP enzymes are the enzymes inside the cell responsible for healing, for repairing damage within the cell. That damage could be oxidative stress damage. It could be a gene mutation. It could be gene damage. It could be inflammation. It could be the presence of an infection or a virus. Any of those things happen, what we automatically see is an extreme elevation of PARP. Why? Because the PARP enzymes are trying to expel that virus or trying to eliminate that inflammation. In order to do that, PARP require NAD. And we have shown that when you elevate NAD by taking Niagen, nicotinamide riboside, you not only have more effective PARP, but you have more PARP. I wonder if you could go to the next slide, please. This slide just shows you the amount of research and the elevation over the last few years that's been going on nicotinamide riboside. Okay, as I said, our mission is to create a global brand out of Niagen and True Niagen. And to that end, we've received regulatory approvals from the most stringent regulatory bodies in the world, not just the FDA, for whom we have 2 new dietary ingredient notifications, as well as GRAS, generally recognized as safe approval, but also Canada Health, Australia, European Food Safety Authority, perhaps the most difficult, as well as various claims. We are able to say not only that it's extremely safe, which it is, you guys should be taking it because it's safe and because it elevates NAD levels. But also, we've shown that by elevating NAD levels, there are certain therapeutic and prophylactic benefits to doing that. Now, it's a challenge when you're selling a dietary supplement to be able to make a health claim. Most regulatory bodies do not want you to make a health claim related to a disease if you are not pursuing drug approval status. So this is a challenge, and it's one that we are endeavoring to do. Many dietary supplements don't develop brand new ingredients that have potential therapeutic benefits for actual disease states. But we are not like other dietary supplement companies. So this is a constant endeavor for us to research the benefit and to find a way to communicate that benefit. So our relationships with these regulatory bodies is very strong and is very important. Could you please go to the next slide? This is just an indication of how we've done this. We've only been doing this now for 3 years. We launched our True Niagen consumer brand in March of 2017. We sell online in the US, we sell in retail in Hong Kong and in Singapore and Macau. We also now sell in retail in the UK. We sell in certain retail locations in Canada. It's mostly an online strategy. We sell cross-border into most of these countries, but you see we've begun to get global. Could you please go to the next slide? We are not doing it alone. We have made 2 very interesting deals. One is with the A.S. Watson Group. Watson is a high-end pharmaceutical drugstore, if you will, in Asia and in Europe. They have a footprint of close to 15,000 stores. As I said, we are in their stores in Hong Kong and Singapore. They also have a subsidiary called Superdrug in the UK. We're in 200 of the Superdrug stores as well in the UK. And we hope to expand that footprint. And then we also made a deal with Nestle Health Science, which is one of the world's great food companies. They have some scientists who are also world's leading experts in NAD. They recognize that this is an extremely unique product. We gave them rights in 2 categories. One is the medical foods category, medical food, where it's mostly institutional feeding, in hospital feeding. They have the protein-based meal replacement rights. So if the number 1 ingredient in the product is protein, we gave them the right to create a product with Niagen, as long as it's properly co-branded. And of course, as I said, the medical foods. They launched their first product, which they call Celtriant, 2 months ago. We made this deal about 2 years ago. So it took them about a year and a half to create the brand. By the way, they created this entire category, this entire brand, Celtriant, around this ingredient, nicotinamide riboside. Nestle is very bullish on NR and its benefits. Okay, next slide, please. Just an indication, when we joined Chromadex in 2017, it had historically been a testing service and an ingredient service. We created this brand, True Niagen, and converted the company into a consumer-facing company. The growth has been strong and steady. Since March of 2017, we expect to continue. Chromadex at its core is a very strong science company. We have a scientific advisory board that includes a Nobel Prize winner from Stanford, Roger Kornberg, in chemistry, a Nobel Prize winner from Cambridge, Sir John Walker, in biochemistry. He won his Nobel Prize in bioenergetics. We also have the co-head of the Department of Neurology from Harvard, that's Rudy Tanzi. We also have the inventor of nicotinamide riboside as a precursor to NAD, that's Dr. Charlie Brenner, who is at the City of Hope. We also have Dr. Bruni Felding, who is one of the country's leading cancer researchers at Scripps Research Institute, as well as Bruce German, who's perhaps the world's leading authority on milk at UC Davis. There are some serious implications. Some of the studies that we've shown here have shown an increase in milk production when pregnant animals take True Niagen. But that's just the tip of the iceberg of some of the indications, the positive indications that we've shown by True Niagen. I'm going to just leave it there and then hand it over to our CFO, Kevin Farr, who's going to walk you through some of the financial highlights and hopefully leave a little time to take a couple of questions.
Great, thanks, Rob. Good morning, I'm Kevin Farr, CFO of Chromadex. Rob mentioned the steady top-line growth for True Niagen, our core growth engine. We also continue to make steady progress in cost savings and expense leverage on our path to achieving cash flow break-even, an important objective of the company. Looking at the underlying performance of our business in the third quarter of 2020, adjusted EBITDA excluding legal expense was a loss of $125,000, or essentially break-even for year-to-date 2020. Next slide. We expect to achieve cash flow break even at approximately 19 million of quarterly sales and gross margins above 60% to offset higher operating expense driven by higher legal spending to protect our intellectual property. For purpose of this framework, we define cash flow break even as adjusted EBITDA, including total legal expense. If there's time, we'll now take questions.
Gentlemen, I think we are about out of time, unfortunately, but if you could tell people where they can reach you. Oh, right there. But just so everybody sees that, it looks like it's Brianna G, 2 N's, at chromadex.com, and it is chromadex.com. Again, the ticker is NASDAQ CDXC. Anything else, gentlemen?
Nope, I think
we're good.
Thank
awesome.
you.
Kevin,
Thanks,
Rob,
everybody.
I will definitely be looking into True Niagen. That is incredible.
You should be.
Really,
Yep.
really incredible stuff. I thank you so much for being here and wish you well. Thank you again.
Thank you.
Thanks, everybody.
All right. Thanks again to Rob and Kevin. Awesome company. I was unaware of True Niagen. Now I'm not, and now I will continue to look into it. Let's move right along, though, to a longtime friend of Benzinga, Forefront Ventures. We are welcoming the Chief Investment Officer, Andrew Toot. They are listed on the OTC FFNTF. Andrew, I got to admit, man, I didn't know that your last name was pronounced that way until Phil said it yesterday. So I apologize for saying it wrong all these years.
You aren't the first to mispronounce it, I promise, Elliot.
All right, Andrew, I'm going to let you take it away, my friend.
All right, thank you. And thanks everyone for joining us. Forefront Ventures is a multi-state cannabis operator with dominant market share in Washington state. And basically the thesis is we are taking those tried and true standard operating procedures and products that have allowed us to have a dominant market position in Washington, and we're taking those to 4 other states. Massachusetts, Michigan, California, and Illinois. And we have a license pending in New Jersey as well. It is for those who on the call who are not familiar with the cannabis market, it is a terrific time to be looking at this industry. Here in the United States, 15 states are now legal for adult use. 34 states are legal for medical use. And with the Biden as president-elect, we think that there is going to be a lot of movement in the coming years on legalization, not only for to loosen up banking restrictions in the United States, but afford us access to exchanges and more traditional avenues that other U.S. companies have. So it's a terrific time to be looking at U.S. cannabis right now. Our mission is really, really simple. We are a low-cost producer, and we, because of the elasticity in the cannabis markets, meaning that if you can offer consumers a low-price product, a great product at a very low price, you're going to take outsized market share. And because we have honed low-cost production in Washington, we're taking that across the country. We feel like we're very uniquely positioned to take an awful lot of market share in every state we enter. There's been a shift in U.S. cannabis. If you went back 2 years ago, companies would be on a conference like this talking about how many different states they're in. Oh, I'm in 12 different states. I'm in 17 different states. Right now, investors are rightfully focused not on how many states people in, but how good that company is executed. And Forefront, I'm very pleased to say, has been executing very well and has been setting up operational bogeys and knocking those down throughout this year. So our business overview, as I said, we're in 5 states servicing a population of 76 million people, roughly twice the amount of people in Canada. And it all really started with our dominance in Washington. We are the #1 edibles manufacturer in Washington state, the #2 producer of flower. We are top 10 in every other category, including vape pens, tinctures, you name it. So we have this stable of products that we can make very, very profitably, which we are taking on the road. A quick snapshot of where we are and what states we're taking that to. We have all of our products have been introduced to the Massachusetts market this year. We are recently announced last week that we are opening up a 185,000 square foot production facility to attack the $3 billion California market. And we're expanding greatly in the Illinois market. And so we are really excited on the setup as we enter into 2021 and 2022. Quick review of the assets. Washington is our flagship asset where we have 2 cultivation facilities and a commercial manufacturing facility that's 40,000 square feet. It looks like the Mars Candy Company. This is highly scalable, high throughput consumer packaged goods manufacturing that we've brought to the cannabis industry. We have similar facilities that were in Illinois, and in Massachusetts, where we have grow facilities, and we're currently adding additions to our manufacturing facilities as well as retail in Michigan, and soon to be entering the California market in Q2 of next year. We have brands, we have production, and that has allowed us, we've been very nimble as we have attacked these markets, giving a breadth of 25 different brands, 300 SKUs of products that we can produce very, very quickly. So as I said, Washington's really the blueprint. We're the #1 edibles manufacturer, #2 producer of flower. In that state, on any given month, we deliver to 260 retail locations. And those operating procedures and products that have caused market dominance in Washington, we're just taking outside of the state. We're taking those on the road. We have mastered efficiency at scale. Low cost production is the name of the game in Canada, or in cannabis. And we're not going into states hoping and praying that we get it right. We are experts at facility design. We have growing processes and cultivation processes that are tried and true. We've been able to get synergies on and cost savings on packaging and really wrung the labor out of our production capabilities. And so when we go into a new state, we aren't crossing our fingers, hope we get it right. We're iterating on capabilities that have been proven to work in other states, and we're merely making them better. Forefront is an operator-led company. Leo Gauntmaker was the architect of all our success in Washington State. He is our CEO. Carl Chascano, who is a operator and very accomplished entrepreneur in his own right, is our head of strategy and operations. And Joe Feltham on the far right is our COO, who is very much an operator at his core, has been in the cannabis industry for over 15 years. So I am the only Wall Street face you will see at the company currently. We are an operator-led company focused on execution. We think the future is finished goods. You know, if you roll out cannabis 3, 5, 7, 10 years, people aren't going to be as interested in being farmers, actually growing the plants. Finished goods manufacturing is really the sweet spot in the curve. And we are bringing the same scale, as I said before, that traditional consumer packaged goods operate with, and we're bringing that to the cannabis industry. And the breadth of our product is pretty incredible. Everything from edibles to vape pens to tinctures to capsules, we do it all, and we do it incredibly efficiently. We are able to bring products to market inside of 6 weeks. So if we're seeing a need in a product, we can innovate, deliver that product in a very short time frame, and that allows us to adapt to the markets we're in. Speed and agility. We are a machine. You go into our facility, our manufacturing facility in Washington, you see 200 people, 3 shifts a day, 24 hours a day, churning out product. And it's that efficiency that we're replicating across the map. And to that end, we have 25 different brands, over 300 SKUs in the market right now. And we are delivering to customers a value proposition of a very good product at an excellent price. And that's why our brands are getting a great following and recognition from our end users. Very quickly go through our product categories. On the flower side, we have a good, better, best strategy. Funky Monkey is our premium brand. Legends is our good brand. And then Mini Buds is our discount brand. And we offer all three in the markets in which we serve. Marma's High Burst. Marma's is our number one gummy square. High Burst is more like a fruit chew. They're being very well received in every market we're in. We also have Crystal Clear, which is our distillate vape pen, along with Terp Sticks, which is our infused pre-roll. We are rolling these out across every market we serve as well. Been very, there's a lot of proof of concept taking these products from Washington to these other states, and we're starting to see the uptick in consumer adoption of them. So consumers are loving them. We also have a wellness brand, Pure Ratios, which is largely based around CBD. This is a direct-to-consumer business, with the flagship product being a 96-hour pain relief patch. Which also we've seen great momentum in as we have moved throughout this year. Our retail stores are our mission. We hire folks that are happy, humble, and hardworking. We want a customer to come into our store and feel incredibly comfortable with the cannabis buying experience. We have a week-long training program for all new staff that enter our stores, and the feedback we've gotten from customers on not only the knowledge, but the friendliness with which our staff greets them is we hear time and time again. And we're a mission to serve. Like, this is normalizing the cannabis buying experience. Is, you know, we take a lot of pride in, and it's something that we've spent years, you know, honing our training programs and making sure that we have the right folks answering the right questions in the dispensaries every single day. Our business strategy, very, very simple. Leverage what we have done in Washington across huge nascent adult use markets: Illinois, Michigan, California, Massachusetts. Those states, if we fully penetrate and do what we think we're going to do in those states, we think we have a $250 million EBITDA opportunity there. And the only thing that I haven't mentioned here is that we also have a license pending, application pending for a license in New Jersey that recently went recreational as well. This is the time, I think, for cannabis in the U.S. right now, and I think investors should be paying a lot of attention to this space right now. There are a lot of companies out there, and sometimes it's hard to differentiate between them. But what I would submit to you is look for the ones that are very focused on operations. We think we have a competitive advantage with our low-cost production capabilities, and we can offer. We can take market share by offering customers a very good product at an excellent price. 4Front as a company, we recently flipped to EBITDA positive in the quarter we announced last week, and we as a management team are incredibly aligned with you, the shareholders. Insiders own over 40% of this company, and we are very much in the same boat as you all. Oh, it looks like the financial slide got clicked out. So with that, I may have a minute for questions, Elliot, but thank you for your attention, and please reach out if you have any questions on 4Front.
Yeah, awesome presentation, Andrew. You know, and you all are one of the more established operators in the space, but it will never cease to amaze me that you have 25 brands.
We do.
It is incredibly impressive. The New Jersey license too. That's exciting.
Well, we haven't won it yet, but the application is in there and pending. So fingers crossed on that front.
Absolutely, fingers crossed. And the New Jersey, obviously, an open pipeline to that other state over there, whatever that state is. Who knows? Andrew, we appreciate you being here, my friend. Always happy to have 4Front with us. Lots of interest. Definitely check 4Front out. They're awesome. One of the leaders in the cannabis industry. Andrew, we will see you soon.
All right. Thanks for having me.
All right. Stay healthy, man. All right. We're going to keep moving on. Thanks again to Andrew Toot from 4Front OTC FFNTF. Moving on to Paul Roberts, the interim CEO, and Josh Weiss, the CFO of Kubient Incorporated. They are listed on the NASDAQ KBNT. Gentlemen, I see you. Paul, looks like you are fully on here. Josh, you are muted, but that may be intentional. Oh, you're good now. Gentlemen, I'm going to let you take it away.
How you doing? Just getting a slideshow up here. Can you see that there?
Not yet on my end. Maybe we try again here. Zoom, the ultimate challenge for 2020. Correct. I am left on mute. There's like 3 mute buttons now since I use a microphone that I have to deal with.
My apologies here.
Oh, you're fine. You're fine. All right. Shelby, let's make sure they have full access there. Looks like you do. Looks like it's just Josh now.
Sorry about this technical issue.
No worries at all. Josh, while we're waiting here, is it helpful to start out with a little bit of a summary for the company?
I could certainly kick things off. Obviously, we're very happy and excited to be able to participate in this conference, so we appreciate that opportunity. Paul is going to be joining us momentarily, but of course, the usual start is our standard forward-looking statement statement. So this presentation contains forward-looking information. So I know everyone on the phone understands what that means. So please keep that in mind. With that, I am going to try to share this presentation and turn the call over to Paul.
Sorry for that.
Paul. Yeah, no worries, Paul. We see. Oh, there we go. Looking like we see the screen. Perfect. I'll let you guys take it.
Great. Thanks so much. So, Kubient was founded to help transform digital advertising. Digital advertising is one of the largest formats right now that brands are using to reach their audience. The slide up right now gives a little snapshot on our leadership team. Combined, we have a little over 100 years experience in digital advertising. I spent time at Yahoo. I've been involved in the market for about 20 plus years. Chris Andrews, who's our chief digital officer, most recently was the CTO at Ogilvy Health. Pavel Medvedev, our current CTO, was involved at building some of the largest ad tech platforms in the industry. And Josh, who's obviously joined us on the call, has spent a good amount of time in the public market on the financial side. We really feel strongly about surrounding ourselves with experienced members of the community. If you look at our board of directors, we have an incredibly experienced board. Elizabeth DeMars, she was one of the founders of Bankrate.com. She took creditcards.com public. She was the right hand for Michael Bloomberg as his CMO. Toby Smith was most recently the CMO of Atkins. And, he was involved in the turnaround at Puma. Jeannie Munn was the CFO and COO of MediaMath. And Grania Cohen, last but not least, she was the founding partner of Elevation Investments, a $1 billion hedge fund here in New York City. Next slide, Josh. So, why are we excited about talking to you about Kubient? We have built a cloud-based marketplace. And what that does, it connects advertisers directly with web publishers and app owners. Our proprietary technology is based upon fraud prevention. So fraud prevention, we're going to talk a lot about. It's one of the largest problems facing this massive market. In 2020, advertisers spent a little over $385 billion on digital advertising. We feel that we've assembled a proven management team who's grown and scaled companies in the past, along with our board of directors. And, we think that 2021 is going to give us a huge opportunity in the M&A space. So we have a large, pipeline of companies that we're talking through our investment bankers that we think would be a great add-on and very accretive to Kubient. One of the things we're also going to talk about today is data. So to date, we've analyzed a little over 570 million internet devices. So that is a key piece that powers Kai, which is our fraud prevention tool. Next slide, Josh. So a lot of people ask us, what is a digital marketplace? So you'll notice here it very much mimics a stock market relationship. So you have sellers, which are the audience owners or website owners. So think ESPN.com, FoxNews.com. And on the other side, you have the buyers who are going to be the digital advertisers. So these are global brands like Procter & Gamble, Visa, Ford, et cetera. The relationship at the bottom gives an example of what our technology empowers. So you have the website, you have the publisher site. When that page loads, there's a real-time bidding process. So we allow all of these different advertisers to, bid on the advertisement space, and the end result is an ad for Nike being placed on the website. Next slide, Josh. The interesting part about our industry is, although this is, hundreds of millions of dollars being spent, the world's largest brands are participating. All of this happens within a 300 millisecond window of time. So I won't go through each step of the process, but just to visualize it, when ESPN.com loads, the clock starts, and there's a 300 millisecond window of time before the advertisement has to be placed on that site. So you're going to have multiple technologies, multiple platforms communicating with each other, trying to identify who's on that website and placing an ad on that website. So Kubient's technology was built to operate within that 300 milliseconds. It is really the only democratic piece of our entire industry. Amazon knows everything you're buying. Google knows everything you're searching. Facebook knows your dog's name and your wife's pet name. So Kubient knew that if we were going to make a difference in this industry, we had to build technology that operates within that 300 milliseconds. Next slide, Josh. As most of you are aware, digital advertising is growing year over year. Brands are basically moving from this traditional print advertising and focusing more on reaching their audience across all of their digital devices. So the growth of mobile, the growth of connected televisions, and obviously more and more people are coming online every day. In 2020, the 385 billion being spent, that's kind of a small number compared to where the market's going over the next few years. By 2023, the expectation is that a little over $517 billion will be spent on digital advertising. And one of the key things to recognize on this slide is the red metric continuously going down. So that's traditional ad spending is going down year over year, while digital advertising continues to grow. With this growth, there's obviously problems that will arise. One of the biggest ones that we're addressing is digital ad fraud. So in 2019, a little over $42 billion was lost to digital ad fraud. The Department of Homeland Security estimates by 2025, digital ad fraud will be one of the top 5 global crimes in the world. And it's expected that a little over $100 billion will be lost by digital advertisers by 2023. So criminals are creating bots that are little pieces of code that go all over the internet. All of these bots, they pick up fingerprints, they pick up personas, and those bots then are directed to websites controlled by the criminals, and advertisers run ads on those websites. The issue is that the bots, they're never buying a car. So when Ford runs an ad, there's no chance of them getting a return on that advertisement. One of the other bigger challenges that we're solving is around fragmentation. When Ford wants to run an advertisement, they're typically using 6 to 7 different vendors before their advertisement reaches their audience. So in a typical example, you're going to see Ford work with their agency, who has an agency trading desk, who plugs into what's called a DSP or demand side platform, a company like a Trade Desk or a MediaMath, who's then plugged into an SSP or a supply side platform like a Magnite or a Rubicon, et cetera. The challenge is the brands are only getting about 30 to 40% of each dollar spent on digital advertising. The rest is being captured by all of these middlemen. What we're able to do is use our technology to optimize this marketplace. One of our key clients is the AP. We're able to plug in Kubient's technology. We're able to actually show how we returned over 50% on their, Josh, your screen's overlaying here. We were able to return 50% on their digital revenue. So this is a repeatable process that we can do over and over with different publishers. Next slide, Josh. How do we do it? We have proprietary technology that runs a digital auction. We have machine learning that operates within that auction process. So other vendors are using machine learning, but they all use it outside of that 300 millisecond window, and they're identifying the fraud after it's already been purchased. Our product prevents the digital ad fraud before it's purchased. Next slide, Josh. So we talk a lot about digital ad fraud. It's really the opportunity to address 42 billion. Right now we've run 2 beta tests and we're able to reduce the digital ad fraud.
Sorry about that.
2020 problems. No worries. 2020 problems. My dog always does that. Josh, I'll let you take it.
Yeah, no worries. So digital ad fraud, as Paul has mentioned, multiple times, it's a $42 billion problem. Kai, which stands for Kubient Artificial Intelligence, is our solution to that problem. The way Kai differentiates itself from all of the other competitors out there is that it's the industry's first ad fraud tool that is utilized in the pre-bid portion of the ad. So as opposed to some of the other incumbents that are out there, where the artificial intelligence is being applied after the auction has already taken place, and as a result of that, the funds have already been spent on fraudulent traffic. So this is really where Kubient's technology really differentiates itself from our competitors. And continuing with Kai, Kai, the beauty of Kai is having this Kai's fraud index, which allows us to see in real time the various brands and partners that are transacting with fraudulent digital ad fraud, and the ability for Kubient to show that data to those brands and to those buyers of the fraudulent traffic is what's really allowing us to start gaining market share and getting conversations with these brands to start talking about how they could utilize Kai for addressing their digital ad fraud problem. And with that, we will conclude our presentation. I would like to open the floor up for any questions if there are any.
Yep, I did see one come through the chat. It seems your beta testing of Kai was most of your Q1 revenue. Can you expect going forward to grow that revenue for when the product goes live?
So I will obviously answer that question to the extent that I can. Yes, naturally, we had our successful beta revenue in Q1. Naturally, beta revenue is just that. It was us testing. So we would not expect to have beta revenue going forward, but we would expect to see revenue related to our ability to sell Kai as a standalone isolated product.
Fantastic. Really impressive product, guys. 300 milliseconds and $100 billion problem. Color me impressed. Josh, Paul, really pleasure to have you guys. Really excited to see where Kai goes, where Kubient, takes us digitally. So I appreciate your time. Please do reach out. Where can we find you?
Sure. So you can reach us at info@kubient.com. Obviously we'd love to hear any questions you might have, any feedback. We really thrive on the feedback from the community, from the investment community. So happy to hear from everyone.
Perfect. Awesome. Again, Paul, Josh, pleasure having you guys. Stay healthy. We'll definitely be talking to you guys again very soon.
Thanks a lot. Have a great day, everyone.
Take care.
Thank you. All right. Awesome company, Kubient. Wow. So let's keep moving. We're going on to a very cool company, Emerald Bioscience. They are listed on the OTC. Their ticker is EMBI. And today we have Punit Dhillon, the CEO and chair of Emerald Bioscience with us. Is it Punit?
That's right.
I think I said it. Punit.
Yes,
okay.
Punit.
Definitely said it wrong the first time.
No.
So I'm going to let you take it away, my friend.
Hey, Elliot. Well, thanks for having us on the conference, and good afternoon for everyone on the East Coast. We wanted to welcome you to the Emerald Bioscience story. I'll be making some. Everyone can see my slides, so I'm going to be advancing them myself. I'll be making some forward-looking statements. I should just want to double check. Is this in my control? Yeah. Okay, here it works. I'll be making forward-looking statements, so please refer to our risk factors and in our SEC filings, as well as I'm going to be making updates for delays related to the COVID-19 pandemic as well. So, our risk factors will take into account that. So first, this is a pivotal moment for being an investor or partaking as an investor in Emerald Bioscience. On the macro level, we're developing a proprietary first-in-class set of molecules to treat a wide range of diseases in unmet medical needs. But today, for the presentation, we're going to really take you through our lead program, some of the large opportunity around what we're currently focused on, as well as go into a little bit of the science, and we'll round it out with what are the upcoming milestones that can see a change in from a value inflection point for the company. Like all biotechs, there are a certain amount of building blocks that are necessary for success. First, I'll say that we are aligned with a partnership and license with the University of Mississippi. So these are licenses. The molecules that we're developing are an exclusive all fields license. We have a very novel technology. It's a unique formulation and a unique manufacturing process for these pharmaceutical grade molecules. From an intellectual property standpoint, there are over 22 patents granted for THC, over 5 for CBD, including several that are pending. Like I mentioned, this is an exclusive all fields license that we have with our collaboration with University of Mississippi. We're tackling large market opportunities. Currently, the pipeline is centered around ocular opportunities, but it doesn't preclude us from going after other unmet medical needs. We'll be focusing a majority of our attention today on the lead program, which is focused on glaucoma. And that's where we have a set of important milestones, I think, that really change the value component of this story in the short term. It's been a preclinical story, and it's rapidly moving into a clinical story with several phase 1 enabling studies that are underway. That'll be we're expecting data in between Q1 and Q2 that enables us to move into human studies by Q3. And we're really working with an entirely renewed team. I'm the CEO, and I've recently joined the organization in August of 2020, where we've been able to pull together a very clear development plan for both of our molecules, as well as have a completely new team from a clinical and non-clinical perspective, as well as supporting functions on BD and G&A. So just talking about one of the main areas that we're developing a drug for is glaucoma. It's characterized by irreversible vision loss. It's a huge market in terms of the global incidence of glaucoma. We've in the right side of the slide, you can see kind of just from a visual perspective of what that degradation of vision looks like. From a mechanism and pathology, there's basically kind of 3 ways you can just characterize this. Normal eye has very good flow and ability to drain the fluid that makes the eye functional. So that's characterized under this first diagram, where you see this arrow having the right fluid channels. In glaucoma, that canal gets blocked, and that's what's ending up to crush these important retinal ganglion cells that are critical for vision, as well as the optic nerve. And you can see that increased fluid buildup and ends up creating pressure and really affecting the end result of what we're seeing with intraocular pressure and then glaucoma. So we see a huge opportunity, or an opportunity with cannabinoids being a potential avenue for treatment of glaucoma for a variety of reasons. There's already historical data that shows that the eye, which is prolific with these cannabinoid receptors, has been able to show the THC and other cannabinoids have been able to show a lowering of intraocular pressure. And this is a summary of just several handful of studies that show with inhalation of THC being able to lower IOP. Of course, we're developing a pharmaceutical drug. So here's where the kind of differentiation really already starts to show, is that with studies up until now, we can see the kind of limited effect and the decrease, but where we are expecting that THC pharmaceutically derived can really improve the bioavailability and specific mechanism that really provides that consistent effect that we're expecting with our drugs. I'm just I'm going to summarize here from the sorry, just 1 second, just moving back. So when you look at the cannabinoid studies up until now, the challenges of the previous cannabinoids have been that they have poor bioavailability, so that's really poor absorption. They require significant inhalation of smoked or ingested cannabis, which isn't really ideal for a pharmaceutical, and the duration doesn't really last very long. And that's where we're really trying to, what I was getting at is that the pharmaceutical application of these approaches really helps to build that consistency where you're seeing the right therapeutic effect related to management of a disease, and that's the important thing that we're doing with our unique molecule. So we've created a rational kind of drug design. It's referred to as prodrug, where we've taken the THC molecule and modified it to add a new component called valine hemisuccinate. It's an amide ester bond that basically is able to help us get inside the target organ, in this case the eye. So it has a very strong characteristics of absorption, and then that VALHS component, the valine hemisuccinate component, cleaves and allowing the THC, the active form of the molecule, to do its necessary function. So this is a novel approach. It's patented, and we're not only capable of delivering it to the eye, but you can formulate it for other applications as well. And this is a slide that just summarizes how this molecule is characterized and compared when you use it in glaucoma or in a specific model to test how we lower intraocular pressure. So we've done a head-to-head comparison of THC, VALHS against two of the leading drugs. One is known as latanoprost, and the other is known as timolol. And we've shown that the comparison between THC against the most prescribed drugs helps to reduce intraocular pressure. In fact, it shows that it's longer than latanoprost. So the duration is longer, and we've also been able to show, based on repeat dosing for 5 days, that it has the same superiority to the latanoprost. So there, that's the key kind of component here, is that we're able to show a superior duration of activity, but we can also lower the dosing with our drug, and that's what we're hoping to demonstrate in our clinical studies. Beyond what we've discussed, and from an intraocular pressure perspective, there is a large opportunity of glaucoma that's unrelated to IOP, and that's with the degradation of the optic nerve. So we can go after that opportunity as well. There's a large market in Asia, in terms of India and China representing a pretty large population of this type of class of glaucoma. So beyond going after just a mechanism that we've shown, what the significant opportunity is going after the neuroprotection elements of IOP. And cannabinoids have been able to demonstrate the neuroprotection as well. So that's one of the key preclinical studies that we'll be working on leading into the human study. And we hope that helps continue to differentiate our molecule. Over the last 90 days, our team's been very focused on developing a clear plan that gets us into the clinic at an accelerated pace. There are several preclinical and phase 1 enabling studies that we expect to conclude in Q1 and Q2 that enables us to get into human trials by Q3 of 21. And we expect that we would have data as early as first quarter of 2022. So just in terms of key takeaways, we've been in a short time frame, we know that based on previous information that's already been published, that THC lowers intraocular pressure. We're approaching it in a novel way with a pharmaceutical drug, and we've been able to show greater IOP lowering than the market-leading therapeutics. We know that cannabinoids can have neuroprotective properties, and we're looking to demonstrate that with a study. We've been able to improve the application of this drug in a controlled model where you limit systemic exposure, which is the challenges with inhalation of large quantities of THC. You're getting the other effects that are not necessary when we're tackling a specific disease. We have the ability to address neuroprotection, and we're focusing on a range of different preclinical data that is going to allow us to get into the clinic by middle of 2021. So this team that is helping accomplish that is all experienced. We've done this in different companies. I've recently was the founder and CEO of Oncosec, and I moved into this cannabinoid space a little over a year ago with Emerald Health Sciences, and was a part of the group that helped to evaluate Emerald Biosciences and acquisition.
Hey, Puneet, we're actually going to have to finish up here. Can you tell people where to find you? I think they definitely should research the rest of this team as well, but maybe just a quick website and email.
Yeah, so our email is just on the last page here, ir@emeraldbio.life, and our website is emeraldbio.life.
Perfect. Puneet, we really appreciate you being here. Fascinating presentation for a major health problem at a lower dosage. Very impressive. Really appreciate you all, and looking forward to continuing to follow you.
Hey, thanks so much, Elliot. Thanks for having us.
Thank you. Okay. All right. Again, thank you to Puneet and Emerald Bioscience. They are on the OTC EMBI. Moving on to the next presentation with our good friend Neil Seaman with ReWe. Very cool data play listed on the OTC as well. RWCRF. Neil, are you there, sir?
Yes, I am, Elliot. Can you hear me okay?
I can hear you. If you want to turn your video on, you're more than welcome to, but we do see your screen and I'll let you get to it.
Great. Thank you, Elliot. My name is Neil Seaman. Thank you. I'm the founder and CEO of ReWe. ReWe stands for Real-Time Interactive Worldwide Intelligence. We conduct multi-country surveys, digital ad tests and campaigns, and collect a continuous stream of data that can be used for prediction, monitoring, and risk evaluation in any country. We sell customers our data and sometimes plug into data platform companies that resell our data. We make our money through monthly subscriptions and long-term agreements to enterprise clients in the finance sector, the international security sector, and the humanitarian aid sector. All these sectors have really big data gaps that only ReWe can solve, and I'm here to tell you a bit about why. I'll also talk about innovation and growth in our sector in 2020, which is very different than 2019. Slide 2 is our forward-looking caution slide. The curveballs from COVID are important to note. And for us, the main challenge has been meeting our clients where they are, which has meant some interruptions in project starts and receivables. I'm very happy to report our clients have been resilient. In my view, the real Hollywood story of 2020 is the astonishing genius and ingenuity of Dr. Ur Shaheen, CEO of BioNTech, who created the Pfizer-BioNTech vaccine. Shaheen convinced his whole staff, his investors, then Pfizer to switch away from cancer to COVID. The world thought he was completely crazy to say he could get the vaccine approved in 2020. A lot of people I find in the financial media today talk about the pivot, but Shaheen kept his eyes on the prize. His technology was the same, his vision was the same. The only thing that pivoted was the disease. A lot about this year for me has been inspired by Dr. Shaheen. At REWE, our systems and technologies can address a diverse range of data problem sets. A significant portion of our revenues this year are COVID related. We worked hard to partner with the right companies that know how to ingest our data sets and sell them to clients who value them around the world. One of these end clients is one of the largest research-focused pharma firms. What Dr. Shaheen knows, and what we also know, is that innovation only matters if you can sell and distribute it widely. This is why we promise to invest in salespeople, partners, and sales-focused marketing this year. We are unwavering in our commitment to intelligent growth. One of the many ways in which our unique data streams are contributing to understanding global recovery now is by tracking vaccine skepticism and uptake. A version of this graph was written up in a report by our client, a major US bank. I've also presented on this with partners at Emory University. The reason so many diverse clients need these types of REWE social and behavioral conditions data is because REWE offers differentiated insight into what's called the last mile problem, which is vaccine uptake. The legendary vaccinologist Walter Orenstein, quoted at the top of this slide, has a dictum that states, "Vaccines don't save lives, vaccinations do." And vaccinations, as many have pointed out, move at the speed of trust. Trust changes fast. So imagine if you could quantify trust in public health officials, vaccine distributors, vaccine makers, and do that every day, every minute, in every country. These unique data sets REWE offers are now being used by epidemiologists in public health and by mathematicians and by economists at multilateral organizations to predict both public health resilience and economic recovery. What's the core customer premise of REWE? It's that every voice counts. And we know that by measuring what we call quiet voices, going beyond just the people who post strong pro-vax or anti-vax sentiment online, going beyond the people who just answer online panels that come into your email box, you can get at the truth concerning predictions of economic recovery. You can access the broad voices of people whose behaviors and consumer purchase decisions matter to clients in every sector and every country. Things like anonymity and randomization of our global access to quiet voices matters urgently to our clients, all of whom are not satisfied with good enough data, but instead need REWE data to make critical decisions, like how to target and modify a message campaign to end violence against girls, or how and why to risk adjust the investment portfolio of thousands of clients. So first, our data are more reliable. We are among the only data firms in the world to consistently, every day since September 8th, say with absolute conviction that there would not be a big blue wave in the US 2020 election. That is what we were tasked to investigate for financial clients in 3 continents. We are recognized for discrediting the legacy polling industry for what they're reticent to admit, which is that their tools and instruments to understand voters' changing minds cannot be easily fixed or modeled. Only an accurate machine learning system like REWE can expunge human bias. Our continuous data offers more insights and can be mashed up with open data sets to understand not only what is happening, but why it's happening. For example, if air travel to one destination is picking up very fast versus another destination, and you can only use REWE to properly compare travel path future destination trends reliably, then you can make a stronger bet on the underlying assets at some locations or airports versus others. And imagine doing this with a wide variety of asset classes in every country. And data security matters more than ever today. Since we only collect anonymous data, no cyber criminals can re-identify the people who answer our sensitive questions. More business over time is a core marker of success for us. So is profit and cash in the bank. Accretive greater value to all shareholders is what matters. The 2020 economy requires agility. You enjoy agility if you have cash in the bank from operations, profit, and you are dedicated to a winning business strategy, like investing in sales growth initiatives. So that is what we're doing, and that's what we're being celebrated for. Our jobs layoffs data conducted with Cornell University and Westwood Capital, where you see a client testimonial here, was predictive of the fall jobs data in the United States and generated an intense policy debate in Washington, D.C. about the degree to which the enduring labor market grief among some should be alleviated with more government fiscal support. Here on slide 9, you see another REWE just released study in cooperation with 10 universities and various media outlets and led by the Toronto Star. We embarked on collecting self-reported rates of mental health challenges among university students across North America. It's never been done before. Understanding who's suffering and why and what to do about it with targeted low-cost interventions can help save lives and learn truths we didn't know before. Here on this graph, you see real-time tracking of university students whose self-reported mental health challenges are rising post-COVID to alarming levels. Data neutrality and truth depend on the detection power of your machine. The REWE machine learns every day and functions based on people stumbling into a REWE-controlled web domain that is no longer, nor ever was, commercially active. There are hundreds of millions of these domains. They change and rise in number every day on any device. They may arrive at you from broken links to hypertext on financial blogs or media you read. We then geolocate using math tools embedded in the machine. You anonymously choose to respond. The audience is representative, exceptionally diverse, and random as the response data get fed into our database, which can then be adjusted into any data format for easy 24/7 usage by our clients. Since we're now enterprise-grade privacy secure in all countries, we are qualified for contracts that other data collection firms are not. And since we collect data using our proven methodology in random sets of individuals, we've had our data used in EU court cases. We have regular ethics approvals or exemptions at top universities across the world for which we work. And we're leveraged by one G7 central bank and varied government agencies with strong positive performance reviews. So we stopped counting at around 1.6 billion. At least this many people have responded to REWE surveys or ad tests, providing us some response data of value. We know why they respond. We know the internet makeup of respondents in any country, and we've been doing this long before we fully commercialized in 2017. So for a total of 10 years now. This accumulated knowledge, well beyond our intellectual property that we have patented, has given us market secrets and methods that are always improving to increase our access and precision in different countries and to lower the cost associated with sales over time. Our reach expands as the digital content on the web grows. So on slide 12, in this quote from Peter Thiel, another person who inspires me, is something else that has changed in 2020 in all aspects of the data business that we're in, and I suspect in many other industries as well. So first, in the data sector, we cannot rely on lagging official economic indicators like official unemployment data. High-frequency REWE data solutions are replacing stale-dated household surveys among central banks and at hedge funds. Second, we do need to understand the true state of China's economy now. There's no choice. What the Chinese consumer says and invests in affects US equities and US exports and many aspects of global macro finance, and REWE tracks these data. Third, data from legacy survey methods like political opinion polling using panels or voter databases are unhelpful or unproductive. I've seen no credible defense of traditional polling after the November elections. Fourth, Data anonymity is critical for data transfer, data storage, and data integrity. And fifth, dear to my heart, quiet voices that RIWI uniquely tracks matter more today than ever. So at RIWI, we love profit for all the reasons I've mentioned. By our Q3 quarter end, we had exceeded our revenues for all of 2019. And we continue to note to our investors that our business is best evaluated on an annual basis. And I continue to stress to everyone in our company that this year, even now on December 9th, is far from over. Every new deal signed, every new logo, every sales call, and a relentless focus on sales and sales partnership activity only produces good things. We capture value in ways that serve us through good times and bad, as this year has shown. It's important to think forward and to make a bet on RIWI by evaluating core financial metrics and qualitative metrics. Management reputation and management focus is essential. So what I present here are not only what we have done, but also what we believe in as being important to enduring still greater value. So on fundamentals, we've been profitable in 2018, profitable in 2019, and so far in 2020. It's rare for a technology company. We have a clean balance sheet with no debt, increasing proven and peer-reviewed technology with growing global recognition. Sustainability, that means for us, we have high operating leverage. Over 90% of our business is recurring revenue in nature through subscriptions and long-term agreements. Top tier clients, we have 2 positive performance reviews by the US government, and recently 2 renewals of 3-year agreements cemented just this past summer, one with a major US bank and another with a global multilateral. Optionality of our offerings. So we have patented technology enabling a wide range of agile global data product offerings. We have significant competitive advantages and barriers to entry. And RIWI can blend its data with other data streams to meet new customer needs. Here you find our key corporate information as of today. We've kept our share cap tight. We've raised the right money at the right time. Management and directors are aligned in mission, vision, purpose, and monetarily to assure value gain to all shareholders. So our CFO, Daniel Im, would be happy to connect with participants to make arrangements for further information. Thank you for listening to an overview of the RIWI story and our unique and growing value proposition in the global data marketplace. So for more information, also please visit riwi.com. Thank you.
Neil, thank you so much. And with so much of our business at Benzinga, I mean, being driven by analytics and numbers, I mean, I absolutely love what you're saying. I love that comment too about, the polling, replacing or outperforming the polling. Again, guys, the ticker RIWI, it's Romeo India Whiskey India. And before we go ahead and hop into our next panel, you guys, you all know that I am a sucker for the giveaways. I love doing the giveaways, especially because we have such a big community out there that's engaged with us, that likes spending time with us. So it's a little thing that we can do to give back. So on deck, what we have now, we've got a 1-year subscription to Benzinga Options. What that is, 3 times a week, you are getting options ideas, you're getting options education. It's what I think is one of the best options products out there. Everything from just starting off with buying calls through figuring out how to use spreads. The winner is, drumroll, VM Stuff. If your email starts with VM, email events@benzinga.com, you are on the clock. You have 10 minutes. Again, if your email starts with VM, email events@benzinga.com to claim your prize. You are on the clock. All right, guys, next up, we've got a super relevant panel brought to us by Markham. And again, I want to remind everybody that this whole day wouldn't be possible without Markham, who's leading the charge for us and helping us to get our feet wet here. But it's the guide to going public. I mean, with so many interesting IPOs that we've had this year, I mean, it's super, super compelling panel for us. I want to introduce you all to our moderator, David Buckshin. David, I will let you go ahead and take it away. Super happy to have you here.
Okay. Well, thank you. It's nice to be presenting on today's topic, the capital markets, your guide to going public. We're thrilled to always do anything with Benzinga They've really always put together a stellar panels and interesting topics, and we're proud to be a national sponsor of almost all their events. So just to introduce myself and our esteemed panel, my name, as you know, is David Buxton. I sit as the Vice Chairman of Markham and in charge of our capital markets practice. Markham currently sits as the 6th largest auditor of public companies in the United States. We also represent companies going public in Canada and elsewhere throughout the world. We are also a leader in the SPAC product, having completed over 150 SPAC IPOs since 2015. And as a matter of fact, other than the big four, every year we do more IPOs than any other accounting firm in the United States. With that as a framework, we spend a lot of time talking to young companies that are thinking about accessing the public markets. So we've put a great panel together to talk about that process. Panel into three. I know we have a limited time, but we're going to divide the panel into 3 sections. One is talking a little bit about prepping to go public. The second is discussing options for going public, because there are certainly more options today than there has been maybe ever. And finally, what is the outlook for the coming year? So I will let my co-panelists introduce themselves. We'll start with Nico Pronk. Nico?
Might be muted there, Nico. Yeah, Nico, I think you're still on mute there, my friend.
I'm on mute. Okay, thank you. Thank you, David, for the introduction. Pleased to participate in the panel today. I'm Nico Pronk, CEO of Noble Capital Markets. We're a 35-year-old boutique investment bank focused on the small and micro cap equity side of the capital markets. Been here since 1988, and we've raised billions of dollars over the years in growth capital for companies, both through public offerings and follow-on offerings. Back to you, Dave.
Phenomenal. I'll next introduce Jack Cassell from NASDAQ.
Thanks, Dave. Jack Castle here. I sit in our San Francisco office at NASDAQ and oversee our IPO business for the Western US, as well as our private market business globally. So been here for about 3 years, investment banker prior to that. And prior to that was a professional baseball player for a number of years. So if this dovetails from IPOs to sports, I'm all in.
Phenomenal. Well, I can certainly tell you in the SPAC market, Jack, that we are seeing a lot of SPACs targeting sports teams, sports-related industries. And as a matter of fact, we just were involved in taking the Hall of Fame Village, the Football Hall of Fame public through a SPAC. So it could very well dovetail there.
Yeah, great.
And finally, Jamie Mercer from Shepherd Mullen.
Hi, Jamie Mercer, Shepherd Mullen. I co-chair our public company practice and have been doing it for 30 years. So happy to be here.
Outstanding, outstanding. So, of course, when we're thinking about the public markets, you know, when you decide to go public, you go from one business to 2 businesses. The business of whatever you're in, let's call it making widgets, and the business of being public. So when you're thinking about that second business, if you will, you really got to spend a lot of time focusing on prepping to go public and the impact to your organization. So my first question is for Nico, and then anyone who has additional commentary, certainly chime in. Nico, when you're talking to private companies, what are you telling private company CEOs what they should be most concerned about when considering a public listing?
Well, there are a couple of items, but the ones that are on top of the list for us to cover and making sure that these management teams are well informed before they make the plunge or to take the plunge, is really the time involved in prepping for a public offering and the cost involved. And then after that, what we believe is extremely important is transparency. Going public means more transparency, more disclosure requirements, and sometimes that can have effects on companies from a competitive perspective. So these companies really need to think that through thoroughly and to discuss that with their professional advisors before they take the going public round. The other one that's very important to me is engaging with the right professionals, be it the SEC attorney, the accountants, or the investment bankers, or a transfer agent. You want to go with folks that have done it before and that are well versed in your industry, so they can add value not only during the process of going public, but as well as in the aftermarket, once the company is publicly traded. And that's really leading me to the most important warnings that we or not warnings, cautionary advice that we have for these management teams is, buyer beware, because once you're public, you take on another job. It's no longer marketing your products, it's marketing to a whole new customer, and that's called your shareholders or prospective new shareholders. And that requires a lot of time, and depending on the size of your company and the depth of your organization, with the smaller microcap type companies, oftentimes it falls on the shoulders of the CFO and the CEO, and that could be a major distraction as it relates to the day-to-day execution of the business. And studies have been done on this over the years, where you sometimes see a deterioration of the results of a company post IPO, which is directly correlated with the intense process that's called the IPO process. So these are kind of the concerns that we share with the management teams that they should consider before making the decision.
Yeah, Nico, I'm sure you, and certainly you and I go back many years, I'm sure you see lots of companies come into you, and everybody wants to be public because it sounds great. You could get liquidity in your company, you can raise additional capital, but what are some of the key criteria you see for maybe in terms of a minimal size of their market value, public company comparables? What is some of the kind of the data that you kind of look at when you're kind of thinking about telling a company, it's not right for you, come back in a couple of years, or this is something we got to do?
Yeah, I mean, it really varies from company to company, industry to industry. It's really unique for each potential company that wants to go public. But generally speaking, we like to see a public float of about $100 million, to get some institutional interest in the stock. It's difficult, to attract institutional investors when your float is below $100 million. If it is lower than that, we really want to see a situation where there are near-term inflection points that could substantially raise the market cap of that company, whereby you can get institutions involved in a 6 to 12 month period after an IPO or an APO for that matter. So every company is unique. We've taken companies public with a $40 million market cap, and we've taken companies public with a $500 million market cap. It really depends on the characteristics of the company, as well as as the appetite in the capital markets. Right now, things are flowing very well. There's a lot of liquidity there. A lot of people are chasing those new deals, but that's not always the case. So you have to be sensitive to to the appetite in the markets, and advise your clients surrounding all these different variables.
Well, that's real good insight. And I know that from what I recall, Noble and you have a particular specialty, I think, in life sciences, med tech, and pharma, which has certainly been on a bit of a run, certainly with everything with COVID. What other industries are you seeing recently that that are getting the recognition and the investors are clamoring to see the product it's available to invest in?
Well, life sciences, as you said, is a very good area to be in right now. as well as technology, and more specifically within technology, anything surrounding green technologies or these electric vehicles, battery manufacturers. That broader group of companies is currently attracting a lot of investor interest, and a lot of capital is flowing into that group. The other sector of technology or subsector of technologies are the do it at home stocks, right? And we've seen that throughout the pandemic, with the capital that has been flowing into companies like Zoom and others. And there are other companies that were VC backed, that are now coming out of the closet and taking advantage of this market opportunity to tip their toe in the public company waters.
We're actually seeing, I don't know if you're seeing this, but we're seeing a lot of food, specialty food, stuff that you would never think is getting investor interest, but there's been a number of deals that have gone public recently. Tattooed Chef, some other things that are really piquing investor interest. So we're seeing a lot of that. I want to throw a question over to Jamie. Jamie, when do you need to get the lawyers involved in a going public process? How much cleanup work and other things do you need to do in advance to get these companies ready for prime time?
Yeah, I guess my answer would be early and probably a few months before you're going to start your formal process. I mean, most people will think of the lawyer's role in the process as being putting the registration statement together, helping the company tell the story, responding to SEC comments and questions to get the registration statement effective. But there are a couple of other things that we'll do behind the scenes. And to Nico's point, when you're in the process, you're already busy. So if you can get these things done ahead of time, you're better off. To get listed on Jack's exchange, you're going to have certain corporate governance pieces in place, right? You're going to need independent directors. You're going to have to form certain committees. That process, the paperwork doesn't take that long, but putting together the thought about who should be on the board, what skill sets and technical acumen you need, that may take a little bit of advanced planning. Also, by the time we get over to Nico and his team to kind of take you out, they're going to need to do a due diligence review. So you're going to set up a data room for your company. And better to have somebody on your legal side go through that data room, help you get organized, fill in any missing gaps, anticipate any problems or concerns or risk areas, and at least have your answers or explanations ready ahead of time so that when Nico and his team does come in, you can put your best foot forward in terms of presenting the company as a well-oiled machine, ready to go and ready to launch.
Dave, you're on mute.
Sorry about that. That's great insight. We're actually prepping a company to go public right now. And while they thought they did a great job with growing their revenue base and building out their market, they did a lousy job documenting their entire capital structure, option grants, equity infusions, and all that kind of stuff. I mean, is that one of the gating items that you see often, Jamie, is that they just didn't dot their I's and cross their T's in some of this core paperwork?
Yeah, absolutely. And as you say, if you've got multiple rounds of financing and if you've got derivative instruments out, you may want to take actions to clean all that stuff up before you're in a process and you've got things going. Yeah, no question.
So, as Nico mentioned, these days, technology, life science, and other things are the hot companies, and certainly in the microcap space, probably 50 to 60% of everything that's going public these days. Where, for those people that are participants in our seminar today that might be in that industry, where are the usual, from a legal perspective, gotcha moments? Where do these companies seem to trip up? And what's the key advice that you could give them to kind of cover first and make sure you got that out of the way?
I think capital structure is certainly one of them. You're also going to have to, as part of the process, publish all agreements between executives in the company. So employment agreements, compensation arrangements, you want to kind of clean house on those things. You will want to do background checks on your directors and make sure that your team members are clean, because part of the process for getting on NASDAQ is going to involve background checks on individuals. From a commercial standpoint, the biggest issues I would have are if you've got kind of dependencies on single source solutions. If your business is predicated upon a license from a single vendor, a Qualcomm, or somebody who has kind of essential patents for your field, then making sure that your arrangements around those are clean so that you don't have to describe a risk that, hey, we're utterly dependent on this one issue. And if this goes bad, we're in a bad way. So those are the things that I most often deal with.
Phenomenal. And Jack, over to you. As we kind of have highlighted in the first two panelists, technology and life sciences are kind of what's kind of going on, and there's no more acknowledged home for those kind of companies other than the NASDAQ. And for those listeners or viewers, if you will, that are participating today, how does NASDAQ engage and support private companies ahead of their IPO?
Yeah, so I think, as you heard from Jamie and Nico, I think we'd love to start a conversation with the companies and the management team as early in the process as it makes sense, right? So as you think of that timeline of from when the board or management team makes a decision to start to engage, typically people hold the exchange until the very end, but I will go on record saying we're open and welcome to have conversations earlier in that process. One of the key growth areas for us is really around our private market. So I think Jamie nailed it on the head. We see a lot of issuers and companies that have just a messy cap table, right? So you started with some friends and family, maybe some seed investors. Now you've hit your stride. You've brought in some institutional investments, maybe some venture capital or private equity, and you're getting to this point where now you're looking at your cap table and you're saying, okay, well, either one, it's a mess, or two, we have a lot of investors that are trying to get into the cap table prior to us going public. So at NASDAQ Private Market, we create structured liquidity programs for private stock to help companies run either tender offers or buyback programs. And we're seeing more actually around structured auctions ahead of an IPO. And this allows companies to, one, attract and retain talent. Many companies are staying private longer, as we've heard. We'll see if that continues through 21, as we're seeing such a rush to get out these days, the window being open. But it's allowing them to give liquidity to their tenured employees. It's allowing the executive team to actually get liquidity prior to an IPO, which typically you'll have about a 6-month lockup still is pretty common and enforced. And then again, it helps you to invest and clean up that cap table and bring in new investors into the company that hopefully share your vision and want to be part of this story with you. A second piece of this is also our governance business. So Jamie, again, nailed it around the board governance. That's such a growing issue and an important factor in going public. And it was typically unpopular, I should say, because it was seen as an obstacle or a process that kind of slows down the momentum of a company heading into that. But we've seen now a changing in the thought process that this is becoming very relevant and something that you should put in place prior to your IPO so that you don't get out into the market and all of a sudden become penalized for this or have to make a quick decision. It allows you, that timing allows you to do diligence on what your gaps are, what your needs are, and then who are the best candidates to join that board. So on that side, we actually are starting to offer board evaluations and assessments that help your board kind of find the opportunities to improve its effectiveness. And then there's also a lot around D&O questionnaires. So D&O, as I'm sure every CFO has experienced, or probably a lot of our attendees, the premiums are at all-time highs. And so we work with companies to understand kind of what are some of the alternatives, what are some of the processes in place that can help you to at least understand why, what is the process and why are those premiums there. So it's just more of an education piece. And then lastly, I just say at NASDAQ, we also have several indexes, including the NBI, the NASDAQ Biotech Index. So for any of the healthcare companies or biotech companies that are listing on our exchange, we work with them earlier in the process to ensure that they are in a position to qualify for our index, which typically takes a passive position of about 1% to 2% in the cap table post IPO. And so walking through what do you have to have in line, how do you qualify for this, and ensuring that you're able to be successful as a public company.
Phenomenal, and that's we appreciate that, and I wish we had more time on this panel because there's so many questions that I'm sure young issuers would like to get access to you about the questions about what is approaching NASDAQ to get listing. And one thing I thought you mentioned that was interesting, that companies are staying private longer. I would tell you what we're seeing now with the growth in the SPAC process, that it's incredible how many of these companies are now rushing to find partners. Nico, I have a question. Let's talk about the options for going public. And I mentioned SPACs. There are various going public strategies to consider today, whether it's the entrepreneurial IPO, the SPAC, the reverse merger, the self-filing, direct listing. What go-to-market strategy do you prefer? Or do you, how do you evaluate the choices for one of your clients?
Well, it really depends on the needs of the client, Dave. Needs from timing. If a client is really if speed is of the essence, an IPO is probably one of the better options. With some certainty that time frame, it can be controlled on a traditional IPO to some extent. So the general timelines that can be lived up to. A reverse merger or an APO, an alternative public offering, could be a really good option as well. That's not for everyone. Some people don't want to get involved with reverse mergers. They're good ones, and they're examples of good ones, and there are plenty of examples of bad ones as well. But a reverse merger could, in certain cases, be a faster go-to-market option for companies than the traditional IPO process. The SPAC market, as you alluded to, Dave, is red hot right now. There's a lot of capital being thrown at that right now. A lot of these vehicles are being listed every day, and it certainly needs all these SPACs need to find the right company right over time. But for us representing a company that is considering going public, going after these SPACs or getting in conversations with these SPACs, it's a very competitive process. It's not easy. Our investment banking team at Noble has worked with several companies over the last 12 months, entertaining the potential of merging with a SPAC, and in all of these cases, we've been wasting our time, wasting the company's time, and luckily, we went both routes, right? We looked at different alternatives at the same time, so it didn't hurt the company in the long run, other than the expenses that are involved with going multiple routes at the same time. But the SPAC market is very good right now. It definitely is an option. I think it's not for everyone. And some of the capital that we're seeing raised for the SPACs, you're talking about billions of dollars, right? And it's not so much for the micro cap companies or the low end of small cap.
'em.
Most of these SPACs are entertaining $1 billion+ market caps. And so, And that's the smaller side of the market, right? If you measure it in terms of transactions, not in terms of dollar volume, but in terms of transactions. The sandbox that we play in every day here at Noble are more the sub $500 million market cap companies. And for us, we've been most successful with the traditional IPOs and the alternative public offerings.
Yeah, I think you do make a couple of excellent points there. One is that the smallest SPAC, as for those who may know, is a $40 million raise. And the way the SPAC mechanics work, you always look for a target at least 3 times the size of the amount you raise. So the smallest SPACs, and there's not many $40 million SPACs out there, looking for a $120 million enterprise value company. The average size of SPACs these days is probably about 250 million. So to Nico's point, they're looking for $750 million in enterprise value or better. But the nice thing about also kind of touching on something else you said, the SPAC is the hybrid of a traditional IPO and a reverse merger. It's got the structure of a reverse merger, but the institutional and listing on an exchange that like a traditional IPO. The time is very tight here. And I do want to make sure to hear from everybody. So what I'd like to do is just jump ahead to hear from Jack. Jack, what do you think the outlook is for the capital markets for 21? And then leave enough time for Jamie and Nico to get a word in as well.
Yeah, I'll be brief. Look, we're still very bullish on 21. The number of deals that we're engaged with, the number of SPACs that we know are coming to market in at least Q1 through into Q2 and beyond, the number of operating companies that are coming to market that have mandates from the board to get out next year, and the number of bankers that are talking to a lot of these companies trying to pull them up. Hey, they were a second half deal or a Q4 deal. We're trying to pull them into that September timeframe or June timeframe. So across the board in our entire ecosystem, it does feel like there's a lot of momentum and volume of good quality companies that are now going to be coming to market next year.
Great. Jamie?
Yeah, I would echo that. And the pandemic situation has been so unusual, right? You would have expected things to slow down, and there are certainly winners and losers in this market. But overall, we've seen a tremendous volume of transactions. We've seen some things that are kind of helpful in the process, in that you don't seem to have the same August slowdown or December slowdown. I've got a company that's looking at possibly going public the week before Christmas, which you would never have done in prior years. And road shows are now virtual. There's much less travel. You can get to more people faster. There's some things about the process that they're actually very helpful. So like Jack, very bullish for 2021.
Great. Nico, some final thoughts?
Yeah, same here. We continue to be bullish as well. I think a lot of it is driven by the liquidity in the marketplace right now, and as long as the Fed keeps these rates near zero, I think there will be continued demand from the investor community for these new public offerings. So we're optimistic. Of course, valuations are being stretched in certain areas of the market, certain sectors. That is a little bit concerning, but I think the amount of liquidity out there makes me feel pretty comfortable going into next year, and for the full year actually to have a very robust public offering market.
Phenomenal. I would echo all of your sentiments that the liquidity in the marketplace, the direction of the share prices has created payoff for those management teams who really execute on their business plans. I'd like to take this time to thank Benzinga for putting this panel together. And it was enjoyable that we got about 30 minutes of a lot of data out there. And I'd like to thank my fellow panelists, Nico Pronk from Noble, Jamie Mercer from Shepherd Mullen, and Jack Castle from NASDAQ. Really enjoyed it. And everybody have a nice afternoon. Thank you.
And thank you to you, David, and the Markham team for being a part of this. Could not have done it without you guys. Thanks again, everybody. Definitely be talking to you soon. Stay healthy, all. All right. Wonderful panel. Super insightful. Tons of data. Obviously, 2021 is going to be a great year. Very excited for that. So let's move on to the next company that is moving into 2021, as we all are. Rob Ellen, the CEO of LiveX Live Media. They are listed on the NASDAQ at LIVX. Also joined by Norm Padiz, former founder and executive chairman of Podcast One. I probably butchered Norm's last name. Many apologies. But if we have you gentlemen here, I'm going to let you take it away.
Great. Thank you, everyone. Rob Ellen, CEO and founder of Live by Live. It's been an extraordinary year for Live by Live, in that we have built the foundation of one of the few platforms left in the world that has the ability to have mobile subscription across all of music and all the foundations of music, from audio to video to podcasting to pay-per-view. So with that, we've built very similar to my last companies, when I started i1.com or when I started Digital Turbine. We built on the foundation of world-class management teams. You're going to get to meet my partner, Norm Padiz, today. Unique technology that you can't get anywhere else, and original programming, right? That is the most robust live music platform offering in history. And so with that, we have built the flywheel to have the capability of having an artist-first, talent-first platform focus on fandom. And when I say focus on fandom, I'm talking about super fans. So what we've done is we built franchises, and we built the capabilities. You'll start with original programming, right? So you'll start at the top of the funnel with original programming and work your way to the commodity music that you'll get in that 30 million songs that we have. So with that, we are closing our fourth acquisition in the next couple of weeks, maybe earlier, which will give us the foundation that from start to finish, you'll have the opportunity to attend, listen, watch, engage, and transact, all for $5 a month in that range. So you have the capabilities here that we have put ourselves in a position that the consumer, right, that super fan, has the opportunity of not only listening to the best music in the world, but attending and watching. So with that, a couple of highlights for this year. We've now streamed 16 artists around the globe. We've had 5 billion engagements, meaning that super fans are repurposing and reposting our videos back on a Live by Live video, right, and telling their friends and family to watch. We've had, as of this week, we will pass 100 million live streams. We've had over 2.2 billion downloads of our podcasts and over 55 billion listens to our audio. We're about to pass 1 million paid monthly subscribers. Our revenues are ramping up. We've grown from 7 million to 38 million. We've just come out with our projections for this year and increased those to 63.5 to 69.5 million. And with the acquisition of CPS, we've added again to the immersive experience. So we built a social experience that while you're listening or watching, you get to message, chat, buy a hat, buy a t-shirt, buy specialty items, pay-per-view, virtual tickets. And as 5G comes along, that'll even expand dramatically. As that expands dramatically, you can have more capabilities that'll offer the same piece of content. You'll have more and more revenue streams off that same piece of content. Think of cable and satellite. Today, as you're watching the rebundling of media, we watched the debundling for the last 7 years. Now you're watching the rebundling. As you watch the rebundling and you see AOL and Warner and HBO come together, and Disney and Fox and Hulu come together, more and more of these platforms are going to look like cable and satellite. And our team's humble opinion is that every one of those platforms is going to must have live and must have music. With that, you're watching us announce distributors on a bi-weekly basis. We've announced partnerships across Roku, Xumo, 40 million Samsung TVs, Samsung phones. We have our own over-the-top channel, as well as we now launch across Sling TV. You're going to continue to see those distribution platforms grow, and every one of those platforms drives new revenues off the same content. Same thing on the sponsorship side. All right, it's kind of a self-fulfilling prophecy. The more traffic you have and the bigger your audience is, the more revenues you're going to drive. So with 100 million live streams and 5 billion engagements, you're going to continue to grow the number of subscribers, right? And then you're going to start to see that sponsorship. Today we announced Hyundai. It's literally been, it's so exciting to watch the sponsorship come in, and that sponsorship just hit our 23rd sponsor this year. AAA sponsors from MasterCard to Hyundai to Porsche to American Airlines to MasterCard, across all the verticals of sponsorship. And last year there were 4 sponsors. So as we get more and more robust and more content, that continues to grow. So you get the opportunity of hearing our content from your car all the way to your home, and you get to participate in subscription and sponsorship simultaneously. With that, I want to hand it off to my partner, who I'm proud to announce that we closed during COVID, Podcast One. And Norm, if you could in a minute, just give him a little bit of your background and why you joined the company.
Sure. Thanks, Rob. My background is almost 40 years ago. I founded Westwood One, which is the largest radio network in America. When I founded the company, I did it with one radio program, one syndicated radio program, one employee, me, in one room in Westwood, hence the name Westwood One. That company grew to generate over $600 million in advertiser-supported revenue with a market cap of around $4 billion at its peak. When I left Westwood One, intending simply to retire, I became aware of what was going on in the podcast market. And a mutual friend introduced me to our president, Kit Gray, who had been representing podcasts out of his apartment in Marina del Rey. And once I sat down with Kit, I thought, well, this is just the digital extension of what we were doing in the radio business, providing content to radio stations. But now we would be providing content to consumers without having to filter them through radio stations. I probably don't have to tell you that podcasting is a very hot space right now. As a matter of fact, yesterday I participated in a webinar on research that had been done by Edison Research that's available. We can provide it to you, on super listeners in podcasting and the effect of podcasting on the overall audio market. And it is extraordinary. Everything that we thought 9 years ago when we launched Podcast One is playing out today. It's becoming a dominant force in audio distribution. The reason that I liked, doing this deal with Rob is because with increasing competition in the marketplace, having a video option to include with our audio option puts us kind of in a class by ourselves. We're not just talking about podcasts now, we're talking about vodcasts, video podcasts, which we expect to be a growing piece of our business. And very much like Live by Live, Podcast One has always been artist-centric. Moving into the music business and music content in a more fulsome manner is something that's very appealing to me, because when I started Westwood One, it was basically a music company until it became a sports company and a talk radio company and a news company and everything else. So the game plan for the growth of Podcast One within Live by Live is very similar to the one we used to launch Westwood One, which eventually became, a public company and did extremely well, is now owned by Cumulus Broadcasting. And it just seemed like the natural move to make. It's an all stock deal. So me personally, I'm totally in. We were not interested in selling the company for cash. We were interested in seeing the company gain an advantage over the competition and seeing the company be able to grow, which you can in the public market because of having been the chairman of a public company for 30 years. I know the advantages as well as the disadvantages, but I certainly know the advantages of being a public company. So that's where we are. That's where I came from. And Rob, I'll throw it back to you.
Great. Thank you, Norm. And Norm's being humble. He's one of the icons in radio. He took his last company to over a $4.5 billion public company. We feel the same way here, except for the exciting part is that we have 4 verticals within one company. So as you look at audio, and Goldman Sachs just did a great video where music is going. They're going to be 1.2 billion paying subscribers of music. What we've said is we're going to hit 10 million subscribers in 5 years. And the exciting part is the talent drives all of our traffic. We spent a total of $1.5 million in marketing in full this year to drive over 100 million people and 5 billion engagements, right? And as the flywheel grows, the more traffic it grows, the more subscribers are coming in. But it's really the artists that are driving that because of their passion, right? These have become the next generation music videos. Second is on the podcasting side, we just about this year $1 billion industry. It's going to 10 billion. Right. And the same thing as you've all been watching with Over the Top, as you see the OTT, right, growing and expanding. So we have multiple different opportunities within the same company. And as you look at that, you're seeing that, all of that growth, all the metrics of this company is skyrocketing, right? 38 million to 63.5 to 69.5, right? As we close this next acquisition, right? If you annualize the current run rate and you add in our live business, next year is over $100 million without any growth. But we're really excited about where this is going. From 3 years ago, taking it public, we've not only survived COVID, but we've come out of it stronger than ever, and more excited about where the revenues, the bottom lines are going. So this is a really exciting time for the company, and really proud of our team and what we built and where it's growing. And with that, you're seeing more and more talent joining our network, from exclusive deals with Pitbull to Monster X to across just about Wiz Khalifa. We just did a pay-per-view for him this weekend. Every day is another live music event. We've had over 100 events this year, up from 38 last year. We've had over 1,600 artists, up from 240 last year. All right. And then on the stock side of it, higher, as you've probably seen in the 13D filings, all of the last, sort of 8 days. My largest shareholders have continued to grow their position. Fidelity, who funded most of the IPO, has grown their position over 10 million shares. Roe Capital, who found XM Radio and sold it Sirius for $2.3 billion, right, is up close to 7% company. So we're really excited about partnerships, and the same thing across the board. We're partners with just about everybody in music, from Sony to Universal to Warner to the biggest publishers. We have exclusive partnership with iHeart. The gentleman, Bob and John Sykes, who founded MTV, who are our partners, put all of their live music across our platform. We put Live Nation's music across our platform, and really have taken the ESPN model and followed the ESPN model, deliver that for music. And we've delivered is the first time in 25 years that authentic voice of music that has been missing across audio and video globally. And as you think about that immersive experience and the platforms that are out there, Sirius, Spotify, are trading at $50 and $60 billion valuations, right? We're one of 10 technologies left on Earth that has the capabilities and the technology and the partnerships right across the music industry that have those capabilities to deliver consumer the first ever truly focused authentic voice of music in 25 years that is really focused on fandom and driving those super fans. Those super fans are going to be the ones that are going to buy tickets as live music comes back. Our division, React Entertainment, which normally does 40 to 50 shows a month, as that comes back, we also have the largest EDM show in Chicago, right, called Spring Awakening. It'll be our 10-year anniversary. All right, as live music comes back and as we all come through these difficult times, we're the only company in the world that is positioned for both live and digital. The COVID has been difficult. It's been difficult on everyone, but it's been really exciting for this company because we had the opportunity to partner with Norman and acquire Podcast One, and we had the opportunity of truly building out our brand. All the brand built historically when we started i1.com, when we started Digital Turbine, right, which is now $3.9 billion valuation. It took 6-7 years to get that brand out there as an early stage company. And for all of you who focus on companies under $1 billion valuation, it takes time to get that brand out there. COVID has materialized our brand way earlier than we were truly ready. So we've become a global brand. We've become world renowned. We're going to continue to grow it. We're going to continue to add acquisitions, and really excited that looking at a 5-year window to get to 10 million subscribers, you're looking at $500 million in revenues plus sponsorship of another $400 or $500 million in revenues, and you can easily see where this could be $1 billion company in 5 years. So thank you everyone for attending. Thank you everyone for joining. Really a pleasure, and everyone.
Awesome. And Rob and Norm, I mean, absolutely amazing to have you guys here. As a fellow media company, I mean, we're watching what you guys are doing, and you're doing so many of the right things. And Norm, of course, an icon in the space. I mean, super honored to have you guys as a part of the conference.
Pleasure.
Thank you much.
All right. Thanks, guys. All right. To everyone out there, Zinger Nation, we actually have a new face to bring on the stream here. You've heard the rumors, but producer Shelby is here in the flesh, not just the voice. All right.
Looks
Shelby?
different from the side of the Zoom for sure.
Exactly. Yeah. You're on the other side of the Zoom now. And Shelby, I was told that you're going to be picking the next winner of our prize, of our giveaways.
Yeah, so this is for a $100 merch gift card. The winner is Manus. That stock was UIS. Again, UIS. So Manus, send an email to events@benzinga.com to claim your gift.
Woo! Air horn. We haven't air horn enough today. But all right, guys. Shelby, thank you so much for announcing our winner. And we're going to see more of you today. To everyone out there watching, again, I want to make the point that I was making all day yesterday. I haven't said it as much today. But if you truly want to find alpha in these markets, which is why we're all spending time to be involved in markets, again, it's about finding some of these small cap names. I mean, small caps have underperformed the S&P decade after decade after decade. And what we're doing today is we're giving you insight into these stocks before Wall Street finds out about them, but before they're big enough for hedge funds to invest in them. So I'm so glad you guys are here with us. You see this vision. And again, I mean, let's all go make some money together. Next up, we're going to be hopping into a little bit of education. We're going to be bringing on Brian Sapp of Schaefer's. If you guys could bring Brian onto the stream. There we go. I see you, Brian. You're muted, but happy to have you here, man.
Thanks for having me. Can you hear? Sound good?
You sound good, and you look even better.
Let's not get carried away.
All right, and before you get going, just a reminder, everyone out there, make sure you like and subscribe to the stream. All right, Brian, back to you. Take it away.
All right, thanks for that. To echo what you just said, we're going to talk about small caps today, and specifically, I'd like to talk about our small caps in a position to outperform going forward. And the answer to that is yes. In my mind, in my opinion, and I'm going to lay out a case for it here, and you can obviously be the judge from there. But a quick intro about me. I'm Brian Sapp, as you said. I'm a senior market strategist at Schaefer's Research. I've been with the company about 11 years, specialize in volatility trading and macro analysis with a deep dive into sentiment. That's always at the backdrop of what we like to do. So today we're going to look at recent index performance or index performance going back a decade and what's been going on in the last few months and why we think there's a situation where small caps could be really in a position to play catch up for the next few years. We're going to look at that in the context of the current sentiment backdrop and also with the seasonality trends that we have in place that are coming into the end of the year. And then lastly, I'm going to give you a few trade ideas that are actually components of the Russell 2000. So some small cap, long investment ideas. So if you look at this is the 10-year performance of the three major indices, the NASDAQ, the Russell, and the S&P. And if you notice, for the first maybe 5 years of the last decade, these indices all moved pretty closely together. And then starting in about late 2015, early 2016, you started to see a big divergence with the tech stocks, especially the mega cap tech stocks, where you had Apple and Amazon and Google and starting to do their thing and take over the universe, for lack of a better term. So that's obviously been the place to be. But with with anything like this, whenever the analogy that we like to use is a rubber band, whenever you stretch a rubber band so far, generally you get a snapback reaction that's pretty violent in the opposite direction. And these small caps have underperformed for some time. And it does seem to me that they are at a moment, at a juncture here to where they could, outperform in the near future. So this is the year to date for those three indices. And obviously COVID happened and COVID really took the small caps lower, which they're the most volatile. The Russell components have an average beta of about 1.2 compared to the market, which is, obviously a 1 beta. So those more volatile names are going to usually get hit harder in bigger downturns. Now, what that does is that creates opportunity. So from the bottom in March, the Russell was down about 40% year to date. Fast forward to now, and the Russell's actually up about 15% year to date, and it is caught up. It's totally closed that gap with the SPY, the S&P. Now, it's still lagging, obviously, behind tech, but I think I'm going to show you here in a few minutes why I think it's positioned to catch up with the big tech stocks. So here's a ratio chart right here. This is a weekly ratio chart of the IWM over the Qs. So it's the Russell over the NASDAQ. And obviously tech has been really strong. So this ratio is going to continue to trend lower over time. It has trended lower over time. But if you look there in July, starting in July, we created a series of lower highs on this ratio. If you look at the RSI pane on top, relative strength, the Russell has been stronger here recently. And those divergences are pretty interesting to me. It looks to me like this is a situation where a bottom has been formed in this ratio, and there's a lot of potential room for upside. And this is the Russell compared to the SPY, very similar look. And when we looked at that chart earlier that showed the big catch up that the Russell's played in the last month or so, it's kind of, you can see it on this chart here. Starting in about November until now, the beginning of November, the Russell has really played catch up. So relative strength here in the last month or two. And I think this potentially could just be the first or second inning of something that could play out over the next 1 to 3 years. So that's the price action side of it. Let's look at the sentiment that's gone behind this and potentially why the Russell has underperformed. On the left, this is a pane of all the S&P 500 stocks. And then the red line is the aggregate short interest. So it's the total number of shares that have been sold short over time. So for a while, it kind of chopped in a range there between about 6 billion and 7.5, 8 billion shares. So short interest wasn't doing a whole lot. But if you look from about the middle of this year, that short interest on the S&P names began to plummet. And obviously the S&P stocks have gone virtually parabolic over that same time frame. So there's been a lot of short covering. There's been a lot of fundamental bears, a lot of funds, maybe long short funds, things of that nature, where they're beginning to throw in the towel on those stocks. And that short squeeze has added fuel to this rally. So that's the S&P. But then if you look at the chart on the right, that's the Russell 2000 or the IWM. And that's the component short interest within that index. So short interest has trended higher for some time now. It actually hit an all-time high in July. And it's just only modestly off that all-time high. So you have a lot of people betting against these companies. You have a lot of pent-up potential buying power in the future, but no one's really covered yet. Like, people are still in there shorting these stocks, even though over the last 2 months, the Russell names have been going ballistic. So these are natural buyers that have been pushing this index higher. And the shorts are still in there. So as that index, or should the index continue to trend higher, that's going to force the shorts' hand. They're going to have to cover at some point. They'll reach a pain threshold where they have to say, okay, that's enough. And if and when that begins to happen, that's going to be gas on the fire. And you're potentially setting up for a parabolic move in a lot of these names and maybe even the index. Now, obviously, I come on today and I'm going to pitch bullish the Russell 2000. And we had a big divergence intraday where we made a new high and now the market's selling off and the Russell is actually getting hit really hard. Comparatively speaking, from the highs today. It sets up a scenario in my mind where if you look at the IWM, the ETF for the Russell, a pullback to that 185, 186 area, I think would be a really good spot to start nibbling for longer term positions. So this could be providing some opportunity on the long side here. And this is a pretty interesting quote that that I think is pretty germane to what's going on right now. It's when I see a bubble forming, I rush to buy, adding fuel to the fire. And that's George Soros is famous for saying that. I'm not necessarily saying that this market is a bubble. It very well could be. But if it is, we could still have a long way to go on the upside. And in that, if things get even more ridiculous and stocks, continue to trend even higher and higher and higher, you're generally going to want to be in the more volatile names during periods like that. So high beta has outperformed a lot here in the last couple of months. And I think it could just be the beginning of a bigger trend that could be in place. So right now is a great time. We're options traders at Schaefer's, but right now is a great time to buy option premium. You can limit your risk. You define your risk going in, and you potentially have a big upside, and implied volatilities on options are still really low in these trending markets. So you get the best of both worlds. You get leverage and you also get defined risk. And if you're wrong, you know exactly what you have at risk when you enter that position. I missed this slide for some reason. So this is just a glimpse of the option sentiment backdrop. And I'm sure a lot of people have seen this chart right now. The red line is the 10-day average buy to open equity only put call ratio. So it's investor appetite for puts versus calls. And obviously the market is melting up. So you have a little bit of a Pavlovian experiment where people buy calls, the market goes higher, they make money, they buy more calls, and it just keeps happening over and over and over again. And I've seen in the media, I've seen on Twitter a lot, other social media, that people look at this chart and they say, well, hey, that's bearish. Well, maybe, but not necessarily. This ratio should be low right now because that's what's going on with the market. So this could go on for a while still, is basically what I'm saying. Now, if the market were trending lower and the put call ratio was low, then absolutely that's bearish. That's a sign that people are bullish when the market's actually going down. But I wouldn't look at this chart in a vacuum and say, this is bearish for the market. It's basically just saying, okay, people are buying calls, people are getting paid for that. And another dynamic of this is that this excessive call buying can create what's called a gamma squeeze. So without going into too many details, call buyers buy those calls from market makers who need to hedge their positions. They're short calls, they're short risk. So in order to hedge those positions, they buy shares. By buying shares, they push the price higher. So this has happened in some names like Tesla was really popular not too long ago. You had this ridiculous call buying and the stock just went parabolic. And a lot of that was market makers hedging, and that just kind of snowballed. So we could potentially be in a scenario like that for the market in general, and this could continue for a little while longer. So here's the seasonality trends that we have in place. The left pane is the S&P by month over the last 50 years. And as you'll see, November, December, January, that's the strongest 3-month period in the market historically over the last 50 years. So we're in that period right now. And November, December have been positive over 70% of the time over the last 50 years. The pane on the right is what people refer to as the Santa Claus rally. And a lot of people say, it starts in December, it starts whenever. Investopedia defines it as the last 5 days, the last 5 trading days of the year with the first 2 trading days of the next year. So in looking at those 7 days, we broke it down and we took the Santa rally days, and then we also took any random 7-day return in the market over the last 50 years. So for the Santa rally, you're averaging almost a 1.3% return in 7 days versus an average of 0.24% over any random 7 days. And 76% of the time over the last 50 years, it's been the market has been positive over that 7-day period, compared to a 57% average for any random 7-day period. So seasonally, we're coming into a time of year that's really strong. And I think small caps could continue to outperform, and you could actually see some pretty ridiculous upside in specific names, not just the Russell itself, but there's a lot of names that are very highly shorted that may have a little bit of a turnaround story behind them. And you have all these pent up shorts that could create explosive moves to the upside. And as an option buyer or as a spec trader, that's exactly what you want. So just to kind of recap everything, why small caps? The market's melting higher. Embrace the volatility, embrace the beta. That's where you want to be right now. You get the most bang for your buck. The long period of underperformance seems to be mean reverting. So you had that long 10-year period where tech has outperformed, small caps have underperformed. Maybe we're getting a big tectonic shift right now, and we could be in the very early stages of that. Historically, the small caps have outperformed coming out of recessions, and by a pretty wide margin. 3 of the last 4 small caps have outperformed, and going back even further, that number is about the same. So small caps seem to be the place that you want to be to capture the most upside. And we're obviously coming out of a pretty rough period for the economy, and we could be getting back to a more normal economy here in the next year. The elevated short interest among the components creates the potential for big blow-off moves. And then lastly, the vaccine should be coming out, who knows when, but spring, summer should be fairly readily available for everybody. And there's a good chance that the economy is going to return to a more normal state, what we're used to. Tech stocks like Google and Amazon and Apple, they haven't been hurt at all by the pandemic because people are at home, people are buying things, people, you don't actually physically have to go to the store. It's more convenient to buy things at home. Whereas a lot of these small cap names, you have a lot of retail, you have some oil exploration names, things of that nature that are brick and mortar businesses that actually need the economy to function as a normal entity and not what it's been for the last 8 months, I guess. So if and when the economy does return to normal, these businesses that have been really hurt are set, hopefully, for them to return to a more normal state. And there's potentially a lot of upside growth in that over the next few years.
Awesome. Brian,
yeah.
Awesome presentation, my friend. I think we got to cut you off there for the 15, unless I'm early. I think that is correct. But really incredible information, man. You are with us quite a bit, so I think we'll see Schaefer's hopefully at our next boot camp. But Schaefer's long-term partner and supporter of Benzinga, and we love you guys, and we're super thrilled you're here.
Okay, thanks. Real quick, I'll just scroll through. These are my 2 ideas: long Bed Bath & Beyond, long SunPower, stop here under 1750, stop here under 20, 3-to-1 reward to risk.
Perfect. Awesome. Brian, thanks again, my friend. Stay healthy, and when that economy gets back, we'll still be talking about it here at Benzinga with you.
All right, thanks,
appreciate it, Brian. Awesome. All right, everybody. We've had some incredible content today. We're moving right along. We're bringing back Mike Aiello. He is the managing partner at Century Business Consulting. They obviously work with a ton of companies in the small cap space, and we're going to hear them talk about some very interesting industries that they work within, how they work within, some obstacles that they've seen. Mike, are you there, sir?
Yeah, can you see me?
Yeah, there we are. Sorry, I just had to scroll over, power of Zoom. Mike, it's good to see you again, man. We've done this before. I'm excited to dive in again with you. Century's awesome. Let's dive in. Can you tell us a bit about Century, the expertise that you all offer in the industries that you cover?
Yeah, absolutely. So at Century, we are focused on accounting and advisory services for emerging growth companies and emerging growth industries. We provide these rapidly growing companies with the additional expertise they need to accomplish their goals. So whether that's an IPO, M&A, or assisting them with the rapid organic growth, we have them covered. And that's what we focus on each and every day.
So a ton of financial expertise. I love that. So are there industries or markets that you find need your services more than others?
Yeah, that's a great question. So although we have clients of every shape and size and work with every industry that you can possibly think of, the clients that we're able to make the biggest impact for are in that emerging growth sector and those industries. So that's life sciences, tech, esports, crypto, cannabis. Those are the ones, again, that we're able to make that big impact for. And I guess to your question of why, it's because these companies usually have a lean accounting and finance department because, as they should be, they're focused on their product, their tech, their IP, etc. We're able to come in there and bolster their team, supplement their team, and give them that big company feel and the expertise that they need to hit their next growth goals.
Yeah, we heard that earlier, I think, with Andrew Thute from Forefront about how if you're looking at cannabis, look at companies that are focused on operations. And, it sounds like you're echoing that to an extent, at least. So, how do you adjust your expertise? Let's say specifically within IPO readiness, with an emerging market such as cannabis versus maybe some of the more mature markets that you work within?
Yeah, sure. So, for us, it's not a one size fits all thing. For the more mature companies, there's countless examples, case studies, et cetera, that you can go by for the right path to go through IPO. There's a lot of examples and history there. But when you think about a cannabis company in this example here, these companies, in all likelihood, haven't historically been focused on SEC reporting, exchange listing requirements, US GAAP. They've been focused on statutory laws and regulations and tax reporting. That's what's most important in cannabis. So when you start shifting and thinking about the SEC, US GAAP, Sarbanes-Oxley, that's a bit daunting for some companies in that space. So we're able to focus on that for them so they can focus on running and growing their business. What a novel idea. And again, that's where we fit in.
Invaluable. The SEC, the FDA, federal legalization for cannabis, obviously more specifically than the other emerging markets you work within, definitely seem to be the conversation topics of late. Fantastic. That makes a lot of sense. So, all right. So, obviously COVID, the name of the game here, has been since, March, early to mid-March, even before that for many people. But because of the pandemic, which industry is really facing the most challenges right now? The biggest uphill battle, and a little bit more specifically, how is Century helping them navigate that?
Yeah, that's a good question. And, obviously the pandemic has been here, and it's really what we've seen, and I think a lot of people have seen, is it's hurt the retail and hospitality sector the most. And it's a shame. My heart really goes out to these companies and entrepreneurs. And for them, again, our focus is not on compliance. It's not the right time to be focused on compliance and helping these companies. It's more cash management, forecasting, budgeting, PPP, forgiveness, loans, grants, and looking for pivots that not only can help their companies survive, but also thrive going forward in the future. So it's really making sure we're focused on what they need most. And that's where we're really excited to get in there and help them. And we've had a lot of success stories. There's some rough cases out there, but looking forward to this pandemic being over soon and letting these companies get back to what they do best.
Just as a quick follow-up, once the pandemic does come to a conclusion, and ideally we have a vaccination shortly and hopefully sooner than what we're really all expecting, does it go back to normal?
I think, look, I don't have a crystal ball. No one does, right?
Yeah.
I think, unfortunately, there's going to be companies that never come back. I mean, if you just walk down 7th Ave in Manhattan, you're going to see that it's going to be rough for a little bit. But what I believe in is the United States of America. I believe in the U.S. economy, and I think entrepreneurs will always succeed. And I think it will come back. It's just going to take some time.
Amen to that. I'm hiring you for my locker room speech next time. All right. So Benzinga, as you know, you have been with us for, I think, several events now. We work pretty heavily within cannabis, hence me referencing it several times already. So some pretty big news recently with the House passing the MORE Act. Obviously, some maybe a little bit more resistance than we would have hoped otherwise. Where do you see that headed, maybe specifically into next year?
Yeah, so I'm really excited about the MORE Act, passing the House, that is, but not necessarily because I think that the Senate's going to come in and give the okay, as they probably should, in my humble opinion. But I'm not going to hold my breath on that happening either. Mm-hmm. I'm very excited about it because what this really signals is 68% of the American population is now supporting the legalization or decriminalization of cannabis. And that's important, getting more exposure, more news, the House passing it, of course, it's just driving more and more support for it. We all need to look forward to the January election. Let's cross our fingers here and look for the Democrats to win. But I don't think that we should all bank on that all of a sudden January comes and we're in the clear there. I think we're still a couple years away, unfortunately. And why? I believe it's because the government has a lot more to focus on right now with infrastructure, healthcare, stimulus. And I think that's where, Biden is going to look to focus in the beginning. But all of this is exciting and momentum is building. And it's hard not to feel it and see it.
Yeah, perhaps another follow-up for you there, something that you've been on our Cannabis Hour podcast before. We host it every Thursday at 4. Something that I ask, people quite a bit, is that okay? I think there's still a pretty large, small, albeit minority, that thinks we're not all quite ready for federal legalization. Where do you kind of sit on the timeline?
The timing, I think we're somewhere between 2 to 4 years where that comes down. But again, this is exciting news because you can see, let's let all the other states see that what's progressing, the momentum that's building, and that they should get on the team here. But it's going to take time. It does help the industry, even though none of us want to admit it. It helps to continue to build that infrastructure, build that long-term confidence and maturity. So, listen, I'm as eager as any to get the go ahead there and for that door to be wide open. But, it takes time, and it's hard not to be enthusiastic and excited about this recent events.
Perfect. Awesome. So we've talked a lot about cannabis. Let's move into another industry you cover, esports. Now, is this sector, is it still growing? Has it lost steam amidst the pandemic? Does competitive gaming rebound once, we are past the pandemic?
Yeah, great question. And, as you know, and maybe some others saw, had an awesome panel earlier this morning with some great panelists. And, the overall theme, first of all, we're all very excited about where esports are going. And we think it's just the tip of the iceberg and has a very bright future. And really what we've seen here, in the pandemic in 2020 is an additional increase in the awareness, the viewership, and the overall coverage of esports. And just the attention that it's received from the investment community, from some of the largest companies in the world are very focused and invested in this. You're talking about celebrities and very wealthy individuals being very focused about it, on its growth and its future. So, I'm very excited to see the future. Yes, live events, that certainly took a hit like any other thing, but in some ways, and I caution saying this, but in some ways the pandemic actually helped with the traditional sports getting canceled and shut down. It really gave everyone an opportunity to really open their eyes to what esports can provide, the gambling that's associated with it, the shift for more colleges, high schools, et cetera, to put programs in place. So again, it has an extremely bright future in my opinion, and it's just the tip of the iceberg.
Absolutely. Yeah, I was just thinking, A, we're all missing live events, case in point. But B, it's funny, my home state of Kentucky actually does not allow sports gambling. That ironically, you think Churchill Downs, you think horse racing, but you have to go across the river to bet on anything else. So very interesting there. All right, so maybe we'll wrap up here shortly with another question or two. If you could leave this audience of investors and companies one piece of advice moving into the new year, maybe it's one for each particular part of the audience or just one in general, what would that be?
Yeah, so probably not going to surprise you on this, but when I think to the investment community, I suggest thinking long term. And when I say that, I say look to cannabis. Again, I think it has a lot of legs. It's been a little up and down over the past 30 days, but if you're in it for the long term, it's still a great time to invest in cannabis. And again, I say the same thing about esports. I think it's the right time to make sure you're focused on the future, and the future is now. For the companies, these black swan moments don't come across very often. Look for opportunities to capitalize, to take advantage of this, and come out better and stronger on the other side of this.
Perfect. Mike, great answer. Where can people find you?
Yeah, to get more information on Century, go to centuryconsulting.com. And if we can help them any way, give us a shout.
Perfect. Mike, ideally, we'll see you again next event. You are a wonderful partner to us. We appreciate you. Have a wonderful end to your year. Please reach out to Mike if you have any questions. We'll see you soon, sir.
Yeah, thanks. Happy holidays.
All right. You as well. Thanks again. All right. Fantastic conversation with Mike Aiello from Century Business Consulting. Love them. They have an incredible amount of expertise and do a lot in the space. But let's move right along. Thanks again, Mike, to Kelsey Ramsden. She is going to be here from Mind Cure Health, listed on the OTC and the CSE. It looks like I have the same ticker for both written. That cannot be super correct. Kelsey, can you help me out with your tickers there?
Yeah, for sure. On the OTC, it's MCURF as in Frank. And on the CSE, it's MCUR.
Perfect. Thank you so much. I'm going to let you take it away, but we're super happy you're here with us.
Great. Just give me a moment here and I'll get into my share screen and make this all happen for us. Just 1 second. Great. So we have a short time here today, and so I'm going to get right to it and move pretty quickly. I know we're all pretty well seasoned in here, but I'm going to start it with a little bit of a psychedelics 101 for those of you who haven't been following the space, and then we're going to move into some conversation around digital therapeutics and why we think and it's an important thing for investors to have a look at. So MindCure is bridging science, tech, and psychedelics for tangible results. And we're going to talk a little bit about the market. At the beginning, we're going to cover what does the space look like today? Who's looking to this space to invest? Not just what's happening, but who's there? What does psychedelic therapy look like? Why do digital therapeutics play an important role? And then I'll speak a little bit about ourselves. Because we are going to be moving pretty quickly today, if anyone has questions along the way that I can answer afterwards, you're welcome to email me and just kramsden@mindcure.com. So let's get off to the races. So really what's going on in the mental health space is many of the people have alluded to throughout the day is this idea that we were facing a mental health care crisis going into 2020, and it's only been exacerbated by the situation with COVID-19. There were a couple of people earlier in the day, actually a colleague in this space with MindMed who'd given some stats around that 1 in 10 Americans are over the last few months within COVID have been considering suicide. And 40% of Americans have had a mental health reduction during COVID. So it's a material space and there's a lot of good work to do and value to create in that. For us at MindCure, what this looks like is reinventing mental health care. So not only are we talking about novel drugs and molecules, but we're actually talking about how we undergo therapy and therapeutic treatment. So we're committed to providing an integrated therapeutic system. So anyone who's been involved in any form of therapy or has a family or a friend who has been involved will understand quite well how disintegrated the system is, and how a lot of folks, even though they go and seek treatment, either aren't provided with medicines in due time that actually help cure and or materially alleviate the issues at hand. And a lot of times people are sent back out into the world really without enough support to have the long tail of their recovery to be supported. So we see high incidences of reoccurrence of addiction, anxiety, PTSD, and the like. And we'll get into that a little bit more in a moment. So for us, what this looks like is finding a model where better patient outcomes and scientific rigor are the #1 thing. And that's supported heavily through our digital therapeutics platform, through psychedelic assisted therapy and proprietary treatment protocols, as well as some ongoing neuro supports. So what does mental health care now look like? Well, it's a big industry. There's a lot of money being spent trying to help people get better. So 16 trillion is a cumulative global cost of mental health disorders. That's forecast out just 3 years from now and did not account for COVID when we're looking at this. 300 million is the number of people suffering from depression. There's a tremendous amount of people suffering from depression at the moment. And in addition to that, depressive states that are drug resistant. So 30% of people with depression who are actually undergoing treatment are resistant to the drugs, or they haven't found the right mix of drugs, and psychedelics are a direct solution for that kind of situation. Anxiety is on a tremendous rise. I mean, I can go on and on about the numbers here, but I think the notion is this idea that mental health care has been under-researched for the past roughly 20 years. The last big drug that came out of traditional pharma was Prozac. There was one ketamine-inducing drug in the last 10 years, but it's really just a matter of maintenance for momentary anxiety. So the pharma giants have really cut psychiatric medicine and neuroscience research. It's been undertreated, so a lot of anxiety disorders, PTSD and depression just are not being hit or targeted in the same way that they would have been in the past. And so a lot of disinterest has gone into the area, whilst at the same time, a tremendous amount of people are suffering. And it's costing a tremendous amount of money. If you look at insurance rates alone, so I was just on the phone the other day with a colleague in an organization I can't name, but within their ranks, they have a tremendous amount of people on disability with PTSD, and they believe it's actually costing them more to serve the people who are not working than the entire resource base of the people who are at the moment, and those are just anxiety sufferers. So what we're looking at that's interesting and building up this market space, and why I think people should be paying more attention and or close attention, is regulatory change. So we've heard a lot about cannabis over the last few days, and so a similar thing is happening with respect to psychedelics, in that the regulators who oversee the drug classifications and treatment protocols are starting to make moves to address this crisis in mental health care. So in Canada, what that looks like is in August, the first Section 56 exemption providing patient access. So the first psychedelic treatments legally conducted in Canada happened in August of this year, and they continue to do so through nonprofits who've really been leading the charge through this renaissance of psychedelics. And what that means in Canada is not, and I want to, triple asterisk this for anyone who's listening. The notion is not that we are trying to get regulatory change for a person on the street to have access to psychedelic medicines. Quite frankly, they're far too powerful for us to be pursuing that. The notion is, how do we utilize psychedelic medicines under supervised care? And so in Canada, big measures and things are happening quickly. In the States, FDA granted breakthrough status for psilocybin, and you're seeing a lot of activity happening around deregulation. And even just recently in Oregon, support being granted to advance the idea of clinical therapy being conducted with psychedelic substances. And so it's rapidly changing. And so this is a time of a renaissance in psychedelic research. There was a lot of it done in the 60s and 70s, and then for a variety of reasons, some political, some cultural, most of that research was stopped, which is really unfortunate because the outcomes are material. And there's a reason why we're called mind cure, in that an innumerable number of people actually walk out of treatment with material differences, and or, in the case of PTSD, coming in the highest quartiles and leaving with no measurable post-traumatic stress disorder coming out. So the appetite for alternatives by the general public and by organizations is tremendous. So in short, it's large and growing. The addressable market is there. There's regulatory changes that are expanding our opportunities. Traditional drugs are not solving the problem, and the world is suffering and continues to. We're going to move a little bit quicker through this section now that we gave you the one-on-one, some sector insights. So most of us would be familiar with Peter Thiel of Facebook fame. So he was backing behind Atai and Compass Pathways, which are parent and sub companies. Some large raises in there, 125 million Series C and 146 million IPO. Compass with a $1.7 billion market cap. Earlier this morning, we heard from Kevin, my dear Canadian friend here, who is behind MindMed and their 100 million raised to date. MindStrong, privately held company at 140 million. Cybin just closing a $45 million bought deal this past week. So a lot of money moving into the space. And funding in 2019 was just 220 million. And you can see that's rapidly skyrocketing. And so market defining investors are back in the psychedelic mental wellness space. And so, you know, I never like to be a person who promotes anything specifically, so do your own homework, but you'll find there are multiples in the hundreds because there's real value and real business models to be supporting here. So I might talk a little bit about MindCure and how we are looking at this market and why this matters. So we see mental health care as a spectrum. So over here, far on our left, we're talking about simple organic compounds. So this is like, you know, we take great care of our bodies from the neck down. Yeah, we shower, we brush our teeth, we do all those kind of good things, but very rarely do people think about managing and optimizing their mind or their brain for optimal use every single day. So part of psychedelic treatment also includes that. So things that are non-psychoactive, or sorry, that are psychoactive and non-psychedelic. So things that affect your mind, increase focus, clarity, better flow states are some places that we're currently operating in. And then moving all the way over to this idea around how do we find complex and novel molecules in the psychedelic realm to better support treatment and care. So playing across the entire bandwidth and spectrum. And what we've seen is a large degree of individuals, executive level individuals looking for optimization of their mental health and or performance, and they're seeking out psychedelic treatments as well. So just talking about what we truly understand. So psychedelic therapy, and there is a little bit of a difference in understanding around this. I think people have this expectation, like people come in and they do some in air quotes drugs and stumble back out. But really these protocols, and we call them protocols, it's like a treatment recipe, are proprietarily and highly scientific backed. It takes a long time to develop a care protocol utilizing the right type of medicines in the right dosage, in the right environment, at the right time for the right people. And this is why you see so many people in this space putting a lot of emphasis on not just the medicine on the whole, but the entire experience. And so part of what we're doing at MindCure is developing a system whereby we become the digital and technological backbone of the industry in a way that that you might have seen before with some familiar parties. So digital therapeutics for mental health can look like this. So at Thai Life Sciences, they're doing a digital platform. MindStrong is much like a telehealth type platform. We're seeing a lot of that these days in COVID times. But what we are focused on is the idea of really becoming like the Netflix of the psychedelic industry. So developing the distribution platform, some of our own content, and allowing people to up-train so that more people have access to the medicines in their own communities and homes with registered therapists who can partake in the work. So what we're doing with our digital therapeutic platform is building the tech that enables observation and collection all the way from the research stage, where these protocols are developed and vetted, deep science backing, and then coming out in a catalog format so the therapist can say, how do I adequately and appropriately onboard my patient in a way that I choose the right medicine in the right dose, in the right time, etc., for the highest patient outcomes. And so the idea in the long tail of treatment, and this is where I think we make a material difference, is in supporting people coming out of therapeutic care in a way that they don't relapse, in a way that we continuously optimize on their health. And this is where some of the machine learning comes in and starts to create feedback loops that start to optimize the content, just like Netflix does. So I'm gonna walk you through really quickly in the dying minutes of our presentation here, how we do that. So in the discovery phase, this looks like research, product discovery, and protocol development. So this is the content. So just like Netflix does, we produce our own content and we carry the content of others. So if there's research coming out of Johns Hopkins, other universities, other psychedelic practitioners in the field, we become the distribution backbone so that clinical research and therapists, when they're being deployed in the field, have a place to go that's vetted and understood. The tech enablement of that treatment in clinic, and then as those patients are released back into the world, allows us to get much deeper understanding of some of the nuanced effects of the medicines, some of the nuanced outcomes on an individual by individual basis. So what we like to say is we're creating personalization of care at scale. And what this allows us to do as well is keep therapists in office time down while allowing better patient outcomes out of office time by consistently feedback looping their data on themselves and discovering when people may or may not be feeling well, how we can make that particular individual feel better. And then recommending those follow-up protocols back into the data set. So the data set is where a tremendous amount of our value lies, and it's in the rigor of the process. So again, coming back to the renaissance of psychedelics, and what we were not afforded with before was the depth and detail of technology that we are now. And then in the long tail of the research and the support, that's where we see better patient outcomes and material uptake for these services. So here's just a little bit of a map of different people.
Because this is such interesting stuff, but we're gonna have to wrap it up here. If you have one last thought to leave us with, please do so.
Yeah, absolutely. So I would say for the most part, it's just looking at digital therapeutics as a meaningful way for psychedelic research to be vetted and distributed around the world. I think we're doing great work in terms of supporting the medicines and supporting the outcomes. And I think there's a tremendous amount of value in the data here that hasn't been seen in other industries that are undergoing deregulation.
Awesome. Kelsey, thank you so much. Such important work, especially in this climate where so many people are dealing with mental health issues right now. So thank you again for all of that information. And one last thing, where can people find you if they want to get some more information?
Yeah, sure. They can find us at mindcure.com. On the OTC, we're MCURF. And if they want me, they can reach me at kramsden@mindcure.com.
Perfect. Thank you so much, Kelsey. We'll see you soon. Stay safe.
Thanks, Shelby.
All right, guys, as Luke mentioned earlier, I am back, and Luke and Elliot have been kind enough to let me stretch my feet on this side of the Zoom. So I'm so glad that they did, because I get to introduce a very interesting fireside chat with Larry Wexler, the CEO of Turning Point Brands on the NYSE, that's TPB. And this conversation will be led by Jeffrey Goldberger from KCSA. So as I move them over, guys, let me know when we have you. Turn on your microphone and video, and we will get started. You guys here with me? All right, and again, while they're getting everything started, again, that's Turning Point Brands on the NYSE is TPB. So check them out on Barella, and we will get them going here very soon. Jeffrey, hello, how are you?
Get off of mute. There we go.
Yeah, there you go. They're trying to mute. Looks like we have Larry coming over. Give us just a second. Larry, can you hear us? Jeffrey, love your background there.
Yeah, it's a little ominous, but we're trying.
No worries.
Okay, how about
right.
There we go.
All right, guys, I'm going to let you have it.
Great. Thanks so much, Shelby. We appreciate it. Larry, thanks so much for joining me today. Very exciting company, an exciting time for Turning Point Brands, especially, frankly, since COVID. I just checked out your stock, and if someone was lucky enough to get in the mid-March timeframe, they've had almost a triple here. So why don't I step back for a second and hand over the mic to you, and why don't you give us a little bit of a broad overview of the company?
Okay, Jeffrey, thank you. It's a pleasure to be here. So Turning Point Brands is a consumer product company in which Zigzag is our most highly profitable part of our business in our smoking section. And it produces over half of our operating income. What's interesting about Zigzag, that's highly tied to the cannabis industry. So it's sort of a back end way of playing with cannabis. when you look at our core business, which is smokeless and smoking, both these segments are very recession resilient. As you pointed out, we've had one of our best years this year with all this economic turmoil, and our second best year was in 2008. They're organized. We have two strong brands, Stoker's and Zigzag, with over 50% gross margins and high 30 to 40% operating margins. And the two of them combined generate over $50 million of free cash flow a year. So we're pretty happy about that. So I'll just give you a high level view of both the segments. In smokeless, as I said, we're organized around Stoker's. It's grown 16% year to date. And it's made up of two individual categories, product categories. You have chewing tobacco, which has volume declines, industry volume declines, which are offset by pricing, but we've been able to outperform by a bit by long-term share gains. We've grown share fairly consistently over the last 15, 20 years. The real story in smokeless is MST. This is a product that's been on a roll. It's up about 25% in the past year. It has about 5% of the tonnage of the category. The MST category is a great category. It's got consistent price increases. It's a very large category, $3 or $4 billion at the manufacturing level.
Hey, Larry, we have everybody that might not know what MST is.
Oh, I'm sorry, moist snuff, dip. I'll use dip, I'll use moist snuff. It's oral tobacco, basically.
Great.
That's a good point. Sorry, I sometimes slip into jargon. What we're particularly happy about is that most of the growth that we've had in the past year has been from same-store sales growth. While we are increasing our distribution, we only have about 60% of the distribution of the weighted category. So we think that Stoker's has a real long runway for growth in the moist snuff category. In the smoking segment, we're organized around Zigzag. I had mentioned that before, and it's made up of two product groups. The first is rolling papers, which is kind of where Zigzag's heritage is. We sell Zigzag under a license for North America, so we have both Canada and the United States, and it's the leading premium brand in both those markets for premium rolling papers. The other category is make your own cigar wraps. Think of the outer shell of a machine-made cigar where consumers generally put cannabis in it and to consume cannabis. That we own the tobacco mark for Zigzag. And in that particular category, we have about 70 shares. So Zigzag is leaders in both of the accessory categories for cannabis. Now, what's interesting about Zigzag is that about 18 months ago, we made a concerted effort to reinvigorate the brand. We introduced a number of new products, most interestingly cones. Think of cones as a preformed rolling paper with a little tip in there so you can use it to smoke. It is the largest category. It's one of the largest categories within rolling papers. And it's basically almost the same size as the unformed booklets. And we're just getting started there. We're already the second leading manufacturer in the measured market. And the other aspect of Zigzag was when legalization started happening, what we saw is consumers started migrating out of our normal channels, like C-stores and tobacco outlets, into dispensaries and head shops. And about 18 months ago, we started putting plans in place to starting to move our attention to these other categories, as well as starting up an e-commerce group. So Zigzag has had tremendous growth over the last 12 months from both these product and channel initiatives. And we're pretty happy with the way it's been performing.
Great. Well, listen, Larry, you hit upon some really interesting topics I'd like to dive a little bit deeper into. So you talked about this topic about consumer packaged goods, where you're positioned in it. But I think, and we discussed this earlier, why the cannabis industry is going to migrate over to this type of platform. So I'd love to get your impression on why brands are important, how you're going to capitalize on Zigzag and some of the other brands that you have to dive deeper into this, and kind of why brands are going to win overall moving into cannabis.
I think it's interesting as you look back on the early stages of cannabis legalization and recreational cannabis. You saw just having availability was the most important thing. So you saw all these dispensaries opening them up and people having access to the product. What we see is as the category evolves, you'll start seeing brands starting to emerge. And the important thing behind brands is having consistency of delivery and having a USP with a benefit. So consumers are actually getting a benefit for it. And what we see is the cannabis consumers evolving. So they'll be starting to seek end benefits as opposed to just availability. And it's sort of interesting that if you look at beer, when beer first started, there were thousands of breweries in the United States. Then it went through this big, massive consolidation. Now you're starting to see these individual craft brewers opening up. I suspect that, we suspect that cannabis will go through the same sort of evolution. And one of the things that we're acting upon that is that we most recently bought a piece of investment in a company called Dosis, which is a cannabis supplier. And one of the things we liked about that company is that they're really focused on health and wellness. They have technology and they have branding that's basically positioning cannabis products for an end benefit for the consumer. So as opposed to selling the molecules, as opposed to selling THC, they're actually selling an end state that you want to get to. And they have some great marketing talent there, and they have some interesting technology that actually gives a measured dose so you know exactly what you're getting from the product. This is where we see the cannabis industry going in the future. We see it more geared towards giving people the desired end result of what they want from their experience, as opposed to just having just the availability. And so we think Dosis is going to be a great position.
So is Dosis a blueprint for things that we should look for, what investors should look for in the future? Unlike a lot of the other players, you have a annual run rate of about $400 million of revenue, a lot of free cash flow. So you guys are really well positioned to put that money to work. In addition to, and everyone would love to hear this, you guys have a dividend. So most of the companies that are playing this are dying for cash. You guys are spitting off cash. So I'd love to understand how that plays into your overall objective.
We are cash flow positive. We do generate about $50 million a year. And we are very well positioned. Now, the interesting thing is at this point in time, now there are some regulatory hurdles and there are some financial hurdles in terms of what you can do with the cash and how you can make the investments. And so the way we invested in Dosis was to actually invest in their THC-free product and in their Canadian operation, which would give us a toehold and get us to start understanding the business and start positioning ourselves. And what you'll see over time is that as the MSOs start building out and as availability comes forward, you'll see more and more shifts to branding and branded products. And that's where we'll see us devoting our cash flow.
Great. So let's kind of talk a little, let's go back a little bit and talk about COVID. COVID has been so devastating for so many industries and individuals and very tough times for a lot of people. But for you, you've done really well. I'd love to talk about what you've done both in your bricks and mortar distribution activities, as well as what you've done on the e-commerce.
Yeah, I don't want to understate the impact that COVID has had on the country. But one of the interesting aspects of COVID on almost all businesses, that every trend that was in place before COVID got accelerated during the COVID period and during the lockdown period, the trends towards online shopping and things like that. We're no exception. We had very strong momentum in both smoking and smokeless going into COVID. And when the lockdowns happened, what happened is that people had more consumption opportunities, as well as we have a product, our moist snuff product. Most moist snuff is sold in 1.2 ounce cans. We actually sell our product in a tub, which is about 10 cans worth. Think of a Baskin-Robbins container of ice cream. So think about a situation where people were looking for value, and it's a value proposition. People were looking for value, and they're looking for convenience. They want to have to go to the store every day or two. Where with our moist snuff product, you can make a purchase. It lasts about a week. It's perfectly positioned for value and convenience. And it's also a great product. We price our product about 40% below the major products in the market. But we've done a lot of consumer testing that shows that our product is the equivalent or better than these other products. And so over time, we have a great, I consider it almost like a solar cell. We're storing up this energy and market share that will release that energy by closing the price gap with the majors over time, which will be another great source of increased profitability. We got sales growth, market share growth. We got industry pricing of 5 to 7%. And then we've got the potential of increasing our pricing relative to the majors. All that driving a long runway of growth for Stoker's and MSD. Now,
yeah, go ahead.
In our new gen business, we have a B2C operation, which we also saw a dramatic increase in sales during the lockdown period, as much of the industry has experienced.
So why don't we step back a little bit and talk about what your next gen business segment is for people that don't know the company very well, and what the plans are for it and where you are with it right now.
Yeah, one of our major initiatives for the company is evolving away from the tobacco heritage that we had and moving into other actives. And New Gen is one of the areas that is going to be very supportive of that evolution. So in New Gen, we built New Gen by buying two companies, a major B2C company in vape and a major B2B company in vape. And then supplemented those acquisitions by opening up a group that we call New X Ventures. Think of that as a skunk works, which just creates new innovative products. And this will be the driver of getting into these other markets. Now in New X, we've actually seen some progress. We just recently came out with a modern oral product called Free, which is one of the hottest markets in the tobacco space, the nicotine space. This is a product that doesn't have tobacco, but has nicotine, and it's in a white pouch, and people are using it as a substitute for moist snuff or as a substitute for smoking. And what we did is we positioned our Free product at the higher end of the nicotine range in the market. What we saw is that all the other products in the market had lower nicotine. And among those products, everyone was moving to the high end of those individual products. So we positioned our product at the high end of the nicotine space. We just introduced it. We had it on one of the online sellers, and they said it was one of the best introductions they've had over the first 4 weeks. And so we'll see what happens as we start rolling that out into the greater market. We have high expectations for that. Great. The New X Ventures has also created a gum-like nicotine product, and we have nutraceuticals with B12 and caffeine. So a whole range of products are in the pipeline that'll help transform the company away from tobacco towards these other actives.
So very small today, but high growth opportunities. What can you do? I think you should make people understand how big your distribution is, your retail distribution is, and how that might affect your rollout of these new gen products.
One of the strengths and one of the pillars of the company is our distribution business. We have a sales force that hits about 210,000 stores in North America. We have one of the largest B2B businesses in vape. We have one of the largest B2C businesses in vape as well. And we also have developed e-commerce platforms for a lot of our products. Essentially, our goal, our strategy is that we will be able to deliver product wherever people want to shop. And we've put the structure in place to do that. And so when you think about, we're very active in acquisitions, so we can take a small regional product that has a very good market share and very good positioning and take it and roll it out into 100,000 stores, 50 to 100,000 stores, sell it online, sell it through vape shops, and sell it through our e-commerce sites. Great. So it gives us a lot of leverage with our products.
Shelby, one more topic. Let me give Larry some time.
I'll allow it. One more.
So let's talk about the vape business and what's going on with the FDA and where this opportunity might lie as this industry shakes out, and not everybody's going to survive this.
Yeah, no, this is a transformational period for the vape industry. The FDA was given regulatory control over tobacco and nicotine in 2009 and put in place a process called the PMTA, or Pre-Market Tobacco Authorization, in which all products that were not in existence in 2007 have to go through this process in order to stay on the market. And all those applications were due to the FDA on this past September 9th. And we see this transforming and consolidating the entire vape industry. Now, the vape industry is pretty large. It's about $3 billion. We operate in a $1 billion segment of that. And in that segment, there are currently hundreds of suppliers of e-nicotine, of e-liquid. And because of this process, we expect this to be weeded out. Will there be perhaps dozens, maybe less than a dozen, maybe only a handful of companies, depending on where FDA sets its bar. So essentially, you have to go and you have to apply. The FDA goes through a two-phase process. First, in which they announce whether you've been accepted or not, stay on the market, and then you get sent into an approval phase. And this is where the resources and the talent that we have in our organization is going to make a difference. Here's where you have to prove scientifically that the physical properties of your product are acceptable for public health, as well as the social use of your product. So how you brand it and whether or not you attract young smokers, underage smokers. Now we've spent $15 to $18 million putting together these applications. They're not cheap. And most of these small players are not going to be able to get through this process. So over the next 6 to 18 months, we expect a massive consolidation of the vape market. And we expect to be one of the survivors and one of the winners in that process. It's a great opportunity for the
perfect cap.
Hate to cut you off, but we do got to keep it moving. Thank you both for being here with us. Contact Larry on the Brella platform if you want to speak further. All right, I'm going to move it right along. We have Sean Heron, the president and COO of E-Options. Sean, are you here with me?
Okay. It's not letting me start the video. Start my video. Okay.
There we go. Perfect. Take it away. I'll let you get right to it.
Yeah, hi. Thank you for having me today. And so let me share my screen here. Appreciate everything Benzinga is doing for the small cap conference. So I'm with E-Option, president of E-Option, and I'd like to show you a short demo and presentation, how to think big with small cap stocks, try options. So we're an online brokerage firm. We do a lot of options, equities, ETFs, small caps as well. So just a little housekeeping here, because we're a brokerage firm, just wanted to go over the disclosure. We're going to be talking about options today. They may not be suitable for everybody. Certainly, you need to be approved to trade options. And options may carry a high level of risk. It may not be suitable for all investors. Certain requirements must be met to trade options through any division of Regal Securities. Please read the option disclosure document titled Characteristics and Risks of Standardized Options before considering any option transaction. A copy may be requested by email from us, support at Regal Securities, or at this address. Complete copy as well as on the OCC website. This presentation is for educational purposes only and should not be considered securities recommendations or trading advice by E-Option.
Sean, just want to hop in. Are you trying to share your screen or?
Yeah, I'm sorry. I thought I did.
No problem.
How's that?
Perfect.
You can see it?
Yeah.
Okay, very good. Sorry about that. Okay, so with E-Option, we trade unlimited stocks and ETFs for zero commission. For options, we're 10 cents a contract plus $1.99 per trade. Powerful web platform as well as completely customizable mobile platform. And what I'm going to review today is Options Play. And it's a free product that we offer to clients, and it's built into our platform, and it's a $500 value annually. All right, let's get into it here. So can you see my screen hopefully here?
Yeah, you're good.
Good, okay, very good. So what you see here is this is our desktop trading platform. It's fully customizable, it's widget based, you build your own screens. And what I'd like to get into today is to review our Options Play product. So with options, I think a lot of people will look at the chains or look at the sheer volume and just become overwhelmed in many cases. And that's totally understandable. Looking at an option chain here for the SPY right now, and as you can see, there are just strikes at every dollar, and expirations, just a huge amount of expirations. So it's, as you can see, every week, multiple expirations per week, months, years, goes out to March 22. So it becomes overwhelming. So what we've built into our platform is a product called Options Play. And as I said, it's fully built into our platform and into our trading screens. So it's an idea generator. And so I just kind of wanted to conduct a quick walkthrough in the time that we have today and just review how you can use this to isolate small caps or different types of equities that you're interested in and develop different ways that you can conduct trades on those to play it whichever way you feel. So what I've done here is just a general overview. Excuse me. You'll see there's 3 panels here. Basically, you've got your what, why, and how of options play, and the what is, excuse me, the stock. So what I've done here is I've created a small cap stock watch list and some big names, a lot of the ones that are higher volume for this period recently. In addition to that, you can go to the trade ideas, and these are cultivated by options play based on a daily scan, looking for stocks that meet certain criteria. And as you can see, these are able to be isolated down to small cap, medium, large, and whether you're bullish or bearish. So we'll go back to my watch list, which is the small caps. And so you'll see there's also a score, and what that is a technical score, and it's a 1-month technical score. And you'll see each stock will be given a certain score. So there's a couple scores in here, and we'll go over those. What I'll focus on today is one that seems to be somewhat popular, blink charging. It's one that I see frequently these days. It's got a score, technical score of 10, and so what happens when I click on blink, it'll populate the data in the 2 other panels. So that's our what, or our how. The middle is our what. So what it'll do is break down blink in terms of where it's at. It'll give you a 1-month, a 6-month trend, the range, a dividend, volume, and it'll give you the chart, as well as some key support and resistance levels, earnings dates, and price action. So it says in plain English, it's in a bullish trend with resistance at 34.67. So we'll stick with what looks to be a bullish trend, and we'll remain bullish in terms of looking at option play ideas. So in addition to this, you can play around with the chart. We do have a completely different charting package, but this one's built into options play. And you can review the 1-month, 3-month, 6-month charts. And so you've got a fair amount of data to play with there. So the real meat of options play is going to be the 3rd panel, which pretty much reviews the why, what's going on. So blink charging, if I'm bullish on this stock, hypothetically, it'll give you 3 examples of a way to play that from a bullish perspective. Certainly buy 100 shares and it'll give you the cost. So that costs you $27.47. There's a bullish option play, which would be just go long a call, a Jan 21, a $27 call. That would cost you $500. And then there is the vertical call spread, which is suggesting 27 to 35 for Jan of 21. And that would cost you $295. So you'll see below that there's a score as well. And that score is strictly a risk-reward score. So what you're risking to what the potential gain is on the trade. And so as you'll see with the vertical call spread, a score of 88, you're risking the least amount of money, $295. And as you can see below here, potential return, if it meets your objective, is 171%. So there are two parts to this third panel. There's a trade generator, and then there's an income. We'll touch on the income in a few minutes. But going down below that, this is an important piece to options play as well, that it kind of cuts through a lot of the the noise in the markets. It really kind of hones in on different ways to play, and it'll give you the information in a plain English format. So there's three screens on this bottom right section, and we'll go through those now. So the first one is the P&L simulator. As you can see, buy 100 shares. If it goes up to the level they expect over a bullish run, there will be a 43% gain. And what it's basing that on is, as you can see below, it goes to this price of $39.53. You can modify that. These are completely changeable. I can lower that down to $32. It changes dynamically the potential for your profit and loss as well. You can also change the date of your expiration, and you can modify the implied volatility on it as well. So there's a lot that you can do there. You can also go above in the top panel and modify it. Maybe you think, long vertical, you want to change the strike. Maybe you think it'll go higher, and you can modify those in here, and it'll automatically display what your potential profit and loss is there. So going back to the first screen, that's the P&L simulator. The second screen is essentially, it's just telling you in plain English terms, what are we looking to do here? So with the vertical call on the right, it says it's a bullish strategy with a limited risk of $295 and a limited potential reward of 505 based on these parameters that I reset. And there's a 32.5% chance of probability that this will happen. So it really kind of breaks it down into much more understandable terms to really help you understand what you're looking to achieve with these strategies. The next screen, looking at, so here you can input different amounts in terms of how much you want to invest or how much you want to risk. And it will modify dynamically the results of the trade in the top portion as well. Also, we have a trading range simulator. So as you can see, the initial set it to 39.53. Maybe I think it's going to be less. I can modify that down and bring that down or expand that range with this simulator. You can also change the expiration date. And so there's a lot of things that you can sort through without having to really dig into a bunch of option chains with a lot of different strikes. And it cuts through to the exact price that you're looking at. So. And the last screen that we're looking at is essentially this lets you modify the strategy. Maybe you don't want to do a vertical call spread. Maybe you're looking to do, I don't know, a condor or something like that. So as a result, you can come down here and look at bullish strategies, bearish, neutral, sharp move, or all strategies. And so you can see here all of the various option strategies. And you can put those in there. And as I said, it'll give you plain English in terms of what you're looking to achieve with that strategy. So just looking to simplify this for our clients and really make it visually easy to operate and see. So going back to the first screen, as I had said initially, we fully integrated this with our trading platform. Say the vertical call spread, the 27 of 35 for January. I want to trade that. Simply click trade here. It'll bring up an order ticket with a strategy checklist. So we'll look at this. And so it's going to give you the trend. It's a bullish trend. The market trend is bullish for 1 month on the S&P. Option play score of 88 is good. Earnings dates. There's no earnings between now and expiration. but it's giving me a warning on the bid ask of the spread is large. So this particular stock, which is common with small caps that trade less, is going to have a wider bid ask, and that's the warning there. So it's just additional checks and balances for you to make sure you're doing exactly what you're looking to achieve. So if we have a few more minutes, I'll also touch on the income. So if your option strategies are more income generated, and you're interested, you're bullish on Blink, it's going to give you different scenarios where you can do covered calls or cash covered puts. And in these different scenarios, it gives you the cost, the reward, and also projected yield and percentage chance of winning on the trade is there as well. And as well, that's built into the trade ticket where you can automatically bring that up. So just to summarize, Options Play is a great tool for those who are looking to simplify option strategies and just put it into a much more visually attractive situation there. So it's a product we're proud to offer you. Like I said, it's free to all users. If we have a couple more minutes, I could touch on the platform itself. Our trading platform is fully streaming, and like I said before, it's widget based. You can customize your own screens. There's a tab here of all the various widgets that we offer, from news, charts, research, option chains, order entry, portfolio analysis, statements, confirms, everything you'll need right at your fingertips. So we appreciate that. And if you have any questions, feel free to contact myself. I'm at sherrin, SHERRIN, at eoption.com, or you can visit our website at eoption.com.
Sean, thank you so much. Again, can you give that website one more time for everyone to reach you at?
Yeah, absolutely. Thanks, Shelby. I appreciate all your efforts there. It's www.eoption.com, eoption.com.
Perfect. Thank you so much, Sean. Stay safe.
Thank you. Take care.
Bye. So I think we are waiting on the one and only Hot Stocks Luke to jump in here real quick. Luke, are you here with me? Well, he should be jumping on soon. In the meantime, we're getting ready to move over one of the hottest panels of the conference. That's the electric vehicles panel. They will be coming up here very shortly with our very own Chris Katcha as the moderator for that panel. So I'm going to get them started moving over while we wait for Luke to join us. Chris, are you here with us?
I am.
Hi, Chris. Good to see you in this format.
Chris, good morning. Good morning. Good afternoon. How we doing?
Still breathing, made it halfway through the week. Hard to complain.
That's right.
Rod, how are you, sir?
Hey, Mark, how you doing?
I'm well.
A little multitasking here.
All right, guys. Luke's taking too long, so we're not going to wait for him. You guys have the floor. Chris, please take it away.
All right, guys. So we're here doing our electric vehicle panel. I know everyone's been waiting to get going on this one, so we're going to kick it off. First, I want to introduce everyone. So we have Elf Poor from Ideonomics. That's symbol IDEX. We have Rod Keller from Arrow. That's symbol AYRO. We have Mark Fronmeyer from Arcimoto. That's symbol FUV. And we have Stephen Rossi from Worksport, symbol WKSP. So good afternoon, guys. We're going to dive into some questions here and get going. So my first question here is, how has the 2020 election accelerated the timeline of electric vehicles? So whoever wants to dive in here first, and we'll kick it off talking election.
Who wants to? Go ahead, Mark.
Happy to take a stab. I mean, I think the outgoing administration has certainly been in favor of domestic manufacturing, but with the Biden administration, we're expecting that there's going to be a much stronger focus on clean transportation and electrification. I think they've made that very clear, and so that should run the gamut from wider deployment of charging solutions as well as consumer incentives, and then again, I think pushing on domestic manufacture of next generation vehicles should be an accelerant across the board. Is our early guess.
Yeah, I agree with Mark. I mean, you saw Biden say in the last couple of weeks he wants to spend $2 trillion to build out 500,000 charging stations, and that create 1 million jobs. So, fortunately, I think that's received pretty favorably in the EV space.
Yeah, I agree. The charging stations for me being the key. I think we're way behind where Europe and particularly Asia is on the charging side of it, and that really limits because what EV in the perception of the average driver, because that range anxiety starts to creep in if you don't have access to the right kind of charging.
I'm with all of you guys on the same thing. Speaking from as a Canadian looking inwards, I believe the administration will keep the momentum. I think there's lots of momentum in that segment, in this segment, and I think that the administration will just keep rolling it forward and support. Yeah, I think the biggest push I forecast would be in the charging network and electrical grid infrastructure.
And I mean, I guess it might be obvious, but I think it bears mentioning just that having a cohesive national strategy that we're executing, I think is going to make a big difference versus what we've had now, which is a lot of private ventures have been going after various aspects of this. And I think we've all been doing a credible job moving the ball forward, but having really the federal government can do a lot to make this stuff go a lot faster.
Yeah. Well, I see here that there was already one of the key promises of the current administration, or the incoming administration, was the creation of the promise of the creation of 1 million new jobs from improved roads to EV charge stations. So I can't wait to see if that's delivered.
Awesome, guys. I want to stick with charging stations for a minute. So, and maybe we'll jump to Alf first here. So I know one of the things Ideanomics is doing in China is helping to put charging stations at traditional gas stations. So do you guys think that we ever see this catch on in the United States, or will we continue to see the trend of charging stations kind of popping up at big box retailers and, just kind of off along highways like they've talked?
Yeah, this is a really interesting subject. This is where we hope the Biden administration delivers for us, because not all chargers are created equally. And one of the biggest issues in the market right now is if you have a smaller vehicle, these level 2 chargers that have popped up everywhere, at 7-Elevens and public libraries and things. These are useful, but they just give you a little top up, right? They're not really useful for what the current energy grid, which is the gasoline and diesel stations, provide. And, people talk about level 1 chargers, forget about level 1 chargers, right? Once we move into the mainstream vehicles, a mid-size, full-size SUV or a pickup, it's going to take a week to charge on a level 1. Level 2, they're nice to have, right? But the convenience that I've found of those is the same as the feedback that we're getting out of China, which is most people go in and plug in at a level 2 charger, which of course is AC. Level 1, level 2 are both AC. Help the audience understand that. They're taking advantage of what is currently preferred parking. Most people, and I see this as well in the US, most people using level 2 chargers, it's because the parking spot's right outside Target, right outside Walmart, or the equivalent over in China. So those are really not very useful to you. The level 2 chargers, what I have at home, right? And this is where the dynamics are a little bit different with EV than the normal vehicles. When I first got my EV, I charged it every night. Okay, now I charge it once every 2 weeks, right? But when I'm out in the field, if I'm commuting, if I'm doing the short local trips that make up most of your driving, right, I don't need a level 2 charger. And that's what most of the infrastructure is right now, both in China and in the US and in Europe. We need DC fast charging, right? Okay, because the level 2 charger at home is taking care of all of my energy needs. Okay, it'll give me up to 250, 300 miles per charge, depending on driving the car. So it's the DC fast charge that we really need. Right, and right now, I've got a smorgasbord of apps if I want to take a long trip anywhere. And so, if you're the typical, I live in the New York area. You want to do your typical trip down to the Carolinas in the summer, or you want to go skiing up in Vermont, you can't get there with level 2 chargers. You just can't do it, right? And there's a lot of things people don't understand as well. Depending on the type of vehicle you've got, depends on how fast the battery charges. Right, so some people say, you can charge DC fast charger, you can go from 10% to 80% in 20 minutes. Right, these guys, other guys on the call here will tell you that battery's got to be at a certain temperature in certain conditions to get that kind of fast charging capacity out of it. And what we need is the fast chargers. Currently, the fast chargers cost a lot more than the level 2 chargers. So what I'm hoping for the administration is the infrastructure to help private enterprise work with state and local governments to get those DC fast chargers in place, and also to bring down the cost. Because right now the difference between a level 2 charger and a level 3 fast charger is not the difference between regular unleaded and Power Plus or Super Plus or whatever they call their high-end energy brand. So a lot of room to clear. The driving, at least from the study we're doing now in the States, the driving dynamic is exactly the same in China as it is in here, which is if you have a level 2 charger at home, it does 90% of your driving needs, right? And it's really what you need access to when you're out driving is that fast charger. You need to get quick access to energy that gives you enough to drive on to the next destination, which is what you currently get out of gasoline and diesel.
Yeah, if I might add maybe a slightly contrasting perspective, I would say certainly that the one aspect of having very large electric vehicles is that they require a lot of juice. But I think you'd find with what we're doing at Arcimoto, certainly what Rod is doing at Aero, is much lighter weight, much more efficient electric vehicles that are tuned for everyday driving. And so that's where having, to me, the ubiquity of level 1 is actually would serve that 90% usage case. But I think you're right on that for the long distance trips, the real focus should be on DC fast charging available everywhere and having a common platform, common app framework, whatever you have that lets customers very easily plug into a heterogeneous charging network. But if we want to really, the low hanging fruit are the trips that we do every single day to go get a cup of coffee or go to work or whatever. And the reality is, as long as you have a very efficient vehicle, you don't need even a level 2 charging station. You can put that plug in, the outlet in my driveway is all that I use to charge my Arcimoto, and I use it every day.
Agreed.
Even anything to add there? I know your trucks have kind of a different charging platform here with the solar.
Oh yeah, so I mean our position is much. I guess we looked at things from a different angle with the Worksport. We're a bolt-on accessory, and we have to be finally connected with the EV side and what's coming on to the markets. As much as we appreciate lightweight, these EV trucks, the market is obviously upgrading in size more from small sedans to. I think the EV market's a little different, but SUVs, pickup trucks are very popular, very common and forthcoming. So I mean, we're talking 150 kilowatt, battery systems or more. And I love hearing fast charging, but I'd like to know where the power is going to come from and how fast the power is going to get there. So when these vehicles are widely adopted by 10% of the population. Which are still only a fraction. Is there 600 volts or 400 volts or 500 volts to fast charge these vehicles? I don't know. I'm not an expert in that, but my intuition says that there isn't. So as much as I think that we can step forward and figure out, common sense indicates that there should be fast charge stations every 100 miles or 50 miles. Is there enough power to, and then are we talking about grid sharing? Are we talking about times? Like, okay, you can access this charge station from 6 to 10. Does that work for, a family of 3 or 4 trying to make the travel home or, away for holidays? So I think that there's a lot that needs to be addressed to that. And our solution, to talk more about what we're doing, is we're trying to take that off grid. So our world is pickup trucks. There's a 700 to 1,000 watt canvas, on the back of this pickup bed, that we can improve that. 700 to 1,000 watts is obviously in today's solar technology, but we can improve solar technology. It is improving. It has improved over the past decades. So we're trying to become 30% of the power needed every day, so that level 1 charging stations can kind of top up overnight as vehicles improve in efficiency. I think that my feedback on the point is, to recap, is that I think charging stations are important, but I think that there's a much bigger step that needs to be taken first in the infrastructure of the electrical grid. And then also, I think the statement that needs to be made for all of us as pioneering members of this market is, we're embracing EVs as a way to answer a problem that Mother Nature is telling us we have, in that there's global warming and there's too much carbon emissions. So what's the answer to the power grid? So we don't have enough power, and are we going to produce more coal plants or natural gas plants, or even nuclear plants? Do they have a footprint of carbon emissions? I believe so. So then the answer is, my questions. The answer to the question is, another question is there enough power? And to get enough power, are we really just deferring the emissions of a gasoline vehicle to a much larger, smoggier producer? So to speak to Worksport, is we just take it off grid and we look at solar. We're going to continue to evolve, applying solar technology to become a meaningful source of trickle charging the vehicles on the back of trucks, as well as charge stations and other power plants, in terms of the future, more sustainable approach.
Awesome, guys. So I want to turn from charging to the vehicles themselves. So when we started with electric vehicles, it was, all about the car, and now we're shifting, to pickup trucks. And then we have some, niche players here, I know, with Mark and Rod. So I guess my question is, why is it important to kind of focus on some of those smaller markets inside the electric vehicle market here?
Rod, you want to take the first jump at
that? I think one of the few silver linings of COVID is that it has accelerated the mix in restaurants between delivery and brick and mortar dining. I think the market moved to us. We, much like Arcimoto, was already working on that space. But I think that the benefit is, in fact, you kind of identified the issue why we chose not to go into the consumer space, because the charging requirements for relatively short distance, low speed vehicles, let's say low speed more like our light duty electric truck, just isn't near the charging requirements like Mark was talking about. So we're excited about the size of the market. When you looked at the size of the market for delivery pre-COVID, it was already significant. It's even larger now. And also couple that also with the fact that many of these restaurants are faced with the challenge of paying as much as 30% of their ticket to the aggregators like Grubhub, DoorDash, and Uber Eats, and they're looking for alternatives to reduce their operating expense. So like the product that Mark's got with the Deliverator, one that we're working on as well, I think the market moved towards us, and it's not an insignificant market. In fact, delivery by 2025 is expected to be a $200 billion market. So to call it a niche, it's a big niche.
I call it sort of the 80% niche. And Chris, I think the important point to recognize is that the initial assumption of the EV industry is just that we're going to take the vehicle topologies that we've already got, the four-wheel car that carries 5 to 7 people, and we'll just make that electric. But you're talking about an energy source that is 1/25 of the energy density of gasoline. That immediately favors lighter weight, more efficient solutions. And so our whole thesis at Arcimoto is let's notice this giant disconnect between the car and how we actually use cars every day. And let's build products that actually fit the way that we use cars. So we're building a consumer vehicle that carries 1 or 2 people, a relatively short distance with a small amount of stuff. That happens to be the vast majority of trips on the road. So you can look at it today as kind of a niche, but we see that as being really a fundamental advantage for Arcimoto as we go forward, is that we just do a lot more with less. And that means that has implications on the charging side. It has implications on the cost of the vehicle. And then at some point, we got to really reconsider the fact that we dedicate 50% of our urban landscape to asphalt and concrete to move cars. And yet we've got gridlock in every metro in the world. So I think there's a real opportunity here in the shift to electric to rethink our basic footprint of mobility.
I agree with what the gentleman is saying. I mean, certainly our Tree Electric division in Malaysia, we have the small vans and trucks that look very similar to some of Rod's product line. And, they're perfect for local last mile deliveries, food trucks. There's a lot of side of the road kind of vegetable stands and things like that go in that part of the world. And we're seeing high demand for those. And when you work in an area like we do in the ASEAN region, two wheels are the main form of transport because of the cost. So whatever you introduce to market, it can't bring sticker shock to the population. And that's where these smaller, lighter types of vehicles with less energy needs, have a role to play. And I agree with both of these guys.
And Rod said as well, and I think it bears repeating, is just that the patterns around delivery have changed and are changing still. When the model for Amazon 5 years ago was you fill up the truck in the morning with a whole truck full of packages and you deliver them all day long. But they're wanting to move to just-in-time delivery. Food delivery, meal delivery is just in time. And that favors vehicles that are lighter, more maneuverable, more efficient over big vehicles.
Yeah, I mean, even one of the classic uses for battery EV is the delivery truck. We spend a bit of time with, the Amazons, the FedExes, the UPSs of the world. Their trucks run an average of 30 miles a day. That's it. Most of the time diesel. If you're a UPS driver, you don't even get a door, right? So you got to have a kerosene heater in the car. They're a really good use for a case work. But the bigger the truck, some of the things that we're used to in the US, pickups, SUVs, these are where you're going to need, Steve said, you're going to need a lot more energy.
I think a really important point, because nobody talks about it a whole lot, and that is if we build beautiful vehicles that are very efficient and half the operating expense and great for restaurant delivery, we can't go have a conversation with the COO of Subway. They're going to ask us, how do I store it? How do I charge it? How do I finance it? How do I maintain it? How do I repair it? How do I insure it? So if you don't build an ecosystem, and you're probably not going to do it all internally, you're going to have to do it through strategic relationships. None of us are going to go be able to deliver on this, this vision and this market size of $200 billion. We don't solve this other problem as well. Yeah, so I'm excited about it, but it's not a simple challenge.
I mean, it's a really interesting point Rod makes. I mean, that's why we started our MEG group in China, because it's not enough just to have a range of vehicles and go to a commercial fleet operator. You got to tell him how to, where he can buy the best vehicles from, how to fund them, how to get them charged. It is a whole ecosystem.
Yeah. I think there's also an onset too in broader markets on top of the broadening just-in-time deliveries, where Amazon and other distribution models are setting up, localized distribution centers. I think that the carriage of package and delivery for small vehicles, like 30-minute runs, quick in a small demographic, is important. I also believe the future for vehicles may be less like ownership and leasing and more ride sharing and membership driven applications. And I think somewhere I was reading recently in some documentation that statistically, Uber moves 1 or 2 people at most, as opposed to 5 or 6. So I think that, to speak to our market, not to keep talking about our market, I think that there'll be the person that needs the big truck, and then there'll be the rest of the population that just needs to convey 1 or 2 or a family. So there'll be a lot more demand on smaller, lighter, more nimble vehicles that I see as definitely being a strong way to the future.
Yeah, Stephen, I mean, spot on. Something like 80% of rideshare is 1 passenger.
Yep.
And I mean, and again, if we look to the future and say these vehicles aren't just going to be electric, they're going to be autonomous.
Yep.
And they're all going to be shared, then that ultimately means that approximately 80% of the vehicles out there are going to be sized for that type of a job. Yep. And so that's really, I think, why we've been focusing on the right size platform. Is it's just in the shared, connected, autonomous electric world, that's the platform that makes sense for the vast majority of vehicles out on the road.
just get me to where I need to go. You know what? I'm in Toronto, Canada. You know, the busiest, most traveled highway, I think, in at least North America, is one of our highways, and we're parked on that highway every day. I'm looking around, seeing SUVs, pickup trucks, and monster vehicles with barely one person there. You know, so I think that there's a larger shift to micro vehicles, like get me to where I need to go, and the rest is immaterial, safely and comfortably. So I agree, and then yeah, so we start looking at how does that look like in terms of it needs less power, it's lighter, it consumes less. So it really mitigates a lot of the broader pictures of maintaining versus maintaining a bigger vehicle footprint, which I completely agree with.
There's a quote I'm reminded of it. I'm going to butcher it, but it's the carpenter doesn't want a quarter-inch drill. He really just wants a quarter-inch hole, right? And so you focus on the job that needs to be done versus the tool that does it.
Yep, precisely. I agree fully.
Awesome. So I know Rod started to touch on food delivery. So, you know, I guess that's my next question here. Obviously, with the DoorDash IPO happening today, the pandemic, we've seen the surge in food delivery. So some of these smaller 1- and 2-seater vehicles seem like great offerings for restaurants and retailers. You kind of talked, Rod, about building an ecosystem. So is the goal here to, you know, go after those restaurants directly, to partner with someone, or kind of go after some of those food delivery companies and try to partner with them? I guess, Rod, if you want to kick us off here.
Yeah, we're going to talk to both sides of it. We'll talk to the aggregators, and we're already talking to some of the large quick service restaurant franchises. I mean, they don't like giving up 30% of the ticket, but it's not only that, it's also they losing control of the experience. They don't know what's going on at the other side of it. Not to mention they're losing the opportunity. These vehicles could be a rolling billboard for them. So, and I don't believe, and Mark probably agrees as well, I don't believe that the mix of delivery versus brick and mortar dining is going to go back to what it was after we get vaccinations and COVID gets eradicated. I think it's going to be this way going forward. I'll give you another example real quick. One of the things that we were surprised by is that the light duty electric truck that we build, we work with a company in Colorado, and they converted into what I'll call a mobile hospitality. It's not like a food truck where somebody's cooking inside of it. But now companies like Sodexo and Chartwells and Aramark, they have these big contracts with universities, and they're like, how do we get food and beverage to students, grab and go food and beverage, if we can't force them into the dining hall? So you're going to see more and more vehicles like what Mark manufactures, what we make, strategically placed around campuses so people can get access to food on the go rather than forcing them into dining halls, violating this whole social distancing situation we're faced with.
Yeah, I mean, whether it stays at the sort of 10x of where it was before or pulls back a little bit, it's not going to go back. I mean, the barrier to adoption is getting the app on your phone, making your first few orders, getting your grocery pick list set up for the week. Once that's done, you realize, wow, this is actually a much more convenient way to do it. And so, yeah, I think how we, I think there's going to be a discussion about how do you disintermediate a lot of the kind of the early services that are going in order to get the right vehicles into the mix, right? You want to figure out how do you get the right vehicle doing the delivery that is the most efficient one, that's the most cost efficient for the driver, that nets the restaurant the most piece of the pie. And I think we have a piece to play, both Aero and Arcimoto, in that vehicle world, but I think also encouraging the right broader ecosystem, to Rod's big point, is going to be a really key part of that.
Awesome. I know one of the questions I've seen with some of these, newer vehicles without the doors and such is kind of the insurance market. So how does the insurance market play into some of those new vehicle offerings that are kind of away from the traditional vehicles that we've seen?
Well, so I mean, we announced this earlier in the year that Progressive now, the largest motorcycle carrier in the country, carries Arcimoto insurance just on their website. But I think there is a bigger story there, and particularly around gig delivery or gig rentals, fractional rentals, vehicle sharing. That's going to need to be solved to make it a very seamless experience and low cost experience for consumers.
And this is an important point Mark just made. The EV vehicles are going to last a lot longer than internal combustion engine vehicles, whether it's being delivered on a bike, delivered on a car. They're going to last a lot longer. They're going to be a lot more reliable. There's less moving parts. So this needs to be baked into whatever new model comes forward, fractional ownership, whatever it is. The restaurants and others have a chance to participate in this. And I think it's very meaningful for everybody within there because, you know, delivery of food done quickly, right? At the moment, we all rely on it being cheap and effective. One of the most expensive parts of it is whatever you use to get your delivery there, whether it's a moped, whether it's a car, whether it's, you know, these two new types of vehicles these guys are bringing to market. And just the longevity and you know, less time off the road these vehicles are going to bring in plays importantly into that dynamic. And that's why I think fractionalization could make it much more beneficial cost-wise for the gig person who's actually, you know, taking the delivery from the restaurant to the person.
Awesome. I want to talk batteries here. So cost of batteries has been coming down. So how important is that for electric vehicle adoption and for getting costs down kind of with mass production here?
It's the most expensive component in the bill of materials.
Yep.
So as energy density gets better and cost comes down, we'll get close to the same, you know, operating expense valuation. So I mean, it's moving in the right direction, clearly.
Yeah, there's I've spoken about this a lot in other interviews because we've been feeling the you know, the pain and the path through on this in China, which is you can't get the vehicles financed easily because of the cost of the battery. And really, it's an odd thing because they're saying, well, I don't have a blue book with 100 years worth of residual value data in it. But the bottom line is the combustion engine is much less reliable. So even without the battery, the vehicle itself is a lot longer lifespan than a traditional automotive, you know, car or van or whatever we've been looking at. So it's a little bit of a strange thing. And the folks that do the financing of these things are, you know, dipping a toe in the water slower than the market's progressing. You know, we've had to do a lot of stuff in innovation in China to solve that puzzle. And it's going to be the same puzzle here until the cost of that battery comes down. So, you know, you're looking at two SUVs and one may be a hybrid, one may be a fully battery EV, and there's no cost differential. Until we get to that point, you know, we're looking forward to seeing the battery come down.
I mean, I think that's a good point. It'll be interesting to see what happens with the new administration because, as we all have experienced, the tariffs on Chinese imports has impacted the cost of our vehicles and particularly the cost of lithium ion. So we'll see what happens with the Biden administration. Maybe some of those tariffs may get reduced or eliminated.
Yeah, and they need to. I mean, basically, no China, no automotive industry, right? No China, no cell phone industry, right?
Yeah.
They're the manufacturing base for everybody. It doesn't matter if you're Ford, GM, you're these guys who are coming new at the market with more innovative vehicles, but you don't have China's manufacturing cost base, you're out of business. So we really need the assistance there. And previous administration obviously got into some difficult conversations that saw some tariffs and things that we'd love to be seen taken down.
The one thing I would probably add to that though is that I'm assuming you guys all have, but for folks in the audience who have not seen Tesla's Battery Day presentation, you know, there is huge opportunity to fundamentally reduce the cost of the battery, and Tesla is absolutely leading the way globally on that story. And you know what, if you look at the EV today from a total cost of ownership perspective, it's a no-brainer if you can buy the vehicle and have, you know, deal with the financing and so on. But to make it the real broad consumer win, it doesn't have to just win on TCO, it's got to win on the sticker price. And that's what, you know, over the next couple of years, I think we're going to see that cost parity come into effect, and that's going to be a major catalyst for really a transformational shift in the market. I mean, the only, you know, we as Arcimoto, you know, we don't make battery cells, we make battery packs. Our thesis is just all about using less. So use less battery to do more. But I think that we gain the benefit of the broader industry trend towards lower cost batteries.
Yeah, 100%.
I agree. There's also there's forthcoming technologies as well, more and more. I think that there's a lot of ground to be made on battery technology. I think that this landscape's going to evolve rapidly in terms of moving forward and in the chemistries and deployment of energy storage solutions. So, you know, my opinion is Although I agree, Alf, that anything moving forward, if it's not coming overseas, or if we're not approaching things with a global community in mind, it really does put a challenge all the way to the sticker price of the vehicle, which brings into question the sales affordability and economics. But more so, I think that technology, in terms of different forms of lithium iron phosphate, and even the forthcoming, graphene or solid state batteries, I think that we'll look back at this in mere years, kind of at a chuckle, saying, wow, this has just come so far, and Tesla is definitely leading the way. But where there's one Tesla, there will be future innovators similar to that. So I'm just sheerly, although the costs are coming down, our own battery systems, are more affordable through economies of scale. But I just can't wait to see what happens when things get better, because we're only just beginning with this, although there's years behind it.
I agree, and this is what we're all trying to get to, right? At the moment, let's be honest, that your average EV right now, it's for the upper middle market only. It's not for the mass buyer. The mass buyer can't afford. I've used an analogy a few times. Certain EV companies looking to give you lifelong fuel or hydrogen lifelong fuel. That's like buying your home and prepaying your gas, internet, electric, and water all up front. Most people can't afford to do that. We need to get EVs to the point where the model is very similar to what they are now. And once the cost comes down, then you'll see the main tipping point where the majority of the mainstream market can afford to enter. Because right now, these are toys for people with money to spare at the end of every month. And that's what we need to change.
And I think, if you look at the whole sort of target for EVs has been, let's get to the affordable electric car that we're defining as the average new selling price of a car, $35K. I mean, that's actually expensive. The bulk of the car market is in the used market, which is, in the $10,000, $12,000 range. And so that's definitely certainly core to our thesis is, let's make actually affordable electric vehicles that can replace the vast majority of trips.
Yeah, and I love what Ford and GM are doing, right? It's going to be still more expensive, but the fact that they're putting, iconic brands like Hummer and the Mustang up for their launches of their vehicles, this is a move in the right direction. It's going to get the enthusiast on board. It's going to get the mainstream vehicles out there. That is their pathway for them bringing out the Ford Focuses and the much more affordable vehicles that come up in that price range that Mark was talking about, because most people don't buy new and most people don't spend more than 15 grand.
Awesome. So you guys started to hit on Tesla. That's going to be last question here, is kind of talking the big elephant in the room with Tesla. We've seen their market cap jump this year. They've been in the news. So obviously, it looks like everyone is kind of going after, some different markets and not competing necessarily directly with them. But how has the visibility of Tesla and the EV market overall, has Tesla helped with that for your individual companies, or has it not really, helped at all? So I guess start with Mark here.
Yeah, I would say, Tesla has done a fantastic job of disabusing the world of the notion that EVs are pokey golf carts. Right? They are incredibly desirable, top performing vehicles the world over. And that has been, they've been leading the way on charging infrastructure deployment, on, getting autopilot out to the mass awareness point. And so I think that helps us all in terms of building certainly the awareness in the market for the need to move and make that shift. Same mission. Same team. I would not want to be going toe to toe in terms of product family, just because I think that they've got such a head start, certainly over the incumbent automotive world, in terms of charging network, battery, drivetrains, manufacturing. I mean, they're just really hitting on all fronts. So that's where I think, our push has been to really kind of go after a niche that they're not really interested in.
I think a lot of people, go on, please, Rob.
No, go ahead. That's all right, Al.
I think a lot of people misunderstand Tesla as well. Okay, the reason Tesla's got that value that it has, not many automotive manufacturers are going to get there. Right? These guys have perfected an Apple-like model. Okay, they have the proprietary charger, they own the software, they own the hardware, they own the energy access points, which most other people don't do. So they are that ecosystem that Rod was talking about earlier. And look, most people don't understand. Tesla are not just in the car business.
They're in the electricity business. They're in the battery business. They're in the solar business. They are the complete end-to-end model.
And that is a highly risky strategy that paid off for them. The only other company, and I mean across industries, that was ever successful building the complete ecosystem was Apple. Think about it, the only ones. That's why when IBM, 40 years ago decided this open-ended architecture everybody could do, they thought that was the right way to go. And Apple's the largest company in the world now at over 2 trillion market cap.
Yeah.
I have a selfish interest why we are excited about Tesla, because we only play in the commercial space today. Tesla announced a gigafactory where they're going to build a truck in our backyard here in Austin. And I think there's an opportunity for us, because I'm sure Tesla uses jet inventory for all of their components that suppliers supply to them. And if we can find any commonality, we'll get the benefit of using those same jet warehouses from suppliers to us too. So
I think Tesla's also done a really good job sort of teaching the importance of aiming for fundamentally lower cost structures, right? You want on the upside, you want recurring revenue from things like robo-taxis or rental vehicles or whatever. And then you want a business model that takes out intermediaries and lets you go direct to customers. And so I think that we definitely look at ourselves as both a vehicle company and a technology company. And I think there are a lot of things that we can do for the market that we serve that pattern after a lot of those same approaches, albeit we're not going to go make solar panels and we're not going to go manufacture battery cells, at least not anytime soon.
Yeah, the Tesla system is definitely, Tesla as a company is an ecosystem far beyond just a vehicle, although it's bringing an attention of a company that reaches milestones. So any participant in the sector or supporter investor in the EV sector can see what the path forward looks like for companies that approach things frugally and with innovation. So it does kind of give people a little bit of a crystal ball of what things can look like in vague senses. But I also believe that, with people just on this panel, as well as, other companies forthcoming and emerge, there's going to be a little bit of a divergence, as well as people learning to accomplish the same thing differently. And then as opposed to building the ecosystem, which Rod, I agree, can be dangerous if not done properly, looks to expand their business network through, collaborations and partnerships to form that same ecosystem, as opposed to trying to be the master of all, just the master of their craft.
Awesome, guys. So we got to wrap up here. So I'm going to go ahead and let all of you, say who you are again, your company, the stock symbol, and then if you want to tell viewers how they can reach out with questions to either yourself or your investor relations team. So again, if we just start with Mark here and you guys go one by one.
Sure thing. Mark Frohnmeyer, founder and CEO of Arcimoto. Our ticker symbol is FUV. Our website is arcimoto.com. You can go to our IR portal at arcimoto.com/IR, send emails to investor@arcimoto.com, and you can sign up for our newsletter. Also, put in a pre-order for a vehicle. Thank you. Really appreciate the opportunity to be on the panel, Chris.
Thank you.
Yeah, this is Rod Keller. Rod Keller, I'm the CEO of Arrow. Our stock symbol is AYRO on the NASDAQ. Our website is ayro.com. There's two ways you can email us. You can either email us via sales@arrow.com, ayro.com, or investors@ayro.com. We're only in the commercial space. Welcome you to come look at our website. And you can also send an email if you so choose to rod.keller, KELLER @arrow.com. Very good.
We're ideanomics.com. I think you can see above me, maybe. They got a background, symbol IDEX. You want to reach us, IR@ideanomics.com. Always happy to answer investors' questions.
I'm Stephen Rossi with Worksport, ticker WKSP. We're at Worksport Limited on all, at Worksport Ltd on all social media platforms, www.worksport.com, investors@worksport.com, or sales@worksport.com, and invest.worksport.com for Reg A direct investment opportunities.
Awesome, guys. Thanks for joining the panel today, and we look forward to following your progress.
Great to see you guys.
Thank
Cheers.
you. Thank you very much.
All right, chatters. How about that panel? I mean, let's talk more EV for a second. And big shout out to Elliot for putting this one together. But guys, the whole point of today is to get trade ideas, to make money together, to figure out where stocks, where we can put our money. So throw in the chat all the EV stocks that you own. That's my first challenge to all of you. I'm gonna have a couple more challenges, but first of all, throw in the chat all the EV stocks you own. I want to crowdsource this thing. I want to get some more money into this thing. And you know, that panel is exactly why right now I've got a trade going against NEO. I've got NEO $40 strike January 15th because there are so many amazing places for investors to put their money, especially in this space. I mean, it's incredible. So
I'm excited about one that we didn't see today, Candy Technologies. I think we might see them next year at a Benzinga event, but they're fun too. But we had 4 amazing companies in that panel.
Yes, absolutely. The chat is going crazy. Guys, keep throwing those tickers in. Again, we want to crowdsource this thing. Again, that's why I've got my bearish trade on NEO, is because I think that there are so many amazing companies to invest in. And to all you EV investors out there, let me throw this one at you. So up next, we're going to be talking real estate. And if you guys are investing in EV, it's because you're futuristic. It's because, you know, you're looking ahead, right? And if you want to talk about an industry that's seen sudden change, especially this year, I mean, think about real estate. Think about how much has changed with COVID, you know, both on the residential, on the commercial side of things. And so if you're looking for opportunity, I mean, real estate is, I think, an amazing place to look. I've been spending personally a ton of time looking into the real estate space. We're going to talk REITs. Again, if you guys are EV investors, it's because you're futuristic. You want to understand this stuff. So I want to bring on to the stream our next panel. We got David Auerbach from World Equity Trading Group and IR Realize. David, I'm going to let you take it away. Let's get into this thing. I mean, we've got a huge fired up group with us. So I'll go hide myself. We'll talk more investing ideas, and you guys can hit it.
Thank you, Luke. I really appreciate it. In my next life, I want to come back and be Alf Poor with the following that he does. My name is David Auerbach. I'm an institutional trader with World Equity Group. I'm a consultant on behalf of IR Realized. I am the co-author and contributor to the Daily REIT Beat newsletter. And I'm honored to be joining you guys here today to moderate the REIT ETF Exchange Traded Fund panel. Joining me is Alex Petty, the President Director of Research and ETFs for Hoya Capital Real Estate, which advises ETFs and individual accounts by investing in portfolios of publicly traded commercial REITs and residential real estate companies. Launched in March of 2019, the Hoya Capital Housing ETF, ticker HOMZ, is a $40+ million passively managed diversified ETF that offers efficient and cost-effective exposure to residential real estate and invests in 100 domestic companies involved in the housing industry, including residential REITs, home builders, home improvement companies, and real estate services and technology firms. I'd also like to introduce Alexi Panagiotakopoulos, sorry, Alexi, the partner and chief investment officer of Fundamental Income, the sponsor and index provider to the Net Lease Corporate Real Estate ETF, ticker NETL. In addition to founding and launching the Net Lease public-focused ETF strategy on the New York Stock Exchange, Alexi oversees acquisitions and investments for a private institutional net lease platform backed by Brookfield Asset Management, and they recently raised $500 million of equity in April to buy freestanding net lease properties all over the United States. Alexi previously served as managing director of SMS Financial, a private distressed debt firm, and previously specialized in underwriting at Store Capital, an $8 billion publicly net leased REIT, ticker STOR, that counts Warren Buffett and Berkshire Hathaway among one of its largest shareholders. The Net Lease Corporate Real Estate ETF is a rules-based ETF focused on income, whose goal is to track the performance of the U.S. net lease real estate sector in a diversified manner by including only net lease REITs and placing key weighting constraints on its holdings to protect against concentration in any one company or tenant. Finally, I'm joined by Jay Hatfield, the portfolio manager of the InfraCap MLP ETF, ticker AMZA, the Virtus InfraCap US Preferred Stock ETF, ticker PFFA, and the InfraCap REIT Preferred ETF, ticker PFFR, that all pay monthly dividends, and a series of hedge funds, plus leads the investment team and directs the company's business development. Jay is a prior executive and current general partner of NGL Energy Partners, ticker NGL, As formerly a portfolio manager, it's SAC Capital, 0.72 asset management, running a portfolio focused on income securities. I think that means Jay might be a Mets fan, but we'll save that conversation for another day. The InfraCap MLP ETF currently has over $153 million in AUM, seeking to provide exposure to midstream master limited partnerships with an emphasis on high current income across 43 securities. The Virtus U.S. Preferred Income Stock ETF has over $200 million in AUM, seeking current income and secondarily capital appreciation through a portfolio of preferred securities issued by U.S. companies with market caps of over $100 million across 155 securities. And finally, the REIT Preferred ETF currently has 57 million, seeks investment results that correspond before fees and expenses to the price and yield performance of the INDXX REIT Preferred Stock Index across 97 securities. Guys, thanks for joining me this afternoon. It's great to have you. I really appreciate it.
Great. Thanks, David, for having us. Appreciate it.
Thanks for having us.
Excellent. Well, we've had some good conversations. Let's just jump right into it. I'm going to throw this out there to all you guys. Why ETFs? Why should folks be buying your ETFs as opposed to the individual stocks that make up your various indexes? We'll go one at a time. Alex, I'll start with you and we'll go around the horn.
Sure. Yeah, so I think that, you know, the ETF market has really evolved over the last 10, 15 years from it used to be, you know, this pure passive index-based strategy. You've seen the rise of these newer kind of innovative funds that have really enabled investors to kind of capture the kind of best of the passive world, and but also kind of take on this kind of active portfolio management role. You know, and I think, you know, with the ETF, you're able to kind of invest in more of a theme-driven investing model, which I think is really consistent with how most investors kind of see their kind of asset allocation.
Jay?
Well, our funds are a little bit unique. So they each have their own rationale really for buying directly versus the underlier. So AMZA is a corporation. And so you get a 1099. So that cleans up your tax reporting. And also and of course you get a diversified portfolio that we actively manage, and we do write some covered calls to enhance the returns. And then also, since we launched in 2015, we have a substantial over $10 a share of deferred tax assets. So that gives you extra sheltering of cash distribution. So it has more attractive tax characteristics than buying the underlying. And then with the preferred ETF, so PFFA and PFFR, those are a little bit different. Those are just normal RICs pass-through, so no unusual tax characteristics. But preferreds trade a little bit by appointment, so they're 20-cent, 30-cent bid-ask spreads. Depending on your broker, we use Interactive, so they don't give as good of leverage, or you have to post more margin for individual preferreds than for our ETF. So even in our own funds, we'll use our ETF just to get better, to post less margin. And also then finally, PFFR is an index fund. It has smart beta, so a feature in it. It will eliminate anything from the index that has 3% or less yield to call. But PFFA is even better in that we're monitoring all the securities all the time, looking for the most attractive yield to call. And so yield to call for the average retail investor, you know, we do it on Bloomberg. You can do a spreadsheet and do the IRRs, but it's not intuitively obvious you can get the current yield. So to have that active management, manage the yield to call, and also with preferreds, you don't want to have low quality credit preferreds because they're junior securities. They're similar to common in bankruptcy. So you want to have high quality issuers. So it's better, we believe it's better to have an active manager select the credits versus just taking everything in the index.
Lexi, you're up.
I think going back to your question originally about, you know, why ETFs, I guess my question to the audience would be, do you take taxis or do you take Ubers? Do you use, you know, Postmates, or do you still, you know, go pick up every piece of meal or delivery that you get? So there's just technology, there's efficiency, there's liquidity, there's transparency. And at the end of the day, it's cheaper and more efficient. You can run a very similar mutual fund strategy or hedge fund strategy. Jay's a perfect example. In the old older trading days, you wouldn't be able to run the strategy Jay's running for what he charges, and it's extremely efficient. So ETFs today are extremely innovative, and they're kind of the new way. And you can see with mutual fund managers launching ETF platforms and fees coming down, investors expect better risk return in what they're paying advisors. Personally in our industry, one of the reasons we launched the net lease real estate index is because historically broker dealers offered their clients extremely high fee private REIT models that were non-traded. Then you saw interval funds, then you saw active traded interval funds, and so many different iterations of those that were charging 1, 2, 3% with 12.5% of high watermark returns, where now you can buy diversified strategies for somewhere between 15 and 80 basis points. So bottom line is it comes down to efficiency and what you're paying and what you're getting for what you're investing in.
Well, let's hammer that point a little bit further. And Alexia, I'm going to come to you first. But thinking about the landscape, I mean, obviously, if you're involved in REITs and real estate and ETFs, you know what IYR and VNQ are, and they're the two bellwethers of the industry. Why your thematic strategies and not going ahead and getting a bigger picture of IYR, VNQ?
Sure. I mean, I think you see it just inherently. I mean, first on the fee discussion, IYR charges 42 basis points, VNQ charges 13. Part of that comes down to this tax structure of how each of those companies is owned and held. The other part of it is, you're paying for a little bit smarter tilt. When you start getting into thematic products that are more actively managed or specialty like HOMZ or Jay's products or ours, NETL, there's a smart beta tilt to it. There's more of a human element. It's not just purely market cap weighted. So there's research that goes into it. And there's a very big distinction between purely market cap weighted indices, which many of the larger big four, iShares, Vanguard, Schwab, State Street offer. And then there's rules-based index strategies like ours and like other boutique ETF providers that actually have a qualitative and quantitative element behind them in the selection that still remain passive and are not actively traded.
Alex, what about you? Same thing, because you can go out and buy IHB and some of these other big home builder, XHB, excuse me. Why some of the other home builders ETFs versus you, or vice versa?
Yeah, the commercial and housing market are such a large asset class, right? So the housing market itself is about a $30 trillion asset class. Commercial real estate about 25 to 30 trillion, right? So that combined is larger than the combined market cap of every single US listed stock, right? And so the idea of kind of using a single fund, a single REIT fund to kind of represent it, to kind of capture the entire real estate sector is kind of like using kind of a single stock to kind of represent the entire equity bond preferred market, right? And I think that the bottom line is that, with this innovation, with newer funds, theme-driven funds, is that you can kind of pick and choose. You can tailor your exposure kind of more towards whether you're more income focused or more growth focused. And I think in the REIT sector, there's 18 to 20 individual property sectors, and some are very bond-like, and some are very kind of equity growth-like. And to kind of be able to kind of piece those sectors together in a way that's more kind of aligned to your kind of investment goals, whether, as I said, you're more income oriented or more growth oriented, it really kind of makes sense. And now investors do have that capability. Now there are numerous kind of real estate sector funds that they can really kind of create their own kind of custom basket, kind of using the diversified nature of the ETF.
And Jay, you've been around the longest of all these guys here. So why don't you give us your side on your side of things?
Well, again, our situations is quite different in that with fixed income on the preferred side, particularly, the yield to call is so critical. So if you look at the broad index, the yield to call on that index is about 2%. And it's about 65% financials. And our view on interest rates is quite negative. We're calling the 10-year Treasury the big short of 2021, primarily because the Fed is trying to drive inflation higher, and Treasuries are 70% correlated with inflation. And also we think QE will end next year. But in any case, so we, by purchasing our funds, either PFFR, which has that 3% minimum yield to call, or PFFA, where we're constantly cycling out the low yield, more treasury risk type securities, you get a different flavor where you get upside from the equity market, but no downside from the treasury market. And so it has different risk characteristics, and it's more diversified by sector than the broad index. So it's kind of an easy decision. I mean, you have to make your own view on interest rates and the market, stock market. And then, like as I really said before, with regard to AMZA, the primary benefit there, well, in terms of buying individual securities, you don't get, instead of getting 25 K1s, you get one simple 1099. And then again, because of the deferred tax asset, you get a superior tax characteristic. So on the MLP side, it's more tax driven. And on the preferred side, it's more driven by this yield to call issue.
Jay, I'm going to stay with you here for a second. Just give me 1 second. So according to NAREIT, the typical average REIT dividend yield right now is around 4%. You briefly touch on interest rates, and we're going to touch on interest rates because I know you and Alexi have some very interesting thoughts about that. We'll come back to that in a second. REIT dividend yields at 4%. The 10 years trading around, let's say, 95 basis points. So there's about 300 basis points in your pocket to be a REIT investor. I mentioned REITs versus 10-year because that's usually the benchmark that they compare it against. But let's take a bigger step back, though. COVID-19 has impacted the REIT sector high and low. One of the things we've noticed across the sector is a bunch of the REITs cut their dividends. So, Jay, I'll start with you. We'll go around the circle. How has the various dividend cuts across the sector impacted your various ETFs? Now, Jay, I know it's different for you as far as the preferreds are concerned because of dividends and arrears and all that fun stuff. But in general, from a high level, how would you say that the dividend cuts across the REIT landscape have impacted your suite of ETFs?
Well, I'd make two comments. First of all, they actually were, in terms of the preferreds, they were good to great, because there was in all but just one situation, the common dividend got cut, sometimes to zero, but sometimes to a penny, because that makes a difference for certain companies. So, but the preferred dividend was maintained. And that's exactly why we like REIT preferreds and also most preferreds, because they're publicly traded companies. They don't want to lose confidence from a credit perspective. And so they'll enhance their overall credit situation by cutting the common, but they treat the preferreds really as a debt instrument. And they don't want to signal to their counterparties that they're in trouble, so they'll need those. And that's was kind of 99% of the outcomes there. And then on the MLP side, there were substantial cuts. The better companies like EPD did not cut their dividend. But what happened is the companies cut their dividends. Everybody was too bearish about oil prices. They came back, they raised their guidance. And now what they're doing is focusing on share purchases. So now the balance of power is with the MLPs because their hedge funds aren't shorting them as much. And then just a quick macro comment on REITs. I would think of it more as in terms of the equity REITs, which we don't have any funds that focus on that, but just for general REIT investors, I would kind of think about it as a 4% yield, but most companies are retaining a lot of earnings and reinvesting it. So more like a 4 or 5% growth. So you can have a 9%, 10% total return. So most REITs are not going to be they're not going to be as interest rate sensitive as they would be in a normal market. And then the last point is just with the pandemic, we had huge dislocations. So I don't anticipate, I think REITs will do well next year, regardless of the fact that rates are rising. And particularly the ones that are like the pandemic victims, not the ones that benefited. So like maybe the tower companies underperform, maybe the industrials underperform, but office REITs like Kilroy or that are 30, 40, 50% off their highs, I don't think they're more dominated by movements in the stock market than interest rates.
So the takeaway here is Jay is saying buy mall REITs. Is that correct? Go out and buy CBL and Penn Just kidding. Just kidding. Don't answer that. Alexi, How about you? How's the net lease REITs? How's the dividend structure happening with the net lease REITs right now impacting your ETF?
I think first of all, I think it's really important to understand there's 40 plus REIT ETFs out there, and all of them effectively do very similar things and give you exposure to broader sectors. HOMZ is extremely boutique. NetL is also boutique in the sense that it's the only one that tracks net lease REITs alone. And net lease REITs, for people that don't know, are ones that focus solely on freestanding triple net lease properties. So think about things like CVS and Walgreens, Starbucks, Chick-fil-A's, Amazon and FedEx distribution centers. Really, it's built around a common structure as known as the triple net lease, which net lease REITs actually have roughly 90% gross profit margins, which is roughly 30% higher than the rest of the REIT sectors. So individually, net lease REITs actually have more conservative payout ratios that buffer REIT dividend cuts. And you can see that in the pandemic. When the world shut down, a number of REITs cut their dividends. Actually, of the 41 REITs that raised their dividend, 8 of those were net lease REITs. And only one actually suspended their dividend, which was EPR, which, just like Disneyland, they own Six Flags and amusement parks. So clearly the pandemic is a perfect storm. That being said,
theaters.
What's that?
And movie theaters.
Yeah, exactly. But talk about resiliency and when you have a moderately leveraged REIT, the average REIT in the net lease sector is less than 40% leverage, and you have an asset that you own. So if we're looking for inflation, personally, I'd rather be in equities and something that we know we can offset that inflation with, rather than bonds and fixed product assets. Just like you're seeing a lot of institutional money flow into things because they need to generate yields, and they can't take long end risk to not generate the income for their portfolio. So inherently, our ETF strategy owns 24 publicly traded companies, all NYSE NASDAQ listed. 30-day SEC yield today, roughly 4.67%. On a comparative basis, pretty wide of the 10-year and wide of other fixed income type or even yielding assets in the equity markets.
Alex?
Yeah, so I think, the two major themes of the REIT sector this year are the dividend cuts and the rent collection. And they're both highly correlated. So of the 170 equity REITs, 60 of them cut their dividend between February and June. But since the end of June, there's only been 6 more dividend cuts. Since June, there's been 47 equity REITs that have actually raised their dividend above pre-pandemic rates. And you've seen this kind of bifurcation between there's essential property sectors that have really kind of accounted for the majority of these boosts. So 13 of the 47 have been in the housing related sectors, 9 in the net lease sector. You've seen 9 industrial REITs boost. You've seen the entire cell tower sector boost dividends, the entire data center sector boost, right? So I think that kind of underscores the kind of overall theme kind of the need to kind of to be selective, but to be selective in a diversified way. And I think that what the pandemic really brought out is really this kind of acceleration of this bifurcation. And now with these newer funds, these kind of sector-driven funds, that investors really do have the capability of kind of screening out the kind of more troubled REITs, or even REITs that are just kind of not fitting with their investment strategy, whether it's growth focused or income focused.
So we're coming up to the bell here, and let's focus on the big picture. Macro view, big picture, what's the value proposition? Investors here are looking for good ideas. So guys, why should folks be buying your ETFs into 2021? I think we've been around the horn. So Alex, why don't you kick us off on this one?
Sure. All right. Yeah. So Homes launched last March. It's the only ETFs that captures the entire housing sector. And I think that you've kind of seen housing kind of lead lead the kind of early recovery. And it's really, there's this kind of greater appreciation for the value of one's home. And so you've seen essentially every kind of housing subsector kind of outperform. You've seen home improvement, you've seen home building. And the idea of homes is that you're able to kind of capture the entire housing sector in this single kind of easy and cost efficient fund.
Alexi?
Piggybacking on Alex, I think it's interesting, COVID related, you see kind of a deurbanization movement where folks are moving away from Manhattan or Chicago or LA and moving to places like Idaho and Arizona and Utah and Nevada. With that, every home builder's dream is to provide amenity to their customers. And so when you think about horizontal land development, the first thing that you see that goes in the middle of a community is a grocery store. Next to it is a gas station. Across the street is a Starbucks, and then a gym, and then a distribution center, and then so on and so forth. And so all those pieces of real estate that you use every day are part of the net lease segment. And that's what our ETF focuses on. And it's 25 stocks. It may seem concentrated. However, when you own this, you own 25 stocks that collectively are $120 billion market cap index that we actually calculate through NASDAQ. You get exposure to all 50 states in the United States with no more than 5% exposure to any one state, with the exception of Texas. 25,000 properties, 40 different industry segments, and over 3,000 tenants. And so the point of it is, this is built like a credit portfolio, and it delivers returns, today that are outpacing and gapping out further than high yield debt.
Jay, you get the last word here.
Well, we think the biggest opportunity is really with preferreds. Preferreds normally trade right around par, $25. Both the underliers and our funds are off $2 to $3 from that par value. You get that opportunity once a decade. You had it in 07, 08, 09. You see it here today. And so you're able to get some upside potential, but you get that protection I was discussing. So you're senior to common. We haven't seen any significant dividend cuts. So that's, like I said, kind of a once in a decade opportunity to add some stable income. And then MLPs are a different flavor. They're not senior to common, so they're equities. They can cut the dividend, they did, but they're recovery stocks, and the recovery stocks that pay double-digit income, deferred income, not currently taxable. So if you want, I would argue that if you want to play the recovery, it's a safer way to buy MLPs or AMZA, which is our fund, than say American Airlines or a hotel REIT with no dividends. So kind of a safer way to play equity recovery, but you have equity risk.
Well, guys, I really appreciate you taking 30 minutes out of your day to chat with us about REITs, preferreds, net lease, and your ETF companies. And obviously, should anybody want to reach out to you, Homes for the Hoya Capital Housing ETF, NETL for the net lease corporate fundamental income REIT ETF, AMZA, PFFR, PFFA for the InfraCap suite of ETFs. And with that, thank you very much. We appreciate it.
David and team, really appreciate it. Thank you guys very much. Awesome panel. Really, really awesome insights there. Thanks again, guys. Be healthy, stay safe. Really cool panel to end, close to end the day with. We have one more piece of content. Everybody stick around. We just learned a lot from the REIT ETF panel. Next up, we're welcoming back Tonix Pharmaceuticals, big player in the COVID crisis right now. Love what they're doing. They will be led by Jim Malloy, the Managing Director of Equity Research, Biotechnology, and Specialty Pharmaceuticals at Alliance Global Partners, otherwise known as AGP. Jim, how are you, sir? Oh, you might be on mute there.
I am well, thank you. How are you? Thank you for having me on.
Of course, glad to have you. I do want to say, everybody stick around. We have a giveaway at the very end of the day after this amazing content. With that said, Jim, I will let you introduce Seth.
We have Seth Letterman, the CEO of Tonix Pharmaceuticals, on with us. Tonix is one of the more fascinating specialty pharmaceutical companies we follow. There's some very positive news just the other day that we'll get through, and they are right in the heat of the COVID response as well. A little earlier stage, perhaps the next generation vaccines after the current ones go through. But Seth, I'll turn it over to you. Perhaps give a little background on yourself and Tonix Pharmaceuticals.
Well, thanks very much, Jim. Thanks to the organizers. Yes, I'm CEO of Tonix. We're a NASDAQ listed biopharmaceutical company. And we have two lead programs, as Jim mentioned. One's in fibromyalgia, where just on Monday, we announced positive top-line data in a phase 3 program. So that's a really transformative event for Tonix. We also have a COVID-19 vaccine I'd be happy to update you on, but what it has been a big week for us in fibromyalgia.
Well, let's walk through that. Just had some positive phase 3 data, as you said, in fibromyalgia. Obviously, beyond the positive hitting the endpoint, you walk through the trials a little bit, and what else jumped out besides actually beyond just hitting the endpoint, and what are the next steps?
Sure, thanks. So our drug is called TNX 102SL, and it's a bedtime medicine once a night at bedtime for fibromyalgia. We think it works through improving sleep quality. So our positive pre-specified endpoint was pain, which is what the FDA requires to approve a fibromyalgia drug. Now, you may know fibromyalgia is a chronic pain condition. It affects about 7 million Americans. About 90% of people affected are women. So our winning on this phase 3 study is really a big win for fibromyalgia patients. There really hasn't been a new fibromyalgia drug for 10 years. And ours is a completely different mechanism of action. So you said, well, what else did we see in the data? Well, we knew that it improved pain, but we saw really intriguing activity in fatigue and sleep. And those are the three main issues that fibromyalgia patients suffer from and for which they're looking relief from. So, basically, I would describe our drug, the characteristics that we showed in this phase 3 trial as broad spectrum, that it really appears to address the wide variety of symptoms that fibromyalgia patients suffer from.
I think one of the things that you mentioned earlier in the week on the data was some of the secondary endpoints were really key beyond the pain, or it should be, hopefully.
Yeah, there were a number of key secondary endpoints that we identified, and they, all but one. The first one in this waterfall was patient global impression of change. And in that one, we had a bare miss of 0.058. But below that, we ran the table with p-values less than 0.05 for fibromyalgia impact questionnaire, function domain, symptom domain, the daily sleep diary, promise sleep, and promise fatigue. So really broad activity in all these categories. And I think that will be important in differentiation when our product gets to the market, which now we, by hitting a phase 3 study, we're obviously in a completely different ballpark in terms of the likelihood of ultimate success. And by the way, we are already enrolling in our second phase 3 study. So, we believe we should have top line data from the second phase 3 study before the end of 2021.
And where would you see, should the second phase 3 bear out and ultimately get approval, where would you see this being used in the treatment paradigm for fibromyalgia?
Well, we're studying it in the paradigm of first-line monotherapy. And, fibromyalgia is characterized by polypharmacy, where, people take multiple medicines to address different symptoms. So I think the prospect of our drug as a single agent with broad spectrum activity, potentially it could, replace more than just one medicine that fibromyalgia patients are taking that they may, be dissatisfied with. So it's really, as I said, a big win for fibromyalgia patients.
I think, in many ways, the fibromyalgia market somewhat echoes the depression market in that there's a number of drugs out there as polypharmacy. People move from drug to drug. And I think the side effect profile, if I recall correctly, was very strong or very few side effects. And in a silent disease like this, that's important. You can't have You can't be introducing side effects to someone who in general, the suffering, beyond the fibromyalgia isn't that great.
Exactly. I mean, we can't really compare our side effect profile to the others directly because we haven't studied them head to head. But I can tell you that our tolerability profile is excellent. And, we had a low dropout rate, a very low rate of systemic adverse events. And even something that's observed with our medicine with some regularity is kind of an intermittent tongue numbness. Even that was observed as at a lower level than in previous studies. But you're absolutely right about the risk reward of fibromyalgia drugs. There are 3 approved drugs in the United States: Lyrica, which had been a blockbuster for Pfizer; Cymbalta, which had been a blockbuster for Lilly; and Savella, which was developed by Forest and is now owned by AbbVie. But none of those drugs won European approval, and it's partly because the European Medicines Agency wasn't satisfied with the risk-reward profile. So we think that we have a fresh shot at getting, potentially the first drug approved in Europe. And similarly in Japan, we have a lot more work to do in Europe and Japan than we have in the United States. In the US, we're 1 phase 3 study away. But our risk-reward profile, I think, is very appealing. And I think it's appealing to fibromyalgia patients who are sensitive to side effects.
Well, let's shift over to a very topical with the vaccines rolling out for COVID. Let's talk a little bit about the horsepox vaccine at Tonix, and maybe your thoughts on why that could be better or certainly needed down the road, and your take on the current vaccines and where Tonix's horsepox vaccine could fit in.
Sure. Our drug is called TNX 1800, our vaccine, and it's based on a proprietary vector that we call horsepox. And horsepox is, it's an orthopox virus, but we believe it's very closely related to the vaccine that Edward Jenner developed in 1798. So at 222 years old, Vaccinia is the oldest vaccine. And we think that that's very important in a number of ways. First, it's the most successful vaccine ever. Edward Jenner's vaccine eradicated smallpox. It is the only disease ever eradicated. So we have a long history, we believe, of predicate products that have been used to vaccinate humans. And we just had a group recently published, just about 2 weeks ago, a stunning finding that an 1860, so this is Civil War era, United States smallpox vaccine was surprisingly identical to ours. Now, there's some changes when I say a surprising level of identity, but the idea that essentially our vaccine was being used 160 years ago to vaccinate against smallpox, I think is a good testimony about how validated the technology is. Now, we have cloned into that vector the CoV-2 spike protein. So we have recently reported that non-human primates vaccinated with this construct had strong immunity to spike and also had neutralizing antibodies to CoV-2. So we think our vaccine is a very interesting prospect because it delivers T-cell immunity. Jenner's Vaccinia vaccine provided decades, some believe lifelong immunity. And that gets to your second question, Jim, about how do we compare with the vaccines out there? Well, if you look at the Pfizer and Moderna vaccine, first of all, I'm so grateful that they've made all the progress they've done. It's been awesome. But these are brand new technologies. None of these have been approved. It's really not known, for example, the durability of protection. And the current data on their activity is in people that are within 3-4 months of getting vaccinated. That's when people still have antibodies, and it's really unclear whether they will have the strong T-cell immunity that our vaccine elicits. The other things about the data so far, we really don't know if they protect against death, if they protect against getting, people winding up on ventilators. Another aspect that we don't know about the vaccine data so far is, does it block transmission? You know, the infectious nature of this, the ability of asymptomatic people to be spreaders and super spreaders. We need vaccines that will stop people from being spreaders. And in the case of smallpox, you know, vaccinia, the antecedent of our vaccine, is effective that way. And smallpox is a respiratory transmitted disease. And finally, safety. I think that, you know, for the 222 years people have been getting vaccinated with Edward Jenner's vaccine, we have a good handle on its safety. Whereas the mRNA vaccines, you know, and these other earlier technologies really have much smaller exposure data. So those 4 areas, I think, are areas where we can improve: durability, preventing serious disease, blocking transmission, and also safety are all areas where a vaccine could improve.
And it certainly seems that you know, these vaccines will, the first and out there, won't be the only ones. I mean, I think even just today there were some serious adverse allergic reactions that were found, and you're going to find that when you start putting vaccines into hundreds of millions of people. So there will be a need, I think, for additional vaccines, you know, down the road.
Yes, and even though there are supposedly over 150 vaccines in development, there's only a much smaller group, a handful of companies like us, developing vaccines that are based on live attenuated vectors. We have 2. We've focused on the horsepox vaccine. We're working on another live attenuated vector system. But another company, Merck, also has 2 vaccines based on live attenuated vectors. And there are only a handful of companies working in this area, but we think we're in good company with Merck, because in the past, past 40, 50 years, you know, they've certainly been the leader in vaccine development generally. So the idea of using a live replicating virus is that it delivers strong T-cell immunity, wakes up the immune system in a unique way, can be manufactured at scale. The doses are low, so we believe we can have 100 doses in a single vial. And also the cold chain requirements are really minimal. So we think that our vaccine could be a vaccine for the world.
Well, I see we're coming up rapidly on the end here. Maybe a quick highlight of, you have a very deep pipeline beyond these 2 products. 1 or 2 things you'd like to highlight to the group before we go.
Yeah, thank you. We have a lot going on at Tonix. Probably our most active program in the pipeline is intranasal oxytocin. We acquired this technology from Trigemina in June, and we're actively developing a stable manufacturing process for a GMP applicator device that will deliver oxytocin into the nose. And the lead indication for that is migraine. So the prophylaxis of migraine. So we're very excited. Another really big opportunity in a common problem. And similar to our TNX-102SL for fibromyalgia, oxytocin does not have recognized addictive potential.
Well, great. Well, thank you very much for taking the time, Seth, to walk the panelists through the Tonix Pharmaceuticals and the technology.
Thank you, Jim. And thanks for everyone who listened in.
Jim, Seth, thank you all so much. Very informative, incredibly insightful. Love your company, and definitely will be looking into it further, as I'm sure a lot of our viewers will. Seth and Jim, thanks again. Great. All right, Luke Jacoby, Rocky Balboa, we have come to the end. However, there's more.
Session. And I love small cap stocks. Like I've been saying all day, if you guys want to find alpha in these markets, small caps are the way to do it. We're seeing these technologies that analysts aren't even covering yet. I mean, it's crazy what we've brought today.
Yeah, absolutely. And just from the variety of industries, obviously a huge following for the EV companies, the REIT companies. I mean, incredibly important market, real estate, biotech, not even to mention biotech and cannabis and psychedelics. I mean, goodness, you want to talk about some stocks on the rise next year. We got them.
That's why we have Rocky here.
Is that why? Is it because
all of us out there in the chat, and guys in the chat, can you please throw a shout out to Shelby Jones for running this whole track for us? But again, all of you in the chat, you're like Mickey, coaching up Rocky in the early days, right? Who believed in him, you know, and they ended up being huge winners.
Absolutely. And honestly, all the companies here deserve a Mickey. And do it one more time. I think I was talking over it.
Again, this day's got me fired up, baby.
All right. Next time you'll see Luke on CNBC.
Tell us that too.
Awesome, man. Well, wait, I think we have one more giveaway though, right?
Boom. You know, I will not leave the chat hanging without another giveaway. I love the giveaways. I'm a sucker for the giveaways. We've been doing these all day. Again, a big shout out to Zinger Nation. That is all of you out there with us, trying to make yourselves better traders, better investors, getting educated. So the final giveaway that we have, this is a hot one, maybe the hottest one. It is an annual membership to our Benzinga Pro. Elliot, do you even know what this costs, the retail price of this Benzinga Pro subscription?
I have no idea. I want one, but I don't know.
Yeah, see, Elliot doesn't even have one. It's $1,400 a year. I mean, this is a serious tool. All of these small cap companies covered regularly in there. You're not going to get that out of any other service. But it is our Benzinga Pro annual subscription. The winner of this one is James S. James S., if you're still with us, you are on the clock now. I begin giving everybody 10 minutes. You now have 9 minutes. 9 minutes to email events@benzinga.com. Everybody else got 10 minutes. The day's coming to an end. We're fired up. We're trying to make some money out here. You've got 9 minutes. Email events@benzinga.com if you want to get this Benzinga Pro.
All right, 9 minutes for James, and let me qualify. I'm a new investor, so I'm still finding my way out there. And honestly, this conference was a huge help to me as a new retail investor. I have a ton of companies that I've put on my watch list. I may have made a few positions over the last few days. I'm not going to say who because I don't want to insult people that I know if I didn't buy their stock, but it doesn't mean that it wasn't a great presentation. I'm just not super rich. So awesome content the past couple days.
Absolutely, man. Elliot, you did such an amazing job putting this together. I mean, I love stocks. I love small caps. I love Wednesdays.
Hump day. Yeah.
Hump day.
And I love all you guys out there. Make sure you subscribe. Make sure you smash the like. If you like content, you want to keep educating yourselves. You want to be active in the markets. You want to join the Benzinga team, Zinger Nation out here. Join us on the Benzinga YouTube channel, 8 a.m. Eastern. We're kicking it off. We're talking more stock ideas. We're recapping the conference, and we'll get moving.
Yeah, absolutely. One last thing on our end. Thanks to Nicole, Patrick, Shelby, Nate, Morgan, Alexis, everybody. I'm missing somebody I know, but honestly, the whole team effort. Luke and yes, exactly. Rohan, Aaron, Luke, Jason, you guys are all awesome. I do want to say we have content daily. So, you know, this may be the end of the conference, but as Luke said, 8 a.m. tomorrow morning, back for more. Tomorrow afternoon, cannabis hour at 4 p.m. Before that, another version of pre-market prep. It's always here for you guys. And, you know, honestly, the tool Benzinga Pro is here as well. And people live by it. I know that. I've seen it. So super proud to be a part of Benzinga and looking forward to this again next year.
Awesome. I love you guys. And we will see you at 8 a.m. tomorrow.